Hello and welcome to Yahoo Finance Live from our homes on this Wednesday, April 29th. I'm Alexis Christoforous. So good to see you. Thanks for joining us. We have more evidence this morning of the damage this pandemic is doing to our economy. The U.S. economy contracted by 4.8% in the first quarter. It is the sharpest pace since the Great Recession, but it just pales in comparison to forecasts for the second quarter, where the worst estimate is for a 65% pace of contraction. We've got Emily McCormick with us this morning to break down this report. Good morning, Emily.
Good morning, Alexis. And yes, this was a very dismal first quarter report on U.S. gross domestic product. We had that number turning negative for the first time since 2014, and that drop was the most since late 2008 in the first 3 months of this year. So it's worth repeating that headline number. We had first quarter GDP on an annualized quarter-over-quarter basis declining 4.8%. That was worse than the just 4% drop expected. And we did have a rise of 2.1% in the fourth quarter of 2019. For personal consumption, remember that the consumer spending aspect is 2/3 of economic activity. That was at negative 7.6% for the first quarter, also much steeper than the decline of 3.6% expected. This was also the fastest drop in personal consumption that we've seen since 1980 and double the rate of the worst point during the global financial crisis. Also want to point out that we had services consumption shrinking 10.2% in the first quarter over the prior period. This was the deepest contraction we've seen of this metric on record, and household consumption overall for services deducted 5.6 percentage points to that headline GDP figure. Looking at other areas of the economy, we also saw business fixed investment dropping 8.6% in the first quarter. That was the most since 2009 as companies pulled back some of their spending plans as this pandemic forced business closures and demand to fall during the period. A couple of more positive aspects in this report. We did see residential investment, net exports, and government spending slightly positive and adding modest gains to the headline print, but these were not enough to counterbalance that sharp decline that we saw elsewhere in the economy. This is what the Bureau of Economic Analysis had to say in a statement with today's report. They said, quote, "The decline in first quarter GDP was in part due to the response to the spread of COVID-19 as governments issued stay-at-home orders in March. This led to rapid changes in demand as businesses and schools switched to remote work or canceled operations, and consumers canceled, restricted, or redirected their spending." So again, economists are expecting this contraction to deepen in the second quarter with these stay-at-home measures broadening out starting in April. That's something that we'll have to see coming, but for now, already seeing negative GDP growth for the first quarter. Alexis?
All right, not unexpected. Emily McCormick, thanks for that. I want to dig deeper into this report now with Michael Gapin. He is chief U.S. economist at Barclays. Good morning, Michael, and thanks for being with us. All right, so Emily just broke down this report for us. In your estimate, are we not just in a recession, but can we be looking at a depression, Michael?
Well, I think when you take into account the type of number we're likely to see in the second quarter and the rise in the unemployment rate, yes, I think you could use that type of terminology. This number essentially just confirms, I think, what we already knew. As you mentioned, we do have the stay-at-home orders in place, all the social distancing effects that people were even doing, it appears, before those stay-at-home orders went into place. So we already had a lot of information that the economy was contracting. It certainly is in a recession now. I would kind of hold off on the depression term until we know what the second quarter looks like. But yes, we and others are forecasting an unprecedented contraction in the second quarter. We're likely to see an unemployment rate near 20% as we move into the April and May period. Those are certainly numbers we have not seen since 1929 to 1933.
Michael, this is unprecedented in so many ways. I mean, in terms of a recession, we typically don't see a recession happen so quickly, right? It's usually a gradual process. The fact that we've just, because we slammed the brakes on this economy late in March, when we do start to reopen, what are your estimates as you sort of look through the forest here as to when we might start getting back to positive growth? Or are you even going there in terms of an estimate?
No, we are. I mean, so I think we can all debate the details and the quarterly path, but I do think that there is broad agreement on the general outline, and that is a contraction in the first half, an unprecedented decline in the second quarter, but a resumption of growth in the third quarter. So we took our view on reopenings based off estimates of where peak hospital demand is across the country and when that falls in the calendar. Most estimates put that between mid-April and mid-May. We assumed governors would want information on the other side of that indeed was the case. So we're thinking beginning mid-May into mid-June, you can see a phased reopening of U.S. economic activity across parts of the country, which would mean June should be better than May, and you should start to have upward trajectory as we move into the third quarter. That's obviously dependent on whether we have an adequate testing regime in place and we can quarantine and isolate affected persons effectively. We'll see if that's the case. But under the assumption that we can transition to a world where testing capabilities are elevated, we can avoid what I'll call a macro mitigation story where we need to shut down cities, counties, or states. And if that's the case, we should be growing then in the second half of the year.
Michael, do you think by growing, does that mean fourth quarter GDP is positive? And what does that look like? What would positive GDP look like? Are we back low single digit growth, or are you expecting something bigger than that?
So at least in our baseline outlook, which follows the positive testing outcomes, we actually have a very sizable snapback in activity in the third quarter. We're down minus 45 in the second. And then we have it up 35% in an annualized rate in the third quarter, and then 10% in the fourth quarter. For the year as a whole, though, that would mean the economy down around 6.4 or 6.5% year on year. So we recover, but it's not one-to-one. We don't make everything up. Services activity is very difficult to make up. I think people will be slow to unsocial distance. There's likely to be negative wealth effects on consumption, and commodity prices are likely to keep the oil sector retrenching after the second quarter. So we don't make everything up, but we do have solid rates of growth, and we would look for fiscal spending to keep the economy in an above trend growth path in 2021 and 2022. But it's still in an optimistic scenario. It could take 3 years to get the level of GDP back to where it was in Q4 2019.
Wow, 3 years. Okay, Michael. So then when you look at areas of the economy that are going to start to come back to life, what areas are going to start to come back before others, do you think?
Well, certainly, I think you could see a bounce back in some of the good side of the economy. As you mentioned, personal consumption was down. A lot of that was durable goods. It was offset by solid purchases of food and other goods. But so we've shut down the automotive sector for quite some time. That showed up in a lot of the industrial production and manufacturing numbers. If Detroit reopens production, even at a minimal level, the manufacturing side of the economy can begin to recover. We're just assuming a slow rebound in the virus-affected sectors, your tourism, restaurants, leisure, hospitality, all of the things that require face-to-face contact. So there we think the progress is going to be much slower. I also think if you look within the details of this report, spending on healthcare was actually down and was a drag on consumption in the first quarter. That likely reflects the fact that hospitals shut down all elective surgeries to deal with COVID. That's obviously where hospitals make a lot of revenue and where individuals are making a lot of expenditures. That will likely come back as hospital procedures normalize, and they can both treat COVID patients as well as conduct elective surgery.
Michael, within the GDP report, one number that stood out to me among many here is the personal savings rate is now closing in on 10%. How high do you think that will go?
So we don't have an explicit forecast on that. I'll just say that this is a typical reaction in a downturn, and one that was exacerbated by the stay-at-home orders, right? So normally when households move into precautionary mode, spending goes down and saving goes up. The good news is that means there is cash on hand for many households for when the economy does eventually reopen. So part of the point of fiscal and monetary policy is to hold as much of the U.S. economy in suspended animation as it can while we're in this lockdown phase. So it does suggest that cash balances have built up. on some household balance sheets, which could support spending and activity in the second half of the year. I just don't have an exact forecast. Something in the 10 to 15% range would be completely reasonable with what a model of consumption would suggest, given the decline that we've seen, given where we think wealth effects are and where the unemployment rate is going.
These are just astounding numbers that we are rattling off the tongue here this morning and have been for the past few days, Michael. And I want to get your thoughts on why the market is doing what it's doing. I'm looking at futures right now. Dow futures up about 450 points. We've got the broader market up about 2%. We just found out our economy contracted at a 4.8% rate in Q1. Is there a disconnect here between Wall Street and Main Street?
To some extent, yes. My interpretation of this would be that obviously the market is forward-looking. I think markets had already baked in a very bad first half of the year, so I think this number is expected and was priced into prior price declines. I think the other component, at least from my point of view, is market participants may be looking at this and saying, if there's damage done and permanent damage done, it's likely to be in very small business, in the types of institutions that don't have publicly traded equity, and your larger companies are likely to be in a better financial position out of this and gaining market share. And obviously there's also a very tech-heavy component to the indices. Their market cap dwarfs many others. So if we're coming out of this and thinking work from home is going to be elevated and remote working conditions are important, that obviously benefits some tech companies. So I think it's some combination of all three of those, being forward looking, thinking the bigger companies are going to gain coming out of this, and a tech heavy index to begin with.
All right, Michael Gabin, Chief U.S. Economist at Barclays, always a pleasure, and thanks for your insights this morning.
Thank you.
Let's get a check of overseas markets now. I want to check in with Edmund Heafy. And Edmund, we're going to stick with Barclays here because they are the latest big bank to set aside billions for possible credit losses. What did their latest quarter look like?
Yes, Alexis, Barclays said today that it had set aside around $2.6 billion in its first quarter to cover an expected surge in bad debts due to the coronavirus pandemic. First of all, that was double the consensus estimate. I think another trend we're going to see here is analysts grossly underestimating the extent to which we're going to see European banks front load reserves for loan defaults during this crisis. That impairment charge pushed pre-tax profits down 38% in the quarter, but revenue climbed 20% to $7.9 billion, largely due to its trading division having its best performance since 2014. CEO Jez Staley said that the bank was taking a very conservative posture based on a very harsh economic scenario. As we just heard from Michael, its modeling assumes around a 50% slump in US GDP and also UK GDP during the second quarter.
And I guess, Edmund, no big surprise to find that economic sentiment within the Eurozone in the month of April suffered its sharpest decline on record. We're seeing consumer confidence here in the US fall off a cliff as well. Walk us through this latest report.
Yes, Alexis, Eurozone economic sentiment fell to 67.0 in April. That was way worse than analysts had predicted. As you said, it's the steepest fall off we've seen since the European Commission started collecting this type of data in 1985. It's not the lowest ever reading, however. The figure is just a touch above what we saw in March 2009 in the wake of the financial crisis. There was a huge hit to the common currency area's services sector, responsible for 2/3 of the bloc's GDP.
All right, Edmund Heafy, thanks for that wrap up. All right, we are just a few hours away, folks, from the Fed's latest policy decision, and the markets are really hoping to hear a promise of more aggressive moves from the Fed. Our Fed correspondent, Brian Chung, is with us this morning. Hey, Brian, aggressive moves. I mean, we've got rates at about zero. What more can the Fed do here to be aggressive?
Well, good morning. And usually in these pre-scheduled Federal Open Market Committee meetings, we watch for what the Fed is doing on interest rates and also on the balance sheet. But as you just mentioned, with rates already near zero and QE basically being unlimited right now, what more can the Federal Reserve do? And the focus is really going to shift on its ballooning balance sheet. Keep in mind, it's at $6.6 trillion. as of last Wednesday. And then also the 9 liquidity facilities that it's opened up to try to make sure that the financial markets are functioning properly, from the US dollar to US treasuries to even risky corporate debt. Now, something that's going to be interesting now with the new GDP data this morning is going to be the economic forecast from Chairman Jerome Powell. Keep in mind that we are not going to get any sort of economic projections in this meeting, that we won't get that until the June meeting, but we will have a press conference with Jerome Powell that starts at 2:30 today, where he could provide some more color about the depth of the recession that the U.S. likely finds itself in as a result of the data that we just saw today. Keep in mind, before all this began, Jerome Powell was really championing the U.S. consumer, saying that because the U.S. consumer is 70% of the economy, it was really the consumer that was driving that post-crisis recovery that we had seen up until the coronavirus earlier this year. So the question is going to be, as the GDP numbers show just how terribly the U.S. consumer has been impacted with everyone staying at home, what does that mean for the Federal Reserve's response function? I think that'll be a big focus in that press conference. Again, at 2 p.m. is when we're going to get the statement, and then 2:30, there will be a televideo conference that will begin with Jerome Powell. Alexis?
All right, we're going to be carrying that live here at Yahoo Finance. Brian Chung, thanks for that. And stay with us when we come back, the latest numbers on the coronavirus and some optimism this morning surrounding Gilead's drug to treat coronavirus. We'll be back right after this. Grim news this morning in the fight against COVID-19. More Americans have now died from coronavirus in less than 2 months than the entire 9 years of the Vietnam War, more than 58,000 people. But the U.S. crossed another threshold yesterday, 1 million known coronavirus cases in the U.S. That is nearly 1/3 of all the world's known coronavirus cases. Now, there is reason for optimism this morning, and that's one of the reasons why we're seeing stock futures rallying. Gilead says early results of coronavirus drug trials show improvement with shorter remdesivir treatments. For the latest on this, let's check in with Anjali Khemlani. Anjali?
Thanks, Alexis. Yeah, so we did get the news this morning that, as we know, the world has literally been waiting for in order to boost that confidence to get out again. So Gilead did announce that they've got positive news coming out of 2 trials. One is the company-sponsored trial of severe patients, and they were given 5-day treatments and 10-day treatments. And it basically is, if you've ever taken a Z-Pak, it's the similar concept of a double dose on the first day and then reducing to a single dose in the following days. And so with that level of treatment, they saw improvement in severe patients, and those are patients who had symptoms and were treated within 10 days, but were not on ventilators. And they're also focusing now on an expansion of this study to include those who are on ventilators and will be taking this through an IV. And in addition, the study that's being done with the National Institute of Health, National Institute of Allergy and Infectious Disease, which, as we know, the director is Dr. Anthony Fauci. That study is the one that has more weight to it because it is the placebo-controlled study and is not the company-sponsored one. So we're still waiting for the full results on that one. As we know, they're just sort of the outcomes that they've seen, and they do need to push it through peer-reviewed journal publishing. So we're waiting for that to happen. But as of right now, it does sort of give you that optimism that the outcomes that they did expect on this drug are in fact showing through.
Definitely encouraging news, Anjali. I want to talk about testing right now. What is the latest on testing? Are enough tests being handed out throughout the country? I got an email yesterday from CityMD because I was a patient there a couple of times, and so they sent this blast email out saying, we have tests, come in and get tested. Where does this country stand right now on testing?
Right. So we're seeing a pivot now, actually, in what the provider community and the labs are doing. We know that in conversations that I've had with Quest and LabCorp, they've been taking on sort of the lion's share of the testing, if you will, partnering with all the drive-through sites and pharmacy and retail sites. And so what's happened is there was a limit. The CDC had set a limit on who could be tested, and it was really focusing on severe patients and those that they really needed to test. Meanwhile, asymptomatic people or those who seemed like they had mild or moderate cases would not get tested because there was a concern about the supply chain. Now, that supply chain concern still exists, but we've expanded. The CDC has, in fact, expanded the criteria of who can get tested. Meanwhile, the FDA has approved a dozen more testing machines and types of tests. So that has really increased the capacity for these labs to be able to process. And so you're seeing that all come together with more availability than the demand, as people have stayed away, as they've been told that they can't be tested or turned away. So now you're seeing sort of a break in that, and that has a lot to do with the new focus that we have right now on reopening and making sure that everyone does have access to a test. Alexis.
All right, thanks for the wrap up, Anjali Khemlani. And stay with us. We're about 8 minutes away from the opening bell. We'll get a check of the markets with Jared Blickery after this. The U.S. economy shrank at a 4.8% pace in the first quarter, but get a load of this. Stock futures are rallying. Dow futures up more than 400 points. For the latest on all this, let's go to Jared Blickery. What are you watching, Jared?
I'm watching the price action here. It's been a very active morning, and we still have a Fed decision coming at 2 p.m. So we have the Dow, the S&P 500, and the NASDAQ up all over 1.5%. And I just want to point something out. We did get the GDP announcement, but it was 2 minutes late at 8:32. What happened at 8:30 was Gilead came out with that news about the new remdesivir trial, and that just shot markets up. So that's responsible for this bump up that we're seeing right here. I think markets are pretty much shrugging off any rearward looking economic news like GDP. But we can see in London, the FTSE is up over 2%. Paris, the CAC 40 is up over 1.5%, and the DAX is up 2% as well. Just look at some of the leading sectors. We have energy, materials, and financials all outperforming, Alexis.
All right, and I'm getting whiplash here looking at the oil markets, Jared. Now crude oil up 26%. I guess investors scrutinizing some storage data out there.
That's right. It's not a day unless crude oil is moving 25, 30% to the upside or the downside. Only takes a few dollars to make this happen because we're looking at WTI with a 15 handle right now. Nobody saw that coming a month ago, but it is kind of the new normal right now. We can take a look at the overnight price action. And yes, it has been kind of a bumpy ride over the last few days, but today it's been mostly up, up, and away. So here's the last 5 days and a much different picture. We can see that dramatic sell-off that we had Monday. And if we go back to a year-to-date chart, we can still see that June contract is off about 74% year-to-date. And so this just translates into a lot of hardship for the energy sector. But I will note that the energy sector has been leading recently, and that is a good sign. So let's take a look at the Dow heat map. And we can see in the pre-market, Microsoft is up 2.3%, Apple's up over 2%, JP Morgan's up over 3%. And so we do have this potential rally in store today after the bears failed to take things down yesterday. And we'll have to see what the open begins here.
And we won't have to wait long, just a few minutes away. Jared Blickery, thank you. And again, investors awaiting views from Fed policymakers on the health of the U.S. economy. And of course, we've got a flurry of earnings reports. We'll be back right after this. We'll see if stocks can hold on to this early rally throughout the day, sparked by Gilead on good news about its coronavirus trial drug. Here's the opening bell on Wall Street. All right, new trading day underway on Wall Street on this Wednesday, and joining us is Darryl Cronk. He is president of Wells Fargo Investment Institute. Darryl, we have got the Dow up about 440 points here in the early going, yet we had a dismal report on gross domestic product. What do you make of that?
Yeah, well, a lot of it is in the rearview mirror, Alexis. I guess if there was anything that I didn't like in the report, personal consumption was down almost double the amount that we expected. It was down 7.6 versus about 3.6 on the estimate. That just signals that people just are not spending, whether they're spending from the home as they're quarantined or locked away, or whether they're out and about doing something. So it probably sets up for at least a second quarter GDP on the downside of estimates, perhaps even with maybe a 3 in front of it, unfortunately, for quarter over quarter.
Darryl, how do you anticipate consumer spending to come back? Because to your point, we had the personal savings rate now climb close to 10%. We just had Michael Gapin on over from Barclays suggesting it might hit 15%.
Yeah, and 10 to 15% savings rates would be more consistent with what we saw back in the 1960s, 70s, not with the 3 to 5% we've seen in the last couple years. I think it's going to take a while. First of all, consumers are going to keep more of a cash buffer, as are businesses, so more cash on hand. And I think consumption is going to struggle in the second quarter materially. We do think it will pick back up, Brian, in the latter half of the year as we begin to unlock the economy. But right now, it's going to be pretty ugly numbers for a while.
And of course, the other big thing that's going to happen later today, the Federal Reserve. Darryl, what are you expecting? Are you expecting Jay Powell to say that they have more bazookas left in the arsenal here, and what might those look like?
Yeah, it's a really good question. So first of all, they won't do anything, obviously, with interest rates. They're going to reiterate the fact that they're all in on the coronavirus support for the economy. What I really want to see, though, Alexis, is I want to see guidance on size and scope of 2 or 3 different things here. Number one is, what are they going to do with continued quantitative easing? We know they've been tapering that week on week of Treasury and mortgage-backed purchases. But the reality is, with all the net new issuance, with the budget deficit where it is, they're going to have to continue to purchase at sizable rates in the second half of the year. Number two, I want to hear if they're going to be willing to provide any more additional aid to state and local governments. We know a lot of the state and local government aid has not been in the congressional packages, but the Fed has an ability to support through the municipal lending programs, through the commercial paper programs that purchase short-term muni paper. So those can be important points to get updates on and how the Fed's going to execute there. And number three is around corporate bond purchases, both in investment grade and high yield. So far, they haven't launched or begin purchasing the bonds in the primary and secondary facilities that they launched. I want to hear when they're going to start doing that and how they're going to allocate the capital. So are they going to go to the sectors that are most hardest hit and most in need of the capital? Are they going to stay up in quality and make sure that they're only buying quality paper? But guidance on those 3 things, I think, are really important news for the markets to understand how they're going to implement and execute around size and scale of these programs.
Do you think Jay Powell might even go there in terms of when we're going to see a move on interest rates to the upside? When do you think we might start to see the Fed actually raise interest rates?
So I have no doubt in the press conference he will get asked that question, because inquiring minds want to know. But I don't think he's going there anytime soon. I think he's probably going to say it will be years before the Fed begins to raise interest rates. First of all, you've got to see some level of outsized growth. And there's a lot of concern that, we're in this disinflation, deflationary environment. So until you start to see some positive numbers on inflation, there just isn't a good case to raise interest rates anytime in the foreseeable future.
But Darryl, just building on Alexis' question there, if not rates, when does the Fed start pulling back on some of these extraordinary lending programs? I'm guessing it's no small surprise. We've seen a pretty serious market rally when they announced some of these plans in early April.
Yeah, Brian, and obviously the overused word of unprecedented, right, in places they've gone and the scope of the programs. I think these programs are going to be here with us for years. I don't think they're going to pull back anytime soon. And I think what many misunderstand or don't understand currently is many of these programs haven't even launched yet. They've simply been announced. And so that announcement of a backstop to whether it's the municipal bond market, the commercial paper market, the investment grade corporate bond market, the high yield market, the purchase of ETFs have just provided that backstop support, even though the Fed is not actively in there purchasing those securities at this point. So the fact that we've just announced these programs, we haven't even begun implementing them, probably suggests to me that they're going to be with us for quite some time.
All right, I want to get a check of the markets now with Jared. We're 5 minutes into the day, and a lot of earnings reports out before the bell this morning. Is that helping to fuel any of this positive momentum, or is it all about the Gilead coronavirus drug?
Well, I think Gilead was definitely a catalyst at 8:30, but futures were already up at that point. Here we're looking at the Dow heat map, and we can see tech is outperforming just slightly. Microsoft up 1.7%, Apple up 2.5%. If we go to the NASDAQ, we can see Alphabet really leading communication services here. We got Google up about 10 or 9 or 10% here. Facebook also up close to 5%. But you mentioned earnings, and we have a bunch of earnings reports out. So let's take a look at our heat map for that. And of course, there's Alphabet, the big kahuna right there in the left, but also MasterCard up 5.5%. Just scanning for some other names, we have Boeing up 4% or nearly so. And then Valero Energy also up 8%. And when you take the whole picture of what the market's been doing, we're marching in terms of the S&P 500 all the way up to that 3,000 level. It's kind of a target that's been on a lot of traders' radar. And so far, so good, but a lot of them are looking to put on shorts at that point. So we'll have to see if anything comes of that. But that means if the market climbs above that level, you're going to see a lot of short covering, and we can very definitely see a rally that exceeds people's expectations. The consensus just a week ago was that we're going to revisit the lows of the March, and probably not going to do that anytime soon. But we just have to take this one day at a time, Alexis.
Good advice. One day at a time, as hard as it is to do. Daryl Cronk, president of Wells Fargo Investment Institute, and Jared Blickery, thanks so much. And stay with us. Coming up next, we're going to hear from the CEO of WW International. You know it as Weight Watchers. We'll be back right after this. Earnings reports continue to flood the market, and one of the latest to report is WW International, the company formerly known as Weight Watchers. They reported a narrower than expected loss late yesterday, and joining us now is the CEO of WW, Mindy Grossman. Mindy, so good to have you on the show. Good to see you again.
Great to be here.
You had subscribers reach 5 million last quarter. That's an all-time high. I believe subscribership growth was up about 9% in the quarter. We know the quarter included some of the shutdown that we're now all experiencing. What fueled the growth in subscribership last quarter?
We entered the year in a very strong momentum from the launch of MyWW, which is our new program, more personalized than ever. And we also had the incredible aura of the 9-city WW Presents Oprah's 2020 Vision Tour, which generated about 80 billion impressions. And I think really not only served to for people to see how the brand has transformed, not just around weight, but around total wellness. And the combination of those things coming into the year were just fantastic. To your point, the last 2 weeks of March, we definitely saw a fall off, but the team, and I can't congratulate them enough, from around the world, really galvanized both our product and tech teams, our field teams. And in 6 days, we had trained 14,000 coaches and guides, and we had a simultaneous global launch of virtual workshops. And in the first week alone, we had 12,500 workshops. So although we definitely saw the recruitment, particularly on the studio side, and we were one of the first people to make that decision, because at the forefront of everything we do was the safety and security, certainly of our employees and our members. But the pivot to virtual was not just important from a business perspective. We knew how important it was going to be to keep our community together in an environment when that's more important than anyone else. People want community, they want motivation, they want support. And we've been able not just to give them the workshops virtually, but we created connect groups within our app so they can stay connected to those they want to stay connected to. We then saw some continuation at the beginning of April, but digital recruitment started coming up. And in the last 2 weeks of April, they've actually been comping positive.
You know, Mindy, I'm going to jump in here because about a week ago, we had Anthony Scaramucci, the hedge fund guy, on our air, and he was talking about, he called them Corona calories, how people, he's staying home like we all are, he's eating more, packing on the pounds. I'm curious what you're seeing, because you're able to see consumer behavior in real time. What are your clients telling you? What are they talking about right now?
To your point, it's been very interesting. Because of the move to virtual workshops and our ability to listen to people daily, globally, in real time, and our Connect platform, which is our social platform, we can have a report at the end of every day. What are people saying? What are they feeling? What are they tracking? What are they eating? And what are they doing? And we are starting to see a shift. We can also see why our new members joining. And in the beginning, everyone was hunkered down. And now people are starting to say, I need to address my health. I need to think about what I'm going to do for myself coming out of this. And I do believe that health and wellness is not going to be a luxury going forward. It's going to be a necessity as people really reappraise how they're going to live and how they're going to spend. And so we're really seeing a switch to, I have to be healthy. It's not just, I have to lose weight. And I think that's really important. Now, their cycles and their behaviors are changing. People are working out during the day, not just morning and night. Surprise. What are people eating? People are using their pantries more, so less fresh and more other food. So we've been able in real time to change our content, to change our recipes, to focus on stress management. People are using Headspace within our app much more. We're getting ready to launch sleep tracking within the next week or so, where people are really talking about that. So the more we can really react in real time to how people's mindset is changing, the more engaged they will be. And that's why we've been able to retain our retention at 10 months, even during this time when studio recruitment is obviously pressured because they're not open.
Mindy, one number that caught my attention on the earnings call last night, you guys mentioned $100 million cost savings plan. That's a lot of costs coming out of a business your size. Where are those costs coming from? Because I think that's one of the big reasons why the stock's moving pretty high, pretty significantly higher this morning.
So the cost reduction was twofold. One, we're in a very uncertain environment. As you saw, we pulled guidance for that reason, and we're being very diligent and prudent in our spend to ensure that no matter what happens, we have a healthy business. We're very cash generative. The second is we want to continue to invest for innovation. If you saw, we've been talking about for 2 straight quarters, and we're on track to launch a whole new vertical of the company later this year, which is digital plus virtual group coaching, which gives us another area for both revenue and recruitment. So if you look at where we looked at costs, part is marketing. Now, again, we will invest as we see marketing efficacy, but we're being conservative in how we're planning it. The second is overall headcount, and the third is operational. So I would say a third, a third, a third. But again, we're going to be very prudent. We're going to watch as business unfolds. We truly believe that we are positioned, given our digital transformation and our transformation to weight plus wellness and what we could deliver to people, very strongly coming out of this, because that is what people are going to need. They're going to need support. They're going to want to have healthy habits and get back to ritual and have the engagement. So we are just being, responsible during this time, but we feel very optimistic about where we can go.
All right, we're going to leave it there. That the glass is half full at WW International. Mindy Grossman, CEO. Thanks so much. Always good to see you.
Always great to see you. See you on Peloton.
Definitely.
All right, thanks. And coming up next, we're going to take a deep dive into Boeing. It's out with earnings this morning, and it's not pretty. Stay with us. A rough quarter at Boeing. Revenue came in below expectations. The aerospace giant posting a big quarterly loss of $641 million. It also burned through $4.3 billion in cash during the first quarter. The CEO saying the coronavirus is affecting every aspect of the business. However, the stock is up nearly 5%, helping to lead the Dow higher this morning. Let's talk more about it with Peter McNally. He covers Boeing at Third Bridge. Good to see you, Peter. Good morning. Is this really about the coronavirus or about Boeing's ongoing missteps ever since it had to ground the 737 MAX?
Well, good morning, Alexis. I mean, there are three big things that we, see here, with Boeing. It's just the cash burn in the balance sheet, the production issues, and the investigation into the 737 MAX. Now, we've gotten some of those answers today. Particularly on the cash burn. We've gotten an update on production, but the go-forward plan for the MAX, 737 MAX, is still uncertain.
What do you think a debt raise looks like for this company? How penalizing do you think it will be?
Well, they need the liquidity. I mean, so, look, they've taken measures by tapping credit lines. They burned $4 billion last quarter, but there's only $15 billion left in cash on the balance sheet, or that's actually up from the start of the year. They terminated the Embraer joint venture. And, we've seen kind of the caution on the part of management of taking government funds. So you are left really with the debt markets at this point. So it may have to happen.
Peter, we know that Boeing has said it's going to have to cut its workforce by 10%. Is that the kind of move needed here to fix this? Do they need to get a lot more aggressive?
That remains to be seen. It depends on when their customers start flying again and what those fleets look like. They are stepping down production again, pretty much across the board. But until planes start flying again, commercial aircraft, we're not really sure what the total cuts are going to have to be. And I would just point out that, most of the airlines, or at least the U.S. airline customers, that they have, they haven't been cutting frontline workforce, pilots, crew, and things like that. So it's still, maybe a temporary situation with the coronavirus, that business could get back to normal. I mean, management does cite in their release that they do think the long-term fundamentals are intact. 10% reduction might be a start, but if those long-term fundamentals change, then sure, things could get worse.
Do you think David Calhoun is the right CEO to be leading this company? And has your confidence in Calhoun been shaken at all? I would really strongly argue that he has made a lot of missteps in the early going here.
Yeah, I mean, look, we have clients who've made that argument, but at the same time, he's finding out more, or we're all finding out more and more about the problems with the company. So there's this new, or the emergence of another FAA, DOJ investigation. We still have questions on the production and the safety of the MAX. I think anybody, whether or not they were Calhoun or not, would have a tough time coming to terms with this new information. So we'll see how these things perform going forward.
Peter, I'm sure you're aware, shareholders voted this past week to separate the CEO and chairman positions. Is that the right move here?
Look, I think it's part of a long-term governance trend that we've seen in a lot of industries, over time, pretty much since the financial crisis. But I think most people would say at this point, yes, that is the right move for this kind of business too.
All right, Peter McNally, global sector lead at Third Bridge. Thanks so much for being with us to talk a little Boeing.
All right, thanks, Alexis and Brian.
All right, another stock we are watching today is Best Buy, because it is providing possibly a blueprint for how some retailers are going to reopen their doors when it is safe to do so. And it looks like they're doing it, Brian, with appointments. You can come into the store by appointment only to keep crowd control and customer safety as a main priority. What else did they have to say, and how is this going to actually work? What are the logistics here?
Yeah, Alexis, welcome to the new age of retail post the worst of the coronavirus situation. So yesterday, last night, Yahoo Finance broke the story. Best Buy reopening only 200 stores by appointment only. Basically, you go into the Best Buy app, you make an appointment, you then have a pre-call with a Best Buy associate, making sure you feel okay, and then you could come to the store. Once you get to the store, the Best Buy employee will greet you at the store, walk through some social distancing guidelines, and take you through the store. And hopefully you buy something. You check out, they wipe the registers, and they escort you back out of the store. I'm also told by a person familiar with the matter, this does not change Best Buy furloughing 51,000 workers. They came out a couple days ago and said that will be in effect potentially for 2 to 3 months. But overall, Best Buy, very nicely thought out plan here to keep people safe for coming back into their stores and buying stuff they probably need.
So wait a minute, is this the honor system? Meaning they're going to ask you, hey, do you feel okay? And even if you're not feeling great, you're going to say it's okay. I mean, are they going to take your temperature when you walk in? Or are they just going to like believe you?
What I saw, the image that I saw on how this process works, they are not taking temperatures. They're not there yet. But when the person does show up at the store, they're going to be greeted by a Best Buy employee wearing a mask, wearing gloves. You get hand sanitizer. This is a big change in retail. Look, we've been going to Best Buy, Target, and Walmart pretty much our entire lives. We all walk in these stores, and especially on something like a Black Friday when we just bum rush these stores, that's not going to happen this time around.
Whoa, yeah, right. Good one there. I mean, the way we shop, at least for the short term, is going to be really, really different. All right, Brian, thanks for breaking that story. And now let's get a hit of the markets with Jared. And Jared, I see the Dow up about more than 460 points.
Yes, it is. A nice rally to start the day here. That's 1.9%. NASDAQ up, outperforming, up 2.58%. We've seen tech kind of lagging over the last few days, but not today. S&P 500 also up 2% or more. And then the Russell 2000, which has been a leader over the last 3 days, also doing very well today, up 2.38%. Now, some of the sectors that are leading, communication services, that's going to be Alphabet, which is 25% of that sector. And that is outperforming today. We see Microsoft up over 2%, along with Apple nearly 3%, Visa nearly 5%, JP Morgan up over 4%. So financials, energy, and communication services really taking the lead here. And of course, we cannot neglect crude oil because that is up, let's see here, what is it, 25%. Another nice day for crude, but very whipsawed.
Whipsawed is the word. All right, thanks for that, Jared. And once again, the U.S. economy shrank at a 4.8% pace in the first quarter. That was worse than expected as we begin to see the damage this pandemic is having on our economy. But it's not pulling back the stock market, as you just heard from Jared. Stocks rallying here in the early going. Stay with us. Much more Yahoo Finance Live straight ahead after this short break.
Welcome back to Yahoo Finance Live. You're seeing the markets in rally mode. I want to get right to Inez Ferre, who's watching a whole bunch of companies that reported earnings this morning. And Inez, let's start with GE. Not a good quarter from GE. What's the latest?
No, that's right, Brian. GE, well, that stock right now is up about 1%, but its first quarter revenue declined 8%. Its adjusted earnings coming in at 5 cents a share. Its aviation segment, that took a hit during the quarter. Its healthcare segment, though, did see revenue rise by 7%. It does expect this quarter, Brian, to really see the full impact of COVID-19. And I'm just showing you a year to date of GE. It's down 38% year to date. Taking a look also at Hasbro, down about 5% right now after its adjusted earnings came in at 57 cents a share on revenue of $1.1 billion. Kids have been staying at home, of course, because of the shelter in place. So the company did say it saw demand for family games, for Play-Doh for kids increase during the quarter. It is, though, withdrawing its 2020 guidance that it issued back in February. And then lastly, I just want you to look at Blue Apron. Really under pressure this morning, down 22%. The company posted a net loss of $20.1 million last quarter. As far as its guidance, it's expecting this quarter's net revenue to grow in the high single digit year over year. It did see customer growth last quarter, but right now it's focusing on retention of those customers, Brian.
All right, thanks so much, Inez. Let's dive into the markets now. I'm bringing Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeff, always good to speak with you here. My mind right now is on earnings season. Do you think the market is right to completely ignore these earnings reports? We have dividend cuts, no more buybacks. I got GE out this morning saying it burned through $2.2 billion in cash. Now it's looking for another $2 billion in cost cuts. What the heck is going on here?
Yeah, there are some things to be focused on this earnings season, even though it is a bit of a look in the rearview mirror. None of these companies are proving pandemic proof, as we just heard a couple of names this morning that are suffering on results a little worse than many expected, given their businesses. But look, a lot of companies are looking to hoard some cash right now. They don't know how long this is going to be. We are on the cusp of these reopenings, but we don't know how fast they're going to proceed. We don't know how successful they'll be. So companies are really looking to hoard that cash and take guidance out of the, whatever guidance they had, take it out of the picture. And so that is a pretty negative picture for a market that's already rallied back on the idea that this will be a fairly rapid recovery, given that we're now maybe at peak lockdown.
You know, Jeff, is the market just simply too optimistic right now? We found out today our economy shrank more than expected by a 4.8% annualized rate. It's expected to get a heck of a lot worse in the second quarter. Why is this market continuing to be so resilient?
You know, the stock market is at a complete disconnect from the other markets. Take a look at the bond market. Yields are about as low as they've been during this downturn. Look at commodities. I know oil's bounced a little bit this morning, but they are pinned to their cycle lows as well. Yet stocks have rebounded pretty significantly. So I think there's certainly a bit more optimism, maybe a lot more optimism in the stock market around the pace and success of these recoveries, of these reopenings, I should say, that's not embedded in other markets. So there's a lot of skepticism across the rest of the marketplace not being seen in the stock market. So you have to ask, well, why? Why is that the case? Why are stocks where the optimism is being concentrated? And I think I just have to say, you know, it's interesting if you look at ETF flows, we have not seen the type of selling you'd normally expect to see in downturns from individual investors. That would normally kind of give you the next down leg and then be very slow to come back. And that hasn't happened this time. It's a bit curious, but I think many individual investors are focused maybe more long-term or maybe more focused on their personal health than maybe their financial health.
Good morning, Jeff. It's Heidi Chung here. So you're not the first strategist that we've talked to that has said that we're potentially going to see a W-shaped recovery. So at the end of this pandemic, can you give us a little more insight on what you mean by that W? Are we encouraged here, or are you encouraged here, that the recovery in China and South Korea seems to be on track at this point?
I am encouraged by that, and I'm not forecasting a W, but I do think it's a risk. We are watching these high-frequency indicators, things like we watched in China and South Korea, things like rush hour traffic, retail foot traffic from shopper track, you know, as that begins to come back a little bit here. Looking at air pollution for a gauge of manufacturing recovery, electricity use is a gauge of the service sector coming back online, and then, of course, having to watch these new virus cases every day. They have been successful. You almost say V-shaped recovery in China. They have not seen a further uptick in new cases, but we're now a couple of weeks past the reopening in Austria, and it looks like more of a slower recovery. Italy targeting May 4th, Germany and France have different dates at which they're beginning to reopen. So we're going to need to watch this on a real-time basis. I think that hopefully there are some signs that they may be successful and not lead to another spike in cases that would give us that W. But it's early to make that assessment, but the stock market seems fairly convinced.
Jeff, that's pretty clever to watch air pollution in China. I'm actually writing a note to go back and check that myself. My question is, do you think we're in a new bull market here?
I think we're on the cusp of beginning one. Has one already begun? I don't know. We like to say, bottoms are a process, not really a day. So I think maybe a little bit more evidence needs to come into play before we can declare the bear market over to new bull market intact. But I do think that new leadership usually comes with a new bull market. And it's interesting to note that we've seen value stocks lead the recovery so far. I don't want to dismiss what we've seen in some of the tech names, but look, energy and materials have been the leaders, the two best performing sectors off the low. I'm not sure how sustainable that is given the lack of demand for production and transportation right now. But it's interesting to note given the fact that the entire last cycle was led by tech.
Jeff, what are your expectations from the Fed today? We don't expect them to move, of course, on interest rates. They're already at zero, pretty much. We're not going to go negative. At least many people don't believe we will. So what do you expect Jay Powell to actually say later today?
I think he's going to say that the Fed stands ready to do more if necessary. I think he's going to probably be forced to say something about how they still don't believe negative rates are likely, because, of course, we've heard Coach Lakota and others that it's a possibility. But I think more importantly, the Fed may just say they're ready and they're watching the data very closely. He may talk a bit about, and this might, result in a tweet from the president, that maybe the reopenings should be very cautious and very slow to ensure a successful recovery. We'll see whether he chooses to delve into that territory.
Jeff, let me get back to something you just mentioned, value versus growth. I'm starting to see a rollover. Some of these big cap tech stocks like Amazon that have led us the past month. Is that a red flag to you?
No, because I think we need new leadership. I think that many of those leaders have done a lot. Their movement, their valuations, the expectations around them are probably being ratcheted down to a greater degree. I think we need to see leadership from bigger groups that haven't participated in maybe a decade, like financials. A big group here like to see the yield curve steepen up a little bit more and begin to lift that sector. I think that is kind of a second wind we would need to really see this thing get going.
And Jeff, what about oil? I was looking at some of the oil ETFs. It surprises me to see they have done reasonably well despite all the volatility in oil. Do you like the oil space at all as some form of value play?
We are neutral on oil right now, and that's kind of a big call, kind of a contrarian call in and of itself. The oil stocks tend to move on not on the front month contract, 24 month contract. They tend to look out a bit for prices. Those are still over $30, and I think the expectation is they've got the liquidity to kind of make it through this near-term environment. So if you're looking past this, wherever this recession ends and the recovery begins, probably within the next 2 years. So they're looking through that and have the cash flow to hang on to it. I think investors are encouraged that there might be some value there, but I wouldn't get too optimistic given longer. It could take quite a bit longer for demand to come back in a number of industries like cruise lines and air.
So Jeff, speaking of value, where do you see it right now, at least in the short term, for investors who still feel comfortable being actively in this market?
It's actually maybe not in the U.S. If you take a look in Asia and you take a look at Europe, those markets have lagged for a long time, yet they are showing some early signs of success as they reemerge from the shutdowns. Their shutdowns were total and successful, unlike maybe what we saw in the U.S. We're also seeing, signs of increasing stimulus there. They've got a broader social safety net that actually has meant we've seen far fewer layoffs, maybe 1 to 10 layoffs that we're seeing in the U.S. And that might mean a more rapid recovery. So, as I look at some of the sectors and industries, European countries look more attractive to me than what I'm seeing in the U.S.
But Jeff, bigger takeaway here. This is the stimulus-led rally in Europe, in China, in the U.S. At what point do you think some of these stimulus efforts, these governments start to pull back on some of these things? Is it off the table for this year and those pullbacks are in 2021?
Maybe, I don't know. Do we get the pullbacks? It's interesting. Remember the 2010s were supposed to be the decade of austerity after all that 08 and 09 stimulus, and they weren't. So I don't know when that's going to happen. I worry a little bit that all the stimulus that's chasing the markets up now turns into a big heavy debt burden and weighs them down later in terms of overall growth. So it could make this downturn shorter. It could make the recovery miserable. We'll have to see.
All right, let's leave it there. Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab. Always good to speak with you. Stay safe.
Thanks, you too.
And stick around. It's Warren Buffett week here at Yahoo Finance. We'll see what he had to tell our Yahoo Finance editor-in-chief, Andy Sower, straight ahead. Welcome back to Yahoo Finance Live. Now, many people are still analyzing the fallout of the global COVID-19 pandemic, but Warren Buffett has thought about situations like this for quite a while. Our editor-in-chief, Andy Sower, sat down with the Oracle of Omaha for his thoughts. Take a listen.
So how do you assess what's going to happen, and does that change your outlook?
Well, it's going to be terrible, but I've always felt a pandemic would happen at some time. I mean, I've actually used that term, in describing things that can interrupt the progress of not only this country, but the world. It won't stop the progress of the country or the world. I mean, this is a terrible event that's occurring. We don't know how terrible, and it may not turn out to be that big a deal when we get through, but it may turn out to be a very big deal, and we just don't know. And I certainly don't know, and nobody knows. But there will be other things that happen in the world in the next 5, 10, 20 years. That's the way the world works. It's not a totally even course. The progress of mankind has been incredible, and that won't stop. I mean, you flew out here, yesterday or today, and you flew over a country that 250 years ago, there wasn't anything here. That's only 3 of my lifetimes, and there wasn't anything here. And now you've got all these bountiful farms, and you got 260 million vehicles in the country, and you got 80 million owner-occupied homes, and you've got 155 million or whatever it is, million people working, and I mean, it's incredible. I went, when I had a medical check the other day, I went to incredible medical facilities that are just 2 or 3 minutes from here, and that wasn't here. Wasn't even here 100 years ago, and so we keep making progress. We haven't forgotten how to make progress in this country, and we haven't lost interest in making progress, and that will benefit to varying degrees all kinds of people, including around the world. But there will be interruptions, and I don't know when they will occur, and I don't know how deep they will occur. I do know they will occur from time to time, and I also know that we'll come out better on the other end.
Make sure to tune into Yahoo Finance on Saturday, May 2nd. We'll be covering the Berkshire Hathaway Annual Shareholders Meeting live. Check out our exclusive coverage at 4 p.m. Eastern Standard Time. Now, with so much stress on the U.S. food supply during the COVID-19 pandemic, it's clear the country will have to find new ways to produce food to feed everyone. One company shaking things up in the farming space is Plenty. Matt Barnard is the co-founder and CEO of Plenty, and he joins us now. Matt, good to see you this morning. Thank you for taking some time. First, walk us through, how does Plenty work? And amidst the situation we're all experiencing, have you seen a pickup in your business? I think, Matt, you might have to unmute. Matt, Matt, can you hear me? All right, we'll try to get back to Matt, having some technical difficulties on our end here, but do stick around. We'll have much more in the markets, and hopefully with Plenty straight ahead. Welcome back to Yahoo Finance Live. Let's get right to our very own Heidi Chung, who's closely watching some earnings this morning. Heidi, let's start with Yum Brands. I know it's a company you follow very, very closely. Mixed quarter from them.
Yeah, Brian. So I think going into these restaurant earnings, expectations are already pretty low because of a lot of what we've heard from management in the recent month regarding the negative business impact from the COVID-19 outbreak here. Revenue for Yum Brands during the first quarter jumped 0.7% year over year to $1.26 billion. Adjusted earnings per share coming in at 64 cents per share. Global same-store sales, though, jumped 4% year over year, but it was still a 7% decline. We had KFC same-store sales falling 8%, and Taco Bell same-store sales actually posting a surprise growth here of 1%. And Pizza Hut continues to be the laggard amongst the brands here, down 11% during the quarter. On the company's earnings conference call earlier this morning, management actually telling us that global same-store sales for Yum were flat in the first week of March and rapidly declined in the following week. They had about 20% of the stores closed at the time, and global same-store sales plunged 30% across the second half of March and into April. So it wasn't a pretty picture when we started that outbreak. Of COVID-19 outbreak, excuse me. But that being said, they told us that the recovery is actually really good at this point materially for the company, but they did withdraw their guidance due to the uncertainty surrounding the pandemic. Management saying, though, that the second quarter same-store sales is largely going to be dependent on when the stores start reopening. At this point in Asia, a lot of their stores, most of their stores, I should say, are open again at this point. We are seeing Yum Brands shares down about 0.7% this morning.
And Heidi, I know you're also watching Spotify. Have they started to make any money yet?
Well, they do expect to be free cash flow positive this year, so that's some good news. But all in all, a really solid quarter for Spotify. It's a different story when we look at the shares. It's up a lot. It's up more than 10% this morning compared to Yum Brands, which is of course down. But first quarter revenue jumping 22% year over year to 1.85 billion euros. Estimate was for 1.84 billion euros. Monthly active users during the quarter jumping 32% year over year to 286 million. Q1 marked the third consecutive quarter of year over year growth above 30%. So really solid there. Global premium subscribers increased 31% year over year to 130 million. Looking at the guidance, the company reiterated long-term guidance here. Full year total premium subscribers expected between 143 million to 153 million. And it also reiterated full year monthly active user outlook of between 328 million to 348 million. The company also saying that in the second quarter, it expects monthly active users between 289 million to 299 million. And it also sees second quarter total premium subscribers between 133 million to 138 million. Now, the company also saying, though, that ad sales did slow down very meaningfully at the end of March as companies started to pull back on some spend there amid the COVID-19 outbreak. In late February, though, the company did see a big hit to monthly active users in those countries that were hardest hit by coronavirus, namely Italy. But since then, things have rebounded significantly for the company, and it is pretty positive going into the rest of the year. Spotify also saying that usage in car, wearable, and web platforms dropped some double digits in some instances, but the audience through TV and game consoles grew very materially in the past quarter, Brian.
Yeah, Heidi, quote of the day here from Spotify. Quote, every day now looks like the weekend. Pretty much sums everything up right now. Go out and order some Pizza Hut. Heidi, I know they need your business. Let's switch gears here. Amazon is staying all in on the NFL despite uncertainty on when sports will resume. Yahoo Finance editor-at-large Dan Roberts joins us now. Dan, Amazon is still clearly bullish on the NFL, judging by this story you just broke.
Yeah, absolutely, Brian. And look at the fact that 15.6 million people tuned in for the first night of the NFL draft last week when the whole thing was virtual. I mean, it was sort of the most cobbled together draft the league has had to have. And yet, record numbers. In fact, overall, over the course of the 3 days, it was the most watched draft ever, which just shows you how starving people are for sports and specifically for the NFL. So, yes, the start of the upcoming season is in some doubt, I think. But, you know, whether and when it comes back, Amazon knows that it's going to be huge. I think that you can expect the ratings once the NFL does return to be enormous. So Amazon today announcing it has extended its deal for 3 more seasons to stream Thursday night football games to Amazon Prime subscribers. So the previous deal was for 11 of those games. Now, these are Thursday night games that are broadcast on Fox, but are also streamed live on Amazon. What's new in the deal is a 12th game that'll be later in the season and won't be on a Thursday. This will be a Saturday game. And Amazon, as well as Twitch, which is owned by Amazon, will get the exclusive national broadcast. So that game on a Saturday later in the regular season will be shown in the local markets, but not broadcast nationally. It'll be exclusive to Amazon. And the figures here are not being shared, but you can imagine that it's certainly for more money than last time around, which was reported to be $130 million for 2 seasons, so about $65 million per season. Amazon extending for 3 seasons. Now, what's sweet for Amazon, it also gets to sell ads against these streams.
Yeah, Dan, I was just going to talk about those ads. This has got to be welcome news for the advertisers and for Amazon because now they actually have a place to put their message. Do you expect spending there to be robust as these advertisers are just so hungry for a place to advertise at this point?
Well, advertising with sports in general is a really interesting subject right now, Alexis, because obviously there's no sports happening. And so we hear a lot about, you know, the financial damage there's going to be to broadcasters and to media companies. There were reports earlier this week that some cable companies are asking ESPN for their rights fees back because there are no sports being shown. Now we'll see what happens there, because ESPN has a couple of things it can say back to that. I mean, The Last Dance has done very well. There was the draft. But I think with NFL specifically, it's kind of the last gig in town in terms of live TV. That was true before coronavirus. Once we get through this time, I think it'll be even more true. And, remember when the NFL had those 2 seasons in a row of declining ratings? That feels like ancient history. That was 2016 and 2017, because now the last 2 seasons in a row, ratings have risen 5%. So whenever it is that the NFL returns, I do think that advertisers will be happy to spend to advertise there. It's kind of the last remaining guarantee of eyeballs.
Hey, Dan, any sense on how much this deal cost Amazon?
It's not clear, Brian, but as I was saying before, you can bet that it is definitely for significantly more than the last time around. The last time the deal was reported at $65 million per season for Amazon. Now it's for 3 seasons. It's got to be more than that. And I think that in itself is really interesting, because we're in a time when weird timing, no sports happening, and we're waiting for sports to return. But B, there's really no more kind of live television guarantees except for the NFL. I mean, how much have we been talking, and we'll talk again later in this show, about the success that Universal just had with releasing Trolls straight to rental, $100 million in rental sales. Some people are saying that this represents, the end of movie theaters. I think that goes too far. But point being, I don't think anything on television is really a guarantee anymore, except for something like the NFL. I mean, even live awards shows really aren't. People just watch clips the next day on Twitter. And so I think this deal is probably worth a lot to Amazon.
All right, Dan Roberts, good story. Talk to you soon.
Thanks, guys.
And do stick around. We'll have much more on the markets, and we'll take a look at the future of farming in America. Stay tuned. Welcome back to Yahoo Finance Live. I want to get right to Inez Ferre, who's closely watching some companies that are fresh out with earnings this morning. Inez?
That's right, Brian. And taking a look at Boeing, you can see shares of Boeing up more than 3% after Boeing reported an adjusted loss per share of $1.70. That's narrower, though, than what the street had been expecting. It burned through $4.3 billion in cash last quarter. And as the company, of course, is impacted not only by COVID-19, but the ongoing grounding of the 737 MAX jet. It's reducing its aircraft production. And the company also noted that it will reduce staff through a voluntary voluntary layoff program, just to show you a year to date of Boeing down 58% year to date. And then just taking a look at Anthem, up more than 1% after the company reported earnings per share of $6.48 for its latest quarter, beating on revenue helped by the launch of its pharmacy benefits business, IngenioRx. It is sticking to its 2020 profit guidance. And then looking at Humana, up more than 4% after its adjusted earnings per share came in at $5.40 for its latest quarter. The company reaffirming also its 2020 profit guidance. Brian?
Thanks so much, Inez. Now, with so much stress on the U.S. food supply during the COVID-19 pandemic, it's clear the country will have to find new ways to produce food to feed all of us. One company shaking things up in the farming space is Plenty. Matt Barnard is the co-founder and CEO of Plenty, and he joins us now. Matt, thanks for taking some time here this morning. Appreciate it. For people not familiar with what you do, and have you seen a pickup in your business given the current situation we've all been experiencing?
Yeah, thanks for having me, Brian. What we do at Plenty is we have worked to bring the farm inside. And we grow fruits and vegetables inside. We control the recipes we give them. And so what that enables us to do is not only have a very local and resilient food supply chain, but grow food that's better than people are used to eating, and grow fruits and vegetables free of pesticides and chemicals that is both very food safe and lasts a long time in their fridge. So you walk into a Plenty farm and you see plants growing 20 feet in the air, very fast in a thriving, robust environment. So it's a very different farm. It's a new farm, and it's growing plants that people love. So what we've seen during this crisis is we've seen our shipments and production increase about 3x since the virus struck and shelter at home started, and we continue to grow week over week as we work to meet the demands that this crisis is creating.
Matt, I'd like to touch on this paradox that we're seeing. A lot of restaurants now have had to close or just doing takeout. So the demand for a lot of this fresh produce from the commercial end has gone down, hotels as well. Yet you're having a lot of people lining up at food banks. They're running out of food at a time when some of our farmers are very sadly dumping their dairy or having to destroy some crops. How do you think we can sort of reconcile those two, and what might Plenty's position be in that?
Yeah, that is a very tragic situation we're seeing around the country. What you're seeing is the effect of the fact that the household food budget in America pre-COVID was roughly 50-50 between restaurants and the grocery store. And so if someone had a field of fruits and vegetables, highly perishable fruits and vegetables that they were planning to bulk pack and ship to restaurants, those restaurants are now closed or at minimum with significantly lower volume. And so there was nowhere for that produce to go. They didn't have the packing lines or the packages or the people to pack in grocery store packaging. So what you saw is a waste of this highly perishable produce because there wasn't enough time to adjust. That said, farmers are very adaptable and resilient, and I'm sure that adjustments are happening throughout the supply chain right now.
Hey, Matt, it's Heidi Chung here. Question about your employees and the workforce over at Plenty. Can you give us an update on what you've had to do to sort of maintain them and not have to lay them off? As well as, within the food supply, we've seen a lot of companies come out and have to close factories and plants because they have sick employees. Have you guys noticed anything on your end?
So we have been very fortunate to maintain a very healthy team. We did a couple things. First of all, we made sure everybody had everything they needed with respect to personal protective equipment. We did that early. We did it before most, and then we did things like rearrange our shift schedules and the way that we work in the farm to do everything we could to keep people safe. To keep people from having to interact unless it was absolutely necessary, and make sure that everybody can maintain the distancing they need. So we worked very hard to keep our farm and our team in the farm safe. And even gave them have given them both resources and training on what to do once they leave the Plenty farm as well. So far so good. That said, we maintain a high level of vigilance because to the earlier question, what we're seeing is that people now are caring more about how safe their food is. They're caring about whether it's coming from a local and resilient chain. So we are succeeding so far, but being very careful.
Matt, I know that Plenty Food can be found at Whole Foods, Safeway. You had expansion plans prior to the pandemic. What has this crisis done to those plans, and are you hoping to roll out in more stores in the near term?
We are working on an expansion of our presence in one of our national partners that we work with. That said, we'll be announcing that as it comes, but we are working on that as we speak.
Matt, two questions for you here. One, are you still on track to open your next farm in Compton, LA, later this year? And then secondarily, there were some unconfirmed reports that you might be nearing $100 million in new financing. Are you nearing more financing, and do you need it?
We're in a strong financial position, Brian. Thanks for asking. What we're focused now on is meeting this demand. We obviously are taking careful consideration over any financing offers that come in over the transom, and are working to make sure this company is financed so that we can fund our growth, build the company, and serve this very strong demand we're seeing around the country as we work to expand our presence with our commercial partners.
And the farm in LA, is that still on target?
The farm in LA right now, we are working to understand the effects of the supply chain on that farm, but we are working to open that as soon as we can. As you've probably seen with many of the companies you report on, the global supply chain has been rocked over the last month and a half, and so we're working with all of those partners to keep that farm on track as much as we can.
All right, let's leave it there. Matt Barner, co-founder and CEO of Plenty. Very important work you're doing. Good luck on the road ahead.
Thank you. Thank you for having us. I know.
All right. When Warren Buffett talks, we all listen. Our editor-in-chief, Andy Sower, sat down with the Oracle Omaha to ask him for insights on student debt. Take a listen.
Another topic that people are very keen on right now is student debt. And I know that you have really prided yourself on helping students. Is this something that really concerns you?
Well, it would be a tough consideration for me if I were going to school, whether I wanted to not only invest, I'm talking about college, whether I wanted to invest the 4 years. I didn't want to go to college that much when I got out of high school. But not only the 4 years, but if I had to incur hundreds of thousands of dollars in student debt, I don't know which decision I would make. No, higher education is really expensive, and we've helped out many thousands of students, and the Gates Foundation has done the same thing, and other of the foundations that I support. But it's just expensive. It's very expensive.
Is it still worth it?
It depends on the individual. It depends on the individual more than the school. I mean, there's a lot to learn in those 4 years. I mean, there's a lot you can learn in those 4 years, and whether you do or not depends more on the individual. I don't think it makes sense for everybody to go to college. And I'm not so sure it made sense for me to go to college.
Really? Come on.
No, I'm not kidding. I don't know. I mean, I learned a lot by reading, and I spent 3 or 4 years, well, counting graduate school, 4 years. That I could have been doing other things. And there were a lot of intelligent things to do then. Who knows? No, I don't think it was essential. I mean, I had some wonderful people I met through it. Main thing when I went to Columbia, though, with taking Ben Graham's course, I already knew what he was going to say. I mean, I read it. I understood. I mean, he was a very good writer, but it was inspirational. It was inspirational more than it was educational.
And make sure to tune into Yahoo Finance on Saturday, May 2nd. We'll be covering the Berkshire Hathaway annual shareholders meeting live. Check out our exclusive coverage at 4 p.m. Eastern Standard Time. And do stick around. We'll dive into the outlook this summer for summer camps. Stay tuned. Welcome back to Yahoo Finance Live. Now, many kids spend 10 months out of the year waiting for their special 2 months at summer camp. Each year, over 14 million children and adults attend camp in the U.S., both campers and counselors. But this summer may look a little different as summer camps are at odds with the coronavirus pandemic. Joining us now is Timberlake Sleepaway Camp owner Jay Jacobs. Jay, thanks for taking some time this morning. So answer the question on the minds of lots of parents. Will there be summer camp this summer?
I believe there will. And I think we have to wait to see how the numbers keep coming down in terms of new cases, other metrics that they're looking at, hospitalizations, the rest. As this virus seems to recede, we'll know better, and the chances get better as with the numbers getting lower.
So, Jay, I have to imagine you are taking some steps here to social distance if camp were to go forward. I'd imagine it's going to look a lot different than it looked last summer. Talk to us about some of the things that you're implementing, working on the assumption that there will be summer camp.
Well, I think social distancing, as we're practicing it in society today, is not reasonable in the summer camp environment. I mean, I don't think that can be the expectation at the same level, frankly. It's a different type of environment. You've got children at play. You can't socially distance yourself from someone you're playing basketball with. It becomes a little difficult. So we have to have a different strategy. And I know at camp, we're looking at the strategy of testing campers or having campers tested before they come to camp and only accepting campers who test negative, and doing the same thing for staff. So creating, if you will, a protected environment where we can have activities in camp knowing that everybody in camp has been tested and is negative. Of course, you're going to have some people coming in and going out occasionally. We've got to deal with that and figure out ways to ensure that the virus doesn't come into camp. But I'm also hopeful that with the numbers coming way, way down in terms of new cases and total number of active cases in the community areas that the camps are in, or that campers come from or others come from, that we'll be protecting campers pretty well with that in place. In addition to doing some other policy changes like no day trips out of camp, no extended trips for the older campers that we've done in the past, perhaps limiting off time off campus for our staff. Those are all things that are going to be looked at, and depending upon the realities at the time, we're going to have to take the actions necessary to create that protective environment.
Jay, in terms of testing, when you really talk about the logistics, would parents have to get their kids tested independently? Would you be able to provide those tests? And then to go along with that, how might your medical staff on site look different this summer?
Well, in terms of the testing, again, there'll be a lot more information and newer tests available. Every week we see something new. Right now we're looking at a saliva test, which has a 24-hour turnaround and can be administered at home and then sent mailed in a packet to the lab. It's prescribed by our doctor. The information comes directly to our doctor, so we know who's taken the test and what the results are, and we know it directly. And we would envision sending that. This is how our camp would do it. Other camps may have other plans, but we're all talking and trying to coordinate. We would pay for that test. It's expensive. We would send it to parents, and they would then have their children tested, and you'd have to be tested in order to come to camp. So, that's one methodology. Then we're also looking at the Abbott Labs model, which requires an expensive piece of equipment, which we will buy if it's available to us, and we believe it will be, along with a more rapid testing. Those are 5 minutes for a positive and 13 minutes for an absolute negative. And we'll have to have those on hand as well, both for in-camp use and for people who come to the gate and want to come through into camp and be tested. So we're looking at that. We're looking at working with a couple of companies that can bring testing to various sites to help test our staff as they enter camp, because we want to test every member of the staff. So those are some of the models we're looking at, and we see our in-camp health personnel being trained and up to date on the latest equipment. We've already ordered, the necessary personal protective equipment that has been recommended, and we have it in good supply. So that's already headed toward camp, and so we'll be ready for this.
Jay, what's the hit financially here, given all these investments into the camping experience, but also too, if the season is shortened?
Well, let me hit the financial piece of this. I think every camp director, I've spoken to a lot of them, they're not worried about the money of what it's going to cost us extra to run camp. It's important to run camp for us because we believe in it. And frankly, if we don't run camp, we're going to have to take advantage of these federal disaster relief loans that we've already applied for just in case to be able to refund the money we need to camp parents, and we'll move forward. And frankly, I think we'll survive it, all of us. But it won't be pleasant. It won't be pretty. But look, there are people dying. I mean, there's a lot worse out there in society than, me not being able to run my summer camp. So I would just say to you, unfortunately, we would take a full year's hit in this period of time where other businesses are losing months. We lose a year. And that would be unfortunate, but we'll have to survive that. But when it comes to operating, I decided a long time ago, and just about every one of the colleagues I speak to, I think is in agreement. We're going to do what's necessary, spend what we have to get this right. I have campers coming from Florida. I have parents who are really very concerned about putting their children on a commercial flight up to New York at the end of June. So I talked to a charter company, and we can access a 737, the same planes that the major airlines use, high quality aircraft, and we can make that available just to campers who are all tested before they get to the airport. Make sure that every camper that gets on, we'll ask the staff on the plane to also be tested. And then we know for sure that we're able to take children up from Florida, safely. That's going to cost us some money.
Yeah.
But I don't think that's the important part right now.
All right. Well, Jay Jacobs, Timberlake owner, rooting for you this summer camping season. Good luck in the weeks ahead.
Thank you very much. Thanks for having me.
And do stick around. We'll have much more in the markets, but also the state of the box office this summer. Stay tuned. Welcome back to Yahoo Finance Live. Now, Universal Pictures' Trolls World Tour shook up the movie industry when the studio decided to release the highly anticipated movie for rental due to the coronavirus instead of in the theater like originally planned. The film has already racked in nearly $100 million in just 3 weeks. Joining us now to discuss is boxofficeguru.com editor Gitesh Pandya and Yahoo Finance's editor-at-large Dan Roberts is back with us. Gitesh, good to speak with you again. here this morning. Do you think what happened with the Trolls World Tour, is that a blueprint for what we should expect moving forward?
Well, I think that it's sort of an individual situation. I mean, this is a movie that was intended to have a 4,000 screen release, just like any other major animated film. But because of the coronavirus pandemic shutting down theaters, they had to sort of change it on the fly. Most movies were delayed till summer, fall, next year. But with this one, it was a different case where they wanted to put it into homes right away at a premium price, $20 instead of the usual $6 or $7. And so obviously AMC is the major exhibitor who was not happy about this because they want these movies in their theaters right away, not at home. So they've had a lot of drama, Universal and AMC, over the last 24 hours. But I think in the long run, they will kiss and make up. I think that they need each other. They're like peanut butter and jelly. You ever have a peanut butter sandwich? It's disgusting. These two need each other. They will work together, and the other theaters will work together as well. However, I think what you will see is some of the smaller films and sometimes some of the family movies going this route and skipping theatrical in order to minimize risk.
Hey, Gatesh, Dan Roberts here. I agree that Trolls and the success of that rental doesn't necessarily mean, movie theaters are dead. I think people are kind of out over their skis going too far with that analysis.
Right.
Now, that said, while we are still in quarantine, or at least while many states are doing stay-at-home, you wonder what other kinds of movies might come out straight to rental. I know there's one coming that's a Judd Apatow movie, a comedy, and that's going straight to rental. Something like Black Widow, obviously, would do well enough in theaters that they wouldn't want to do that. But do you foresee, especially if this time lasts a few more months, other big movies trying the Trolls route?
Some of them, yes. I think that, and this has already been happening before the theaters shut down, is that you have this dichotomy. You have the division of the major leagues and the minor leagues. So the major league films, superhero movies, action sequels, and so on, they need that big screen experience. But some of the smaller and medium-sized films, some sort of sequels from older brands, which may not sell anymore, the risky ones, I do think that studios will look at some of those players on the bench and say, you know what, this does not need a major league release in theaters. Instead, we'll go straight to streaming. Many of the studios now own their own streaming services or are about to launch them, like HBO Max and Peacock coming up. So they need content for that. And I think it's going to be a case-by-case basis. And we are already seeing some of that with movies that were supposed to come out this spring. Instead of being delayed, they're going to straight to Netflix or Amazon or some other streaming service. And I think that depending on the genre, R-rated comedies, for example, have done very poorly at the box office over the last 2 to 3 years. So it makes sense that some of the ones coming up in that category are going straight to streaming because the studios don't want to risk losing money.
Gatesh, it's kind of ironic, the Academy of Motion Pictures was standing strong saying in order to be eligible to win an Oscar, a film has to be in the theater for so many days. Now they've changed their tune, announcing yesterday that a movie has to be on streaming for a certain amount of time, not in the theaters, in order to be eligible for an Oscar. What is Oscar 2021 going to look like to you?
Well, it will be a little bit different. The Academy, I got the press release yesterday and I was analyzing what exactly they were saying. And it is for 1 year only. It's only for the 2020 calendar year for the ceremony happening next February. And it's mostly because you have a 2, 3, 4 month period where theaters are closed and you can't have these movies qualifying. You have to play in LA County for 1 week straight, at least 3 shows per day in order to qualify for most of the major categories. So that's not possible for a number of films right now. And there's a bottleneck coming up later. So I think, you might see some of those movies that we're going to release and are instead going to streaming have a chance to qualify. Now, it doesn't mean that they'll get Oscar nominations. It still has to be a good movie. And, let's be honest, some movies are garbage and some movies are quite good. So that criteria still matters. But, one thing to add to that is that we have had for decades in this industry the parallel universe of movies opening in theaters and movies going straight to video, VHS, DVD, streaming. So it's just a matter of studios still having that and deciding what goes straight to streaming or onto a home entertainment platform, even if it's premium VOD. It's been happening before, it'll keep happening now. And the thing with Trolls was that it was sort of getting a gift and then having the gift taken back. And you get offended by that, obviously. And the theaters were promised that movie, and instead it went to VOD and some drive-in theaters at the same time. That didn't go over well. But I think in the long term, I don't think it should matter too much.
So, Gatesh, what you're telling us is Sonic the Hedgehog won't be Best Picture, I guess, at the Oscars.
It could be up for Best Picture and Best Director. You know, I'm getting my Blu-ray in the mail pretty soon. I'll watch it soon.
Very quickly, while we have you, I know we have to wrap, but just your take on the success of the various streaming services amid coronavirus. You know, great numbers for Disney Plus, which has all the Star Wars movies, but obviously, the longer this lasts, these services won't be getting new movies.
Right. Well, you know, you have a studio compete at the box office with theaters, but they also compete now on the streaming side. So Disney Plus has done a very good job of getting content that excites people and getting it right away. They have that supply chain of all the big movies, so they have an advantage plus a low price point. So it's a great value for consumers. It's going to be a challenge for Universal and Warner Brothers coming up. And look, you know, with all these movies and people stuck at home watching content, you're going to see more subscribers on these streaming services.
All right, let's leave it there. Gatesh Pandya, box office guru, founder. Yeah, I don't know about Sonic the Hedgehog, but I'm looking forward to watching nonetheless. Good to speak with you again.
Thanks for having me.
All right. Before we let you go here, Alphabet shares are up about 9% here. Pretty good earnings report from them. Also watching Starbucks. Listen, Starbucks on their earnings call last night said China sales at the start of the quarter were down close to 90%. So far in April, sales in China, same-store sales, down 35%. Bottom line there is sales are still down. And I think the big takeaway there is it will take some time for these businesses to improve and regain steam after being closed, not just in China, but also in the US. Starbucks stores will reopening next week. Do stick around, much more ahead on Yahoo Finance Live.
Welcome to Yahoo Finance. I'm Adam Shapiro. It is Wednesday, April 29th. We're watching markets for you right now, and we are in a rally. The Dow is up more than 490 points. S&P 500 is up more than 60 points. NASDAQ is up 250 plus points. Even oil is trading higher. WTI for June delivery, those contracts are up almost 25%. This after news from Gilead, which said in a press release that they are, quote, aware of positive data emerging from the National Institute of Allergy and Infectious Diseases study of their antiviral remdesivir treatment for COVID-19. We're going to be talking about those kinds of things going forward, but we've got some headlines for you. Economic data, GDP in the first quarter, it shrank 4.8%. That was worse than had been expected. 3.5 was the expectation. Mortgage applications, 30-year mortgage applications, the 30-year fixed rate mortgage fell to 3.43%. Applications to purchase a home actually rose in March, but overall they fell 3.3%. Refinancing backed off a bit. Pending home sales in March fell dramatically, 20.8% from February, and they were down year over year, 16.3%. We got earnings from MasterCard. Revenue rose 5% to $4 billion. Yum Brands reported net income fell to $83 million year over year from $262 million. Same-store sales were hurt at Pizza Hut as well as KFC. They fell about 7%. We're going to break down earnings for you in the next 15 minutes. Boeing, GE, Ford, and Alphabet. That's all coming up. After the bell today, we get Facebook, Tesla, and Microsoft. But COVID-19 cases worldwide, roughly 3.1 million. The number of dead worldwide, 218,000 plus. In the United States, we have more than 1 million cases now. The number of dead in the United States is around 59,000. Let's head into earnings, and we want to talk about Boeing first. Boeing lost $641 million in the first quarter and burned through $4.3 billion after a double hit from the grounding of the 737 MAX jet and, of course, COVID-19. That loss amounted to about $1.70 a share. Revenue was down to $16.91 billion, roughly 26% year over year. Boeing also has announced that it is planning to cut 10% of its 160,000 strong workforce through attrition and through retirements. They're still seeking $60 billion, according to the CEO, Dave Calhoun, from the U.S. government. They do not want to give the U.S. Treasury shares. So that is still in the works. Julie?
Well, I'm looking at General Electric, Adam. Those shares right now down about 2%. The company said revenue was down by 8%. Earnings missed estimates, although obviously it's tough for analysts to get their arms around what to estimate for companies right now. And the company took a $1 billion hit to its. Now, interesting here, aviation sales were 13. Power and renewable energy sales were down. However, healthcare sales were up, and that's because GE makes a lot of healthcare equipment, and there's higher demand for that stuff at the moment. All of that said, the company is still considering $2 billion in cost cuts and $3 billion in cash prevention for the full year. So all of that explains why the shares are taking a hit today, Adam.
And let's talk about Ford as well. Total revenue fell in the first quarter, almost 15%. It was down 14.9% to $34.3 billion. But remember, the big COVID-19 shutdowns came in the last 2 weeks of March. Ford lost $632 million in the quarter, and they are predicting that in the second quarter, they'll have a pre-tax loss of $5 billion. CFO Tim Stone said last week that they had $35 billion in cash. They have enough, he said, to get through the entire year if they didn't open up production, but they do plan to open up production at least next week in Europe. They also say that they will use the opening of the European plants slowly as a template for reopening the United States. No dates yet. They've also lined up more credit and sold $8 billion in bonds on April 17th. It's a lot to digest, a lot more earnings coming our way, but to help us understand where we are at this point in earnings season, David Nelson is joining us from Bell Point. He is the chief strategist there. And David, when you look at where we have been and some of the huge components like Boeing and how they're reporting, what would be the headline that you would put to this earnings season?
That we're looking through it at this point. You know, some of the most challenged companies and some of the earnings reports have been pretty draconian, but for the most part, investors look forward, and that's what's happening today. You know, in almost every earnings report, in one way or another, in most cases it was a miss, and they're pulling guidance. So, you know, stocks are a forward-looking mechanism. They're not looking backwards, they're looking forward. And right now we're going to have to look pretty far forward because we're going to have to look all the way to 2021 to get a sense of what earnings, normalized earnings, are going to really look like.
I mean, but isn't the problem, David? Hey, it's Julie here. It's good to see you. I mean, what does normalized earnings even mean anymore? When we hear all these predictions that this disruption is not going to be entirely temporary, that we're going to see a more fundamental change for a lot of businesses. So it's interesting that the market, even if it's looking to 2021, that there's any kind of clarity coming down the pike here. I mean, I guess the question is, do you think that stocks are priced appropriately right now, given all of that?
You know, I think you bring up a great point. I think some stocks probably are not priced properly. I think the toughest to come back from an economic level will be close proximity businesses. And you mentioned some of them, like restaurants. Their business model will clearly have to change. Airlines will clearly have to change. Their business model is not designed to run at 50% capacity. People are going to travel less. So the economy is going to be different on the other side of that. And if you're trying to wade through this, you're going to need to have some balance. You're going to need to have some of those big cap tech names, those fortress-like balance sheets, where you know they're going to make it to the other side. And in fact, they might even pick up some market share, but you have to add some risk on the other side. Just try to avoid some of those really challenged names, like really down the food chain, like a Macy's. It looks attractive at around $6 a share, but mountains of debt, going to have to issue more debt and equity. You know, the name may survive for some of these companies, but the equity may not.
Okay, so David, let's bring in the GDP reading that we got in the first quarter. It's going to be worse, everyone expects, in the second quarter. And yet, we're getting some signs of reopening. Texas, for instance, limited, but it will start reopening in the next 2 days. Do you worry that we may overshoot here and we could test the lows that were set back in, March 23rd?
Yeah, it could happen. I'm not necessarily forecasting that at this point. We might even push sideways. If you maybe a better barometer for the market isn't the S&P 500 or the Dow, it's probably, you know, small cap stocks. They actually got hit the hardest. They were down 43% at the low, and that only took 23 days to happen. And to give you some context, you know, the dot-com bubble was 650 days, and even the financial crisis was 350 days. So markets are looking ahead. The Russell has had a pretty big comeback this week. Maybe it's trying to tell us something, but look at today, I'm underinvested. I don't have a lot in small cap. I am in those fortress-like balance sheet names, but it's not enough today for me.
Hey, David, it's Julia LaRoche. I want to dig in further on this kind of point that you're making here, because look, we had GDP, it came in worse than expected. Yet I was just checking, stocks are up. Is there just a disconnect at this point between the market and the economy? And what does that mean?
It's a great question. And, you know, to some extent, yeah, there's likely some kind of disconnect. It happens from time to time. Maybe we overshot on the downside. You know, the early numbers that we got on the coronavirus were a lot more draconian than how it's, you know, panning out. And I think what the market is reacting to more than anything is the headline that the conversation is changing from just the virus and fighting that and fighting the pandemic to actually reopening the economy. And actually, as little as 3 weeks ago, that was a conversation that wasn't taking place. We had no forecasting ability. Now states, one by one, are doing that. And I think 16 states have already put out a plan.
David, did you hear about the Gilead news, the remdesivir, potentially good news there, and even the FDA in talks with the drug maker to potentially start using the 5-day treatment as a treatment for COVID-19? Wouldn't the market take off if this actually comes to fruition?
I think the market is taking off already. It's really good news. Better news would be a vaccine. I think that's ultimately what we're going to have to come up with. But this, at least from what I've read, as little as I know, this seems very, very effective at treating those who are maybe very challenged if you can get them in the early stages. I come from a nursing family. My brother's a nurse, all his kids are nurses, and they're telling me that they're using drugs there that are actually having some effect at pulling people who have been challenged by this through that. And that's really who we have to protect, those who are medically challenged, because a lot of other people get the disease and it's not as serious.
All right, David, stay there because we want to include you in the next discussion. We've got to talk about Alphabet, Google, as we all refer to them. Tom Forte from D.A. Davidson, senior research analyst, is joining us. And all right, revenue, $41.16 billion. Everybody was expecting, I'm going to use the word calamity when it came to advertising. And while it is falling somewhat, the rates are falling, not as bad as the street expected, right?
So I think when you think about Alphabet or Google's earnings, less bad is the new good in the case of Google. So you had tremendous engagement. They talked about 10x Super Bowl as far as search activity for COVID-19 or the coronavirus outbreak. But the challenge is that they're not able to monetize a lot of that traffic. So when you think about Google and you think about the advertising-based business models versus a lot of the e-commerce-based business models, think Amazon, which have held up amazingly well with physical store closures, I think Google has a lot of challenges. in that 4.7% decrease in GDP.
And yet, Tom, when you listen to the commentary from Ruth Porat yesterday, she seemed to suggest that the worst was in March and that things weren't getting much worse in April. I mean, you hear companies like Expedia, for example, and come out and say that they're only going to be spending $1 billion in ads when they usually spend for $5 billion. It seems like there's a bit of a disconnect on that front. I'm curious what you make of how she framed where the business is and whether you really think that ad revenue is kind of bottomed out.
So I think that we have to put it within the context. So there's a great points on Expedia materially scaling back their ad budget. But if you look at Google, the comments they made was that by the end of March, their advertising revenue was declining at a mid-teens rate, which was remarkable. So especially after a strong January and February. So the relative good news is that the rate of decline slowed in April. Now, it doesn't mean that the rate of decline will continue to slow. So what I'm trying to digest is, with 26 million filing for unemployment over the last 5 weeks, how does that affect the economy going forward? And in particular, how does that affect more economically sensitive revenue like advertising revenue?
David, it's Julie here. I wanted to bring you into this as well because I know you hold Alphabet shares. I wanted to give you the opportunity to ask Tom a question if you like, but also to ask you as a shareholder what you thought of this report and if you found it as reassuring as the market has seemed to.
Tom put it perfectly. It was better than feared for sure. YouTube and cloud revenue stood out. But I know for myself as a shareholder, I can't look at the next quarter. The next quarter doesn't matter to me. It's going to be draconian. These are numbers I've never seen in some of these companies that we're going to have to ratchet back. We just had a GDP print -4. We could be as much as -40 in the next quarter. I've got to look out at least a year for a company like Google. And Tom, I guess my question would be, let's look beyond the next quarter. What does the fourth quarter of this year look like?
Yep. So my general view of earnings for the second, third, and fourth quarter is as follows. The second quarter will be nothing short of awful, especially for those who have more economically sensitive business models. Think of Groupon, which is tied to small businesses, that indicated in the month of April, they were down 70% in the US, 80% in international. So I think the June quarter is going to be nothing short of awful. Now in the September quarter, I think you're going to have hopefully a tale of two halves. The first half of the September quarter, I think, is going to be terrible, but I'm looking for improvement in the second half, and then December to be even better than the second half of September. But all of that hinges on the economy reopening. So Adam made a great point that you're starting to see Texas reopen to some degree. You've seen Georgia, you've seen other states. And I do think that there's reason to be hopeful that things will improve. But I'm still trying to, again, digest what 26 million job losses mean to GDP going forward and what it means to 2021. I agree on looking forward to 2021, but I wonder at how many instances 2021 will be worse than 2019.
Tom, I am curious if we can remove the word draconian and maybe replace it with hope, because we're going to get Amazon earnings tomorrow, as well as Apple. Won't we get some silver linings as to where we're headed, especially with Amazon?
For Amazon, I think Target basically reported Amazon's quarter, at least on the retail side, which is going to be tremendous sales growth, but not great profitability. When you're selling lots of toilet paper, hand sanitizer, essentials, and you're not selling discretionary products, then that is a profit challenge. Now, relative to Target, Amazon will benefit because it operates a marketplace, and more than half of the products they sell are on behalf of other third-party sellers, so their relative profitability should be favorable. For Apple, I actually think there's reason to be optimistic. So they came out in April, so admittedly after the quarter, with a $399 smartphone. Now, historically, they haven't done very well with value-priced products, but I think that the setup for them is quite good. And in the case of Apple, we know from the Channel Advisor data that laptop sales are strong with consumers working remotely and learning remotely. They're talking about reopening their stores, perhaps in May. So I'm a little more optimistic on Apple than Amazon, to the extent that Amazon has such a huge run. And I think everyone's assuming that business is, fantastic for Amazon. And I'm a little worried about the profitability.
I want to ask you a follow-up question about Amazon, Tom, because we just got some news in the past few moments that the administration has added 5 Amazon sites to what it's calling its notorious markets list. It's sites in Canada, Germany, France, India, and the UK. And the concern is over counterfeits and also over transparency of sellers, that it's too easy for third-party sellers to get on the platform without vetting, and then it's unclear to consumers who's selling the stuff that they want to buy. What do you think of that, and how much of a threat is that to Amazon's business?
Sure. So I definitely think counterfeiting is a structural challenge for Amazon. And I know they rely heavily on artificial intelligence to try to limit the counterfeits on it. They also rely on the brands reporting. I think historically Nike's reported to Amazon when they see a lot of counterfeit merchandise being sold on the platform. I do think that one of the downsides of the marketplace model in general is you saw a lot of price gouging on hand sanitizer, on other essentials. And Amazon, to its credit, tried to eliminate a lot of the third-party sellers that were price gouging. Shopify did the same on its platform. But I think those are structural challenges for Amazon and one of the downsides of its marketplace model.
David, I got to imagine you two are watching what we're going to get tomorrow from Amazon and Apple. What are your thoughts as to, or what are you going to zero in on in those reports?
Well, I own both. And I guess, for Amazon, Tom said it. It's had a monster run so far. And that's the biggest challenge with some of those fortress-like names. They held up the best, but they're also the most susceptible to a decline because any disappointment at all would likely be sold into pretty hard. Even a good number may be sold into, given how far it's run.
All right. David Nelson from Bell Point Asset Management, the chief strategist. It's always good to see you. Look forward to seeing you back at our office when that is appropriate. And Tom Forte, same, from D.A. Davidson, senior research analyst. Both of you gentlemen, thank you so much for being here on Yahoo Finance. When we come back,
thank you.
We're going to be talking about steps that our parent company, Verizon, along with the Ford Fund, the Ford Motor Company Fund, what they're doing to help people on the front lines of fighting COVID-19. Rally continues on Wall Street here, Yahoo Finance. Take a look. The Dow is up more than 480 points. S&P 500 up more than 65 points. NASDAQ is higher than 260 points. We're going to keep an eye on that. But something else we're watching. Our parent company, Verizon, along with Ford Motor Company, the Ford Motor Company Fund, taking steps to expand a program to help men and women who are fighting the coronavirus. Joining us now to discuss this is Tammy Irwin, Verizon Business Group CEO, and Mary Culler, who is Ford Motor Company Fund President. Let me start with you, Tammy. Verizon has already reached out to provide food and assistance to folks in New York City. What's the next step? How do we expand this?
Yeah, so this is a program that we've been working on since the beginning of April. We recognized a need with all of the healthcare workers in New York to really find a way to match the healthcare workers' need for food with restaurants' need to maintain an open sign on their door. And so we worked with 7 restaurants in New York, paired them up with 6 hospitals in New York City, and have to date served about 40,000 meals to frontline workers in those hospitals. We expanded it out to EMT workers as well. So really proud to be part of doing a very small part to help these healthcare workers that are giving it themselves so carefully.
Mary, it's Julie here. I wanted to bring you into this. Talk to me about the needs in Detroit that you're seeing right now. How many frontline workers are going to be helped by this program, and how Detroit has been affected overall by this pandemic?
Well, thanks, Julie. So we have really been jumping in right from the start, and obviously meals to healthcare workers became a very important issue right from the beginning. We've already delivered about 8,800 meals to healthcare workers in Detroit. I think what's terrific about this program is that the need is just so extensive that we were already delivering meals to different hospitals in the area. But of course, as the Detroit Exhibit Hall, the TCF Center, then became a place where healthcare workers were congregating and obviously helping patients, we needed more help. And so when Verizon and we started talking about this program that we're doing, it just looked like a terrific fit, and we were really happy to support.
Hey there, it's Julia LaRoche, and thank you both for joining us, and especially talking about these efforts that are so important for our frontline workers. It really makes me think about the role of corporations and also leveraging the talent within those corporations to take on some of these challenges. I was wondering if one of you, maybe Tammy, if you could speak to the importance there.
Yeah, I think it's really critically important as we think about the crisis that we're all living in with the pandemic, that corporations step up and play a really meaningful role in how we help society. As Verizon, we've said we have 4 very important stakeholders: our customers, our employees, our shareholders, and society. And we think about those in balance. And now more than ever, how we show up to really help small businesses, in particular, as we think about the work we've done with Pay It Forward, and then thinking about society and how we put our arms around society globally and give back from a philanthropic standpoint, and then use the connections that we have. Ford has been a great partner for us to think about how do we extend our Feed the Frontlines program to the work that they're already doing in Detroit. I love the creativity of bringing food trucks in, because this allows us to really help those businesses stay in business as well, and allows us to play a really important role as we think about how do we recover post-COVID, and how do we make sure we manage through this COVID period.
Mary, I know the Ford Fund in the past has been involved in initiatives to help with upskilling and reskilling in the labor market. And as you look to even just the state of Michigan itself, we're looking at more than 1 million people who are unemployed. What's the conversation within the company in terms of the kind of initiatives maybe that you can consider as these people look to sort of beyond COVID and these jobs that will become available? Are you thinking in terms of potential initiatives to help these workers have the skills for the demands in the jobs that are going to be in place after?
So the Ford Fund has been working in Detroit for over 20 years. To your point, we've had a lot of extensive programming around worker training. Those programs will continue, and I think obviously the needs will be they'll certainly evolve. Right now, of course, all our efforts have sort of shifted to this crisis, because it's so critical to ensure that not only, as Tammy said, that we help the frontline workers, but that we also ensure that these small businesses survive. What I'm very proud of about Ford is when we jumped in a big way. We did ventilators, we helped with masks, respirators, PPE. But what we're doing at the community level is equally as important, because what you're doing is you're actually helping people who are homeless get food and get shelter. We're a mobility company, and one of the largest things that people have asked us for is transportation. Can you help us transport goods food, people. And so we've literally brought together all of our different fleets that we have, our Lincoln personal driver program. So we're actually delivering food in Lincoln Navigators. And so it's just, everybody has jumped in. But to your point, the long-term issues around worker training are going to continue to be front and center for Ford as they have been for over the last 20 years.
Tammy, I was curious. I know that Verizon has been talking with other businesses in localities to help create programs like this. Can you share with us where we might see expansion of this and with whom?
Yeah, we're certainly exploring with other corporations the opportunity to expand this program because it's been so greatly received from healthcare workers who are saying thank you for something as simple as a meal. So good outreach to this broad audience. If there are corporations out there that want to be part of this program to participate with Verizon or the Ford Fund and what we're doing, please join forces with us because it's a small thing, but it's making a huge difference in that fight for COVID and helping healthcare workers.
And Mary, to kind of piggyback on that, I'm curious about your funding. I mean, we've had a lot of various nonprofits on, and many of them have challenged funding right now because people aren't working, so they're not necessarily donating as much. What is Ford, the Ford Fund's major source of funding, Ford itself? And speaking of challenged businesses, I know you can't speak directly to that, but that's another challenged business. So how is your funding position right now? And are you having to turn more to partners like Verizon than you otherwise would in normal times?
So we learned a lot during the recession. We were one of the only companies in the area that really stepped up and continued to give, obviously at a much reduced rate, but it taught us a lot about how we have to prepare for these kinds of crises. So, we do have reserve funding at the Ford Fund. And so we're using some of that as we fund these programs, because obviously we're looking at the business in its entirety and we're having to make some significant business decisions. But it doesn't stop our commitment in the community. But I love the partnership with Verizon because, as you noted, it really leverages two great companies to do something wonderful to communities. So when they came to us and said, we'd love to do something in Detroit, we really thought this was a perfect program, and it really does leverage our resources so that they go much further. One of the things that's wonderful about the program is that a lot of the healthcare workers have said they rarely get a hot meal. So as Tammy said, what's really fantastic about this food truck program is it's very innovative. I love that our teams were super scrappy and thought of something fun. These are the folks that really need some additional help to keep going and operating, and the medical workers are thrilled that they're going to be able to get a hot meal, which isn't always the case. Even though folks are giving meals, they're usually cold meals. And so this is kind of a fun aspect. But look, we are here to support the community, and we also want to support the philanthropic organizations in our community. And we will do whatever we can to ensure that. And we actually have a matching fund program that Bill Ford himself, our executive chairman, put his own personal funding in. It's a $500,000 match program. And I would really encourage those who are interested in helping our organizations to go on at fordfund.org. And you can see the matching program there. And please give and support the community.
Mary, you had me when you said they were delivering food in Lincoln Navigators. Mary Culler, the Ford Motor Company Fund President, thank you for joining us. Tammy Irwin, Verizon Business Group CEO, good to have you here on Yahoo Finance. I want to remind everybody as we go to break that you need to tune into Yahoo Finance on Saturday, May 2nd. We are covering the Berkshire Hathaway Annual Shareholders Meeting live. You want to check out our exclusive coverage at 4 p.m. Eastern. Welcome back to Yahoo Finance. Taking a look at Boeing shares right now, they are actually trading higher, about 7.5% to the upside. After their earnings report this morning, you know the bad news, they have not yet concluded their deal. They've been requesting $60 billion from the U.S. Treasury, but they don't want to turn over shares of the company to the U.S. Treasury. To help us understand what's happening with Boeing and where it is all headed, we want to invite into the program Jonathan Root, who is Moody's Senior Vice President. I am curious, can Boeing make it without that $60 billion injection from all of us taxpayers?
Sure. Hello, Adam. Boeing can definitely make it without the $60 billion. If you look early on, going back 6 weeks or so ago, it made that request representing the aerospace supplier industry, not only for itself. So it doesn't need the full $60 billion. As the company has said on its earnings call this morning, it's looking at all alternatives. Other companies demonstrated there's market access, in the public markets. And additionally, when we downgraded the company to Baa2 with a negative outlook back in early April, we have assumed or estimated or modeling a cash use this year of about $30 billion, about half of that due to COVID, half due to the MAX grounding.
And speaking of the MAX grounding, Jonathan, where do you think they are in terms of the cultural environment at the company? Have they made the necessary changes there to change the culture? And has this current situation and pandemic, in a way, taken some of the heat off of them in that regard?
So I don't think the heat has come off because of COVID. And, under David Calhoun and the management team, they have a tall task in changing culture. It's a very large organization, 160,000 employees. But early on, the company created this safety board, an independent part of the board, put in some change reporting structures. And look, this is their reputation at stake, and they're going to have to take the steps to overcome these challenges with respect to the MAX. In terms of progress, I think they're very close. The company on its earnings call, which is ongoing now as we're talking, they mentioned they're going to start production in the second quarter. They didn't give a date. And right now, their planning is that they'll be able to deliver an airplane in the third quarter. That could be September 29th or 30th, but they're moving ahead. They've done a lot of work. The process is slowed because of the virus. Regulators, can't move at the same pace that they would without it. But this is a long process, changing culture, but they're going to take the steps needed to have the aircraft return to service and manage the enterprise through a recovery process.
Jonathan, I think all of us would cheer if they start producing aircraft for delivery in the third quarter, but what kind of demand will there be? We're hearing Calhoun say that they don't expect travel to resume or at least return to 2019 levels for perhaps at least 3 years. And then we hear from the airlines, they're going to be much smaller. In fact, they're going to have planes that they may turn back over that they no longer need to lease, or they might sell to somebody. So why is Boeing going to be able to weather that storm?
Well, the industry is going to recover. And the $64,000 question right now is time frame. So there's a lot of stakeholders relating their positions at the moment. The key, Adam, is when is there a vaccine? When is there medicine? So all of us can have comfort in getting on an airplane. And it's not only the airplane trip, but it's the destination. So, the company has announced reduced production rates this morning. In our analysis, we had lowered delivery rates and implicitly production rates. And, they're going to manage around that number. And our expectation, whether it's for Boeing or the airlines, is that these companies will manage their infrastructure, their cost structure, and their operations to the level of demand. Importantly, narrow body deliveries of Boeing have been zero for 14 months now. So they're starting from zero rather than coming down. We know of examples of airlines that will take the airplane, they want the airplane, they've arranged financing, they will pay for it, and they're going to appreciate the economic benefits, the fuel efficiency benefits, emission benefits of having the aircraft lower maintenance. So this is a very difficult period right now. We are all struggling through it in our respective areas of work that we do, but it will an end will come and a recovery will start.
Jonathan, I want to pivot to the airlines, which you mentioned. You said that they will sort of adjust to meet the demand. As we know, there's not much demand right now. So are we going to see all of the airlines survive, even with assistance from the government?
So that's our expectation sitting here today. So if you look at the U.S., focus on the U.S. airlines for the moment, the median rating coming into this was BA1, one notch below investment grade. Wind back to 2008, the median rating was B1 or B2. The balance sheets were in weaker condition. The strategies were different. They were market share strategies at that time. Since 2008, the U.S. industry has consolidated. The focus is earning acceptable returns on capital. You know, what's interesting is the A4A put out the data and showed a trend of it took 7 years for volume to recover from the financial crisis, so 09 to 16. What people haven't focused on is the U.S. airlines were profitable in that period, generating strong operating cash flow and good, if not strong, free cash flow, depending on the airline and their investments. So the airlines today, they are bolstering their liquidity every which way they can. I think the airlines have learned that their costs are more flexible and more variable than they had anticipated going into this. And our expectation is that, you know, they will come through this, and looking ahead, there will be less capital investment, there'll be lower fuel, and, you know, they will be focused on restoring their balance sheet. So sitting here today, that's our expectation.
Okay. Jonathan Root, Moody's Senior Vice President, thank you for being here on Yahoo Finance. When we come back after the commercial break, we've heard about the potential shortages of beef, pork, chicken, but the president has signed an order to keep meat processing plants open. But what does that mean for the men and women who actually work at those plants? Does that mean they can't say, I quit? More after this. Welcome back to Yahoo Finance. On an update with the markets, Dow is up more than 490 points on positive news from Gilead about its antiviral drug remdesivir, but not quite there yet. And even if it were a perfect situation, we have to get to that approval for the drug. And part of the problem is the protein supply of beef, pork, and chicken. Yesterday, President Trump signing an order to keep meat processing plants in the United States open. But what does that truly mean? We want to invite into the program Alexis to help us understand, if you're an employee at these plants, which have been hit hard by the spread of the coronavirus, Can you say I quit? I mean, is that no longer on the table for an employee?
Hi, Adam. No, I think these employees can still make the decision to stay at home. The onus is really on the companies to remain open under this Defense Production Act executive order that was signed by President Trump yesterday, late afternoon, early evening. Now, the act is, usually gives the president really wide-ranging authority for the purposes of national security. But usually it is used to really direct goods that a private company might be making to the priority of the federal government. And also as an incentive, the federal government can use the power of the purse really to offer quality compensation for companies in order to incentivize them to ramp up production. Now, it's not usually used in this capacity to say, hey, company, we want you to keep your doors open. Usually that explanation that I just made there about incentivizing is the path. So whether President Trump is looking to test the breadth of the Defense Production Act, we'll have to see. There is some prior case law suggesting that one of the things that President Trump talked about, but it didn't really make it into the final order, is shielding these meatpacking production facilities from liability. Now, that's not also a traditional use of the act. There is some case law that suggests that there is some protection that can be offered to companies, but usually that's just limited to contractual problems and breaches of contract type cases. It's not as broad as the president, I think, was suggesting that it might be used. But hey, look, we've seen this president test a lot of different laws in the past, and this could maybe prove no exception. Adam?
Alexis, I know the working conditions of these meat processing plants certainly unique to that job or that sector, but I think that this does raise a broader question, which is, if a lot of these employees, as economies reopen, are forced to go back to work and maybe they don't feel comfortable, let's say they do get the virus, are the companies held liable, or is that not the case?
Is your question whether the companies would be held liable if they remain shuttered? Against
if employees are forced to go back, and I put that sort of in quotes,
yeah,
and they're not comfortable, but in fact they do get sick at work, is the company held liable?
So, I don't see any way, at least with prior case law and the way that the Defense Production Act has operated in the past, for it to protect private companies from private lawsuits. Now, certainly the federal government could say, hey, we're not going to come after you. We'll shield you from liability that would come from the federal government. But as for private lawsuits, no, I think that, employees could still sue if they feel like their health was jeopardized by having to go back to work. And certainly there are a number of unions that represent these workers who are sounding the alarm, saying we should not be forced to have our employees go back to work in conditions that they consider unsafe. Now, there is some new guidance as of Sunday from OSHA and from the CDC that is supposedly going to put in place some additional protections for these workers, including those shields that some of us have seen in the grocery store. Also, not having meat production processing facilities have the employees face each other. That is supposed to go away. And also, of course, that 6 feet minimum of social distancing. So there are some parts of this action under the Defense Production Act that are still being worked out. Also, some additional guidance expected from the Labor Department as to this supposed shield from liability.
Alexis, there's going to be a lot more on this issue because a lot of the inspectors are no longer inside those plants to make sure these perhaps new regulations are actually put into place. We will revisit this again as we move down the road. But one thing we're watching is how national chains start to reopen slowly, and Starbucks among them, protecting its workers. Our Julia LaRoche had a chance to sit down with the CEO from Starbucks, Kevin Johnson, and talk about those kinds of issues.
Yeah, we're transitioning from this period that I characterize as mitigate and contain, where we've all been sheltering at home and businesses have been shut down, and that was for good reason. That was, governments, health officials, businesses, citizens all working together to flatten the curve and slow the spread of this virus. And now that we see that curve flattening, we're now transitioning into a phase that I call monitor and adapt. And what we have to monitor is we have to monitor and understand, what's happening with the virus. Until there's a vaccine and treatments, we have to be aware of that. And we have to monitor by city, by community. and then adapt the store formats and the store protocols in an appropriate way. So if we see a community that perhaps has a few more COVID-19 cases and it's concerns about growing, that we don't turn the dial up. We maintain the drive-throughs, we maintain mobile order with contactless pickup, curbside. But in other communities where we see the number of COVID cases continue to decline, we might now open our cafe for limited seating. We might have a to-go model. And so we're going to be in this phase where we're tuning the store protocols and what we offer customers as we monitor the situation community by community. And at the end of the day, what we want to provide is we want to provide safe, familiar, and convenient experiences for our customers.
Yeah, Adam, that's right. Well, you can watch the rest of our conversation on Yahoo Finance Presents. And one thing that was really interesting to me, I went to Starbucks this morning. I used the mobile order and pay, that Starbucks rewards app. And that's how you have to do it right now. If you want to go, you're not swiping your credit card or paying with cash. You're using the app. And in the quarter, they saw their users, their monthly active users rise 15% to 19.4 million. They are helping folks, download the app, teaching them how to use the app. I just think this is going to be so interesting going forward. Kevin Johnson has that deep tech background, the digital flywheel that he often refers to. And what does that mean for the broader restaurant industry in this new environment that we will all be navigating? Adam?
And we're going to watch that. Julia LaRoche, thank you. We're going to be right back after this. Welcome back to Yahoo Finance. When you have the right product mix, there is no need to wander 40 years in the desert looking for sustenance. Mandatory Partners has concluded a $141.5 million first fund raise, and it's focused on health and wellness. To talk about the success of this and where they're heading next, Ellie Rubenstein joins us on their new fund and what you're investing in, and it's wellness and healthcare. Is this correct?
That's correct. Thank you so much for having us this morning.
Good to have you here. So, for instance, one of the brands that you're looking at is Vital Farms. What do they do, and how are we going to take advantage of that?
It's a great question. I have a box here. So one of the things that Vital Farms has done really well is they've nailed the transparency, traceability, and the vitality aspect. And when you go and you open up your carton of eggs, there is actually a way that you can scan a QR code and it takes you to the live feed of your farm. And in this current era, we know that consumers want to know exactly where their food comes from, as well as the health aspects. So we like to say happy chickens make better eggs, which make for happier and healthier people.
Hey, Ellie, it's Julie here. Thanks for joining us. I'm familiar with Vital Farms, actually, although I have to say, when I can, I buy from farms that are local and whatnot. One of the things, though, that characterizes a lot of these health and wellness trends is they do come at a premium. In other words, Vital Farms eggs are more expensive than eggs that are conventionally raised, for example. And so I wonder, in this current environment with economic troubles for a lot of Americans, if you're concerned, not just about that brand, but some of the others you're investing in, if they're going to have to bring prices down in order to keep sales volumes up.
You know, that's a really great question, and one we think a lot about. To answer it, I would say actually the number one purchase behavior when people are buying food, health actually now outweighs both cost and taste. And if you look at some of the recent statistics, 77% of people now that are making consumer purchases actually have personal health as top of mind. When we were investing in Vital Farms, we tried to look at, is it recession proof? We know the eggs can cost 3 to 4 times the amount. And the average customer tends to be more in the millennial age, and they are willing to pay the premium because they believe that they're investing in their self. I think that's a trend that we're going to continue to see, because we're now living in a world where the global healthy food market is $1 trillion industry, and healthy food is sort of where the internet was 20 years ago. So in that sense, it's really become an essential, and you're seeing the adoption and convergence of both consumer health, so the retail and health purchases, as well as healthcare industries and food and ag.
Hey, Ellie, it's Julia LaRoche. I'm actually broadcasting from my kitchen, and I too have Vital Farms in my fridge. I grew up on a farm too, so my question for you is, kind of given this environment, we're talking about supply chains that have been breaking down, this kind of big story going on because of the COVID-19 crisis. And I'm wondering if you think there's going to be a shift toward more local foods, and that's going to be a trend that's going to last longer and be here to stay even as we get through this.
Yeah, another great question. Thank you for also being a supporter of Vital Farms. So when we started our investment thesis, the thing that we were looking at was, we said we want to invest in the health of the food supply chain. And what that means is 4 areas. Number 1 is the primary resource. Number 2 is the processing. Number 3 is the distribution. And number 4 is the consumer brand. And we know that the brand is how you get trust. But in the age of smartphones, anybody can take their phone and would want to see what happens inside of where their food is being made. So what we are seeing is that on average, food today is touched 9 times before it reaches your plate. And I think that the person that figures out how to get food faster, better, cheaper, that is transparent through the entire way, will win. I'm not sure it necessarily has to be local. I think it comes from culture of firms. Vital Farms is at scale. So they're in 9,000 grocery stores. They are predominantly in the grocery store, so not in food service. But what they've been able to do is to figure out, how do you take a network of 400 small family farms so that you keep the families, the farmer income's high, and you can still have the small farms, but they control the entire supply chain of that. And I think that's what you need now, is more nimble, more agile supply chain, and leadership that has the culture that emphasizes the health and safety of workers.
Ellie, I'm no millennial. I actually covered the Alwar issue, 3 decades ago or more. Are millennials going to remain brand loyal going forward? Because a lot of this is dependent on that.
Another great question. So I guess I'm in the millennial category myself. I'm 31. And what was interesting about raising our fund is, while we did well with women, we did extremely well with the next generation. So I'd say in ages of 20 to 40. We actually have 29 investors that wrote their first ever private equity fund check. And what we've seen, both male or female, is they have the ability to influence either families that have operating channels and actually showcase why values investing is important. Values are great, but they have to be able to have the returns that people expect in private equity. So I think that millennials can't just be grouped as a category anymore. I think what they can be grouped at is the influence of multi-generation in reducing the learning curve for other people. And one more thing I'd say on that, if you look in the US now, the 10 leading causes of death, 7 of them are lifestyle related, and the number one in lifestyle is nutrition. And I think that why this trend has gone global, and it's not just a trend, it is here to stay, is that the baby boomers now see that there is a way to maybe increase your immunity and eat healthy, and you are what you eat. So I think it's been a global population shift of focusing on the healthy lifestyle.
On behalf of Gen X, I think we would agree. Ellie Rubenstein, who is the co-founder of Mandatory Partners. Thank you for joining us on Yahoo Finance. More after this.
Thank you very much.
Markets reacting to news from Gilead, and here's Jared Blickery with more on this.
That's right, Adam. We got Gilead up 5%, and Dr. Fauci was just making some comments about it. He said that the data shows remdesivir has a positive effect, actually a clear-cut positive effect, also saying that significant positive effect it has in diminishing recovery time. And he says that the data shows that a drug can block this virus. And we're expecting the drug results to be released later at a White House event. But let's take a look at the general market right now. And by the way, it was the Gilead news earlier this morning at 8:30 a.m. that really rocketed the market higher in the stock futures. So we see the Dow up about 500 plus points here. That's over 2%. NASDAQ is leading here. It's up over 3%. Tech, which had been a laggard for the last few days, is outperforming today. And the S&P 500 is up 2.5%. And let's take a look at some of the sectors that are moving right now. We have energy in the lead. That's up over 5%. And guess what? For the current month of April, it is up over 30%. And we have communication services following that. And to the downside, we have staples in the red. Adam?
And we have more Yahoo Finance for you after this.
You're watching Yahoo Finance Live. I'm Julie Hyman. Thanks for joining us. Stocks are rallying today. The S&P 500 right now up about 2.5%. The Dow up 2.25%. The Nasdaq up by nearly 3.22%. Crude oil is also catching my eye, even after we saw an inventory build in the weekly numbers here in the U.S. So we are seeing crude oil prices spike by about 30% for WTI as we continue to see wild gyrations in the prices there. We got some economic data today. GDP in the first quarter, the first read on that, showing a drop of 4.8%. That was worse than estimated. We're going to dig into that in a bit. Meantime, pending home sales in March fell by nearly 21%. One of the things that is giving some hope to stocks today and investors today, some results from studies of remdesivir, the Gilead medication that is being used experimentally to treat COVID-19. A couple of studies showing some promising results. We will be talking about that a bit more as well. And a lot of earnings reports continue to come out. One of those that's probably influencing the markets the most, Alphabet numbers. Even though earnings and revenue missed estimates, the CFO of the company, Ruth Porat, saying that perhaps things are starting to turn for the better. So that's one of the reasons the NASDAQ is outperforming in today's session. Helping me walk us through all of this over the next hour will be my co-host Adam Shapiro, as well as Melody Hum and Rick Newman of Yahoo Finance. Right now, though, we're going to talk more about those Alphabet earnings with our own Dan Howley. And Dan, it's interesting because on the face of it, the numbers didn't look fantastic, and indeed ad sales not performing well. I guess people are trying to look past it.
Yeah, really, what we saw was, and this is something that Sundar Pichai, the CEO of Alphabet, and Ruth Porat, the CFO, kind of explained as the tale of two quarters. That's what they repeatedly went back to, saying that the beginning of the quarter was really just business as usual. They saw increases year over year that were in line with what they were expecting, strong ad sales, strong performance across its business lines. And then, of course, we saw the lockdown start to clamp down around the world. And that's when kind of the economic devastation that we're starting to see began to seep into the quarter. And so what they're saying is they're starting to see ad sales slow down. Now, they did beat on expectations, though expectations are kind of wildly erratic at this point as a result of the economic issues going on. But they did beat on revenue. And they did say, look, we recognize that there will be issues with ad sales at the moment, but they're hoping that in the future, we will see a improved recovery, something along the lines of what everybody has been hoping for, V-shaped, and then that would allow them to see ad sales return to form. And, anecdotally, they have said that they are cutting back on their own marketing budget. That's according to a report by CNBC, basically saying, look, we need to cut back on hiring at the moment, potentially only use hiring in certain cases, that areas that really need it, but cutting back there and more on CapEx spending just to ensure that they are still nice and on an even keel. But it was an interesting report to hear from them, especially the way to describe it, that tale of two quarters.
Yeah, definitely. Speaking of sort of a tale of two quarters, I wanted to look at another tech company. That's Spotify. The shares are up about 12% right now. And I say tale of two quarters because on the one hand, a lot more people subscribed and got the premium. On the other hand, ad sales not as strong.
Yeah, and that's another issue that we're going to see across the tech industry, especially, we're looking at Facebook earnings, we're looking at Amazon earnings. Amazon, you might not think about them as an ad sales company, but they are increasingly the third largest ad sales company on the web. And so this is something we're going to continue to see, and that's what Spotify is really suffering from. But obviously the improvement in paid subscribers, a big boon for them. And they are seeing the same kind of boost that other streaming services are seeing, the Netflix, the Hulus of the world, just from a music perspective. So they've seen users increase their usage of the platform as lockdowns have been put in place. And I think that's something you can expect to see continuing going forward as we are stuck in these kinds of situations.
Right, most definitely, because people are looking for more ways to entertain themselves. Thank you so much, Dan Howley. Appreciate it. I want to turn now to that economic data that we got. Again, GDP in the first quarter falling by 4.8%. And that's likely not going to be the worst of it, right? Because we are continuing to see economic effects stretch into the second quarter because of coronavirus. We're joined now by Paul Grunwald. He is S&P Global Ratings Global Chief Economist. Paul, it's good to see you again. Thanks for rejoining us. So
good to be back.
What do you make of this number? And what then is your extrapolation for what the economic growth is going to look like for the remainder of the year?
Right. Well, today's Q1 number for the U.S. was a sneak preview in a way. Growth fell by 4.8% annualized. We're looking for something much bigger in Q2. That should be a full quarter effect, 30% annualized decline, maybe more. What was informative today was the composition of the decline. It's very much along the lines we were expecting and very much along the lines of what we've seen already in China. Services took a bigger hit than manufacturers. And then within the consumer sector, the durables took a bigger hit than the non-durables. So all of the effects of social distancing on economic activity we've been following played out. But as I said, this is unfortunately just a sneak preview. We think the numbers are going to get much worse in Q2, not just here in the US, but globally.
Paul, let's look past COVID-19 as we get past, say, even the third quarter. We've larded up on debt. We have huge additions to the Fed's balance sheet. Why is that a potential drag in the future when it really hasn't manifested, or has it, in the past?
Right. Well, first of all, you look at the bond markets, right, and look at what the bond markets pricing debt. The 10-year yield's been around 0.6%. So there's a huge amount of appetite for risk-free debt right now. But you're right. The projections for the increase in debt to GDP here in the U.S. are between 15 and 20 percentage points. The Fed's balance sheet's going to be even higher than the $6 trillion right now. So as we get the recovery, and we will recover when we get the health all clear, I think we're going to need some clarity from the fiscal authorities and the central bank on how they're going to sort of unwind those extraordinary support. But right now, the market seems willing to digest it. But the debt levels were high to start this. They're going even higher as we go through it.
Hey, Paul, Rick Newman here. How high do you think the unemployment rate is going to go? When will it peak? And do you think we'll be feeling better about all this by the end of 2020?
Our U.S. economists see the U.S. Unemployment rate peaking at, I think it's 18 or 19% in May. The quarterly rate's a bit lower than that, but it's going to depend on the this interaction we've been talking about before between these policies to keep the labor market intact, PPP, and other things, and how firms and workers actually respond. That's not going to bounce back to 3.5% anytime soon. 3.5% is where we were when we started this for the unemployment rate. That's going to take several years, but we think the big impact's going to be in Q2. The peak's going to be in the high teens, and then a gradual decline after that. The speed of the recovery is going to really depend on how quickly the health restrictions get taken off and whether or not we get a vaccine. If that happens sooner, we get more of a V shape. If it happens slower, then we get a much more elongated recovery.
Paul, as we mentioned, you're chief global economist there. And so when you look around the globe at the countries that have reopened or are starting to reopen, is there anything that we can glean from what's happened with their economic trajectory, or is it even too soon to tell in, say, a place like China?
Right. We're looking at China. We're looking at South Korea and other places where we've got data. I think, first of all, as I mentioned earlier, the sort of trajectory of the decline is pretty clear. I think our takeaway so far is the rebuild has been slower. The health restrictions have been eased more slowly. The bounce back in productions have been a bit slower than we want. In China in particular, we've seen the big state enterprises and the well-funded firms bounce back quickly, but the more private part of the economy, the equivalent of our SME sector, has been slower to recover. They're still not up to pre-COVID capacity. So again, that suggests that things are going to take a bit longer, and that V scenario we're all hoping for, I think the likelihood of that's probably in the decline.
And so the FOMC statement later today is going to be central to get us through the next couple of quarters. Are you looking for anything specific? Is it on the Main Street lending facility, or something else to help support the economic survival to get to the next steps?
Right. I think the Fed at this point, and we've commented on this in the past, is doing the right thing, making sure that markets are functioning. We've got decent liquidity. We've got decent price discovery. The policy that's really going to set the stage and lay the foundation for the recovery is fiscal. And we've seen that enormous jump in jobless claims in the last 6 weeks. We've got the 26 million jobless claims. It took the global financial crisis 60 weeks to generate that same amount of jobless claims. So it's happening very quickly, but fiscal policy, keeping the labor market together, keeping the SME sector running, that's going to be the foundation for the recovery. So monetary policy is going to keep the financial plumbing moving, but it's going to be fiscal that's key for the recovery.
So, Paul, then the key question is there enough being done on the fiscal side? I mean, just to give an example, we saw today that a group of independent restaurants around the country banded together and is trying now to push for some more aid for that industry because, of course, the PPP loans are tied to hiring people back, which is something that many restaurants don't feel they can do right now. So what, if anything, do you think? I mean, fiscal has limits too, right? Or does it?
Well, the market seems willing to buy risk-free debt right now, so I don't want to say fiscal's limitless. That would be irresponsible, but there does seem to be an appetite for fiscal space. My reading and our reading is the will is there, but the execution's been a bit slow. You're right about the PPP. The loans get turned into grants, right? If they have 75% of the expenditure on payroll, but it seems to us that the funding getting to the most critical part of the SME sector has been slow to materialize. We've seen that big drop in jobs and jobless claims. Just to give you something to compare it with, in Germany, the experts there are forecasting a 0.5 percentage point increase in the unemployment rate, and we're talking in the U.S. about going from 3.5 to something like 18 or 19. So the Europeans seem to be in much better shape in keeping the SME sector going and the labor market together.
Well, let's hoping we learn some lessons from that here in the United
Absolutely.
States. Well, Paul Grunwald is S&P Global Ratings Global Chief Economist. It's good to see you, Paul. Stay well, please.
Likewise, thanks.
Speaking of staying well, we want to turn now to what's happening in the medical community, and in particular, how the medical community is facing the challenge of treating African Americans for COVID-19. We have learned from the numbers that the fatality rate in that community has been higher. We're joined now by Dr. James Hildreth. He is Meharry Medical College CEO and president and infectious disease expert. He is joining us from Nashville. Dr. Hildreth, thank you so much for joining us. This is an issue that we have been highlighting consistently on the program. I guess the big question is what to do about it, because obviously this is something that bedevils the medical community, not just with regards to coronavirus, but more broadly when it comes to healthcare outcomes.
Well, thank you, and I'm happy to join you. In light of the fact that we don't have a vaccine or a drug to treat COVID-19, the best strategy for saving the lives of African Americans and anyone else for that matter is to do our best to keep the virus from infecting those populations in the first place. And that applies to all the vulnerable populations, those in nursing homes, assisted living facilities, prisons. I think you've seen that those facilities have just been ravaged by COVID-19, and the strategy has to be for us to find a way to keep the infections from happening in the first place. And that's the strategy we're trying to employ here at Meharry Medical College for the minority community here.
Doctor, it's Adam Shapiro. What are we learning, though, early in this pandemic about the way the virus attacks people? Is this an issue of densely populated, perhaps less affluent folk being more likely to be exposed? Are there other things we're learning?
Well, you know, I've been studying viruses since 1978, and I think it's fair to say we've not encountered a virus quite like this, just because of the broad range of tissue types in our body it infects. So anyone who has a compromised immune system or their lungs are compromised in any way, they're going to have really poor outcomes. And so we do need to find something that can slow the virus down until we have a vaccine. But it's fair to say that of all the viruses that I'm aware of, that I've studied or been involved with, this one is very different, just in terms of just a huge range of things that it does to the body. It shuts down the kidneys. As you've heard, it's starting to cause blood clots in young people in their 30s and 40s who are dying of strokes. It causes really severe lung disease. And it can also trigger something called a cytokine storm, in which the immune system just gets overexuberant and begins to destroy not just the virus, but the tissues around the virus. So it really is an extraordinary challenge like none we've seen before. But I'm really heartened by the fact that scientists all over the world have focused their attention on it. And so I'm confident that we're going to find some solutions in the coming months.
Dr. Hildreth, one of the potential solutions is remdesivir, the drug made by Gilead. A couple of studies out today show more promising results with regard to that drug. How do you feel about this sort of challenge of accessibility to whether it's treatments or vaccines, particularly in vulnerable communities, given even though this virus is different, as you say, from those we've seen before, certainly there have been accessibility issues with treatments for other viruses and infectious diseases we've seen in the past. How do you think we're rising to that challenge right now?
Well, I'm hoping that as a result of the pandemic and the bright light it's shown on these kinds of problems, there will be a focused national strategy to address it, because you're absolutely right. There is a problem of access to healthcare and to all kinds of services that would lower the disease burden in African American communities. My primary focus for the last 30 plus years has been HIV. And of course, there in the earliest days, African Americans would often come into care later because they didn't have access to health care. And the later you present with a disease, almost any disease, the less chance we have as physicians to restore your health. So access to health care is definitely a problem that needs to be addressed. But take, for example, COVID-19. It spreads in aerosols, it spreads on surfaces. So when people live in multi-generational households where they can't really practice social distancing just because of the crowded nature of the living conditions, the virus is going to spread more quickly. And that might be one of the reasons why in African American communities and disadvantaged communities, the virus is having not just killing more people, but the rate of spread might be higher as well. So it all comes down to a combination of all those things.
Yeah, Dr. Hildreth, Melody Hom here. When you think about our success in identifying that this is the case, how do you anticipate change actually taking effect? Because to your point, you studied similar sort of mistreatment, misperceptions around diagnosing folks with HIV, and then thinking about COVID-19. Are you hopeful that we would be prepared for perhaps the next pandemic, and that there could be equal care, and that the care could actually be catering to living conditions and a lot of the existing factors in society?
I'm hoping that as a result of the pandemic, and we are going to get through it, but I hope as a result of this, some structural changes will be made to make sure that everyone who needs access to health care can have it. But there are other factors that are confounding the effort to make the changes. For example, the Surgeon General wrote that African Americans should step up and do better in terms of promoting their own health. But when you live in a community that doesn't have access to nutritious foods, you live in a food desert, that's a challenge. If you live in a place without sidewalks or parks, it's a challenge. When you don't have equal educational opportunities, that's a challenge, because in some places, your level of attainment in education is a great predictor of your overall health. So there are some structural issues that we need to address as a nation, as a society, that will make us all healthier. And the good news is that would lower the $3.5 trillion we spend on healthcare every year. And maybe some of that could be directed to other things that we need to do as a population. So I'm hopeful, and I see there are some good signs that people are paying attention to these things. And I'm excited that this might be an occasion for real change, where healthcare becomes what it needs to be, which is something that all of us can partake in. But you probably know that healthcare only accounts for a small fraction of our overall health, maybe no more than 15%. Those other things, healthy food, good education, being able to work and have a living wage to take care of your family, all those things weigh into health, as does access to healthcare. And that's what I mean by structural changes that need to happen so that all of us can be healthier as a nation.
One of the other structural changes perhaps that needs to occur is something that you are helping with there by educating the next generation of African American doctors. How are we doing on that front? How are the numbers? Because, of course, one of the things that could help is having African Americans be able to go to a physician who looks like them, who might be more responsive to their concerns.
This is also a tremendous challenge, and one that's deeply personal for me. For example, there are 200,000 dentists in the United States that are licensed to practice. Only 6,000 of them are Black. And here's an extraordinary thing to consider. Of those 6,000 dentists, Meharry Medical College on its own trained 42% of them. That's in spite of the fact that there are 65 schools of dentistry in the United States. So that paints the picture of the challenge we have when one institution could account for, 4 out of 10 of all the Black dentists. The other thing that's striking to think about is when I started medical school in 1982, there were about 550 Black males who matriculated that year. If you fast forward to 2015 or 2016 or so, that number had dropped to 512, despite the fact that there were 25% more seats available. All the other demographic groups had gone up, but African American males had gone down. And that's a challenge because as the country becomes older and, with more people of color, we need more physicians, dentists, PAs, other healthcare professionals who come from the same demographic groups, because the data is very compelling that people have the best outcomes when they're being cared for by someone that they can relate to in terms of culture, ethnicity, and all of that. That is not to say that a white doctor cannot provide great health care to a Black person. That happens every day. But the data seems to suggest that the more minority providers we have, the overall health of the population will be improved by that. So we are doing all that we can at Meharry Medical College, and I know other places are as well, to make sure the pipeline is robust for minorities interested in healthcare. And I think as a result of the pandemic, more young people are getting more interested now in medicine and research, and that makes me feel very excited.
I hope so. And thank you for all the work that you're doing there, Doctor. And thank you for joining us. Dr. James Hildreth is Meharry Medical College CEO and president, and he's an expert on infectious diseases. Thank you again for joining us. Coming up next, there was an election yesterday in Ohio. We're going to talk about how it was conducted and whether it was a success. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. Well, as we have talked about, there was an election in Ohio, and it was conducted not entirely, but largely by mail. Rick Newman is here with us. Rick, how did it go? This was sort of a test case, as it were.
Yeah, so this was originally scheduled for March 17th, which is right around the time that President Trump declared a national emergency and governors started to restrict some activity in states. The Ohio governor, Mike DeWine, was actually one of the more aggressive governors restricting activity. So he postponed this election and said, this is going to be mostly a mail-in election. So everybody had to mail in their vote unless there was some reason you had to vote in person. And he extended it until April 28th. So most of the votes are now counted, and some votes are still out as long as they're postmarked by April 27th and received by May 8th next week. They will count. Joe Biden got 72% of the vote. But I think more important than that is this demonstrates that states can quickly convert over to a mail-in election. One caveat there is it looks like the percentage of people who voted this time around is about half of what it was in 2016. So last presidential cycle, around 3 million people voted in the Ohio primary. This time it looks like it was around 1.5 million. That's not a final tally, but it's probably pretty close. So you can do it by mail, but it could have a big effect on turnout.
I'm curious, when you talk about doing it by mail, have a big effect on turnout, is there a grade for how it worked in Ohio? People saying it's a litmus test for a national, perhaps, election where we all mail in our ballots to our state offices. What do you think?
It looks like it went better than in Wisconsin. For one thing, there was no dispute about whether to have an in-person election or a mail-in election as there was in Wisconsin. I'm not aware of any pronounced irregularities. You know, there are some other states that have been doing mail-in elections for some time. Washington State, for example, is mostly a mail-in election. And I think with regard to turnout, the difference is probably from switching quickly over to a mail-in election, which might leave people who don't know where to get a ballot or how to apply and all of those things, and states that have time to ramp up to it, which Washington State has had, because that's how they've been doing it for a while. So I think that tells you that the longer you have to prepare for a mail-in election and make sure you have the right number of ballots and the procedures are right for how people are going to get mail in those ballots. And by the way, is it a prepaid mail-in ballot, or do you have to come up with the postage yourself? That's a big deal. So you need to work these things out in advance if you want, turnout to be the same as it might be otherwise and things to go smoothly.
And I want to turn to something else related to the presidential election, which is that there is possibly a new candidate. He's not a Democrat. He is, I believe, a libertarian is what he's running as. That's Justin Amash, if I'm saying his name correctly, from Michigan, right, Rick?
Yeah, he used to be a Republican, and he represents a Republican district now. But he was the one, as a Republican, he was the one member of the House who said he did favor impeaching President Trump, and he did vote to impeach President Trump. But he has since left the Republican Party, earning President Trump's personal ire, I might add. So he now says he is forming one of these exploratory committees to pursue a possible run as the Libertarian candidate. So there is a Libertarian Party. Jill Stein was the candidate in 2016. I think it was Gary Johnson all the way back in 2012. And this is a very niche party that isn't going to get a lot of the vote. But in swing states, if you can get some decimal point of a percentage of a vote, and it's a really close vote, you could swing that election in that state from one candidate to another. So some Democrats think Jill Stein got enough of the vote in a few states that she may have robbed Hillary Clinton of victory in 2016. There are people who say, no, that's not the case. So there are concerns Justin Amash could do that to Joe Biden. But I think a lot is uncertain at this point. I don't think it's entirely clear that Biden would be the one who would lose the votes. It's possible Trump could lose some votes to Justin Amash. And of course, he hasn't yet said he's actually running, just that he's thinking about it.
Right, exactly. The exploratory committee language. We'll see if that changes. Thank you, Rick. Well, Berkshire Hathaway is going to be having its annual meeting this weekend. Of course, it will be a virtual one. Our editor-in-chief, Andy Serwer, had the chance to sit down with Warren Buffett. Among other things, they talked about the issue of student debt.
Another topic that people are very keen on right now is student debt. And I know that you have really prided yourself on helping students. Is this something that really concerns you?
Well, it would be a tough consideration for me if I were going to school, whether I wanted to not only invest, I'm talking about college, whether I wanted to invest the 4 years. I didn't want to go to college that much when I got out of high school. But not only the 4 years, but if I had to incur hundreds of thousands of dollars in student debt. I don't know which decision I would make. No, higher education is really expensive, and we've helped out many thousands of students, and the Gates Foundation has done the same thing, and other of the foundations that I support. But it's just expensive. It's very expensive.
Is it still worth it?
It depends on the individual. It depends on the individual more than the school. I mean, there's a lot to learn in those 4 years. I mean, there's a lot you can learn in those 4 years, and whether you do or not depends more on the individual. I don't think it makes sense for everybody to go to college. And I'm not so sure it made sense for me to go to college.
Really? Come on.
No, I'm not kidding. I don't know. I mean, I learned a lot by reading, and I spent 3 or 4 years, well, counting graduate school, 4 years. That I could have been doing other things. And there were a lot of intelligent things to do then. Who knows? No, I don't think it was essential. I mean, I had some wonderful people I met through it. Main thing when I went to Columbia, though, with taking Ben Graham's course, I already knew what he was going to say. I mean, I read it. I understood. I mean, he was a very good writer, but it was inspirational. It was inspirational more than it was educational.
You're watching Yahoo Finance Live. I'm Julie Hyman. Well, the trustees of Social Security and Medicare last week came out with their periodic report that they have on the finances of those two bodies. And they didn't necessarily paint the whole picture because, of course, this was conducted, their report was conducted before we were in the midst of this current pandemic. So what does the real picture look like? We are joined by Kathleen Romick. She is Senior Policy Analyst at the Center on Budget and Policy Priorities, which is a partner of the Funding Our Future campaign. It's a group we feature each week only on Yahoo Finance that advocates for a secure retirement for all Americans. Kathleen, thank you for joining us. So what does the picture look like? I mean, the report concludes that those Social Security and Medicare are going to run out of money going to 2034, 2035. Does what's happening right now sort of bring that date closer?
Yeah, I think it's pretty clear that the coronavirus crisis and the related economic fallout is going to affect Social Security's finances. It's just not clear exactly how much. So we know, of course, that tens of millions of workers have been laid off. And we expect that the unemployment rate is going to remain high throughout this year and throughout next year as well, at the very least. And that's important for Social Security because Social Security is primarily financed through the payroll tax contributions of workers. So as long as workers aren't getting paychecks, then Social Security's financing is going to take a hit. The outstanding questions, of course, are how long this is going to last and how deeply the effects are going to be felt for that period. And so we just don't know that yet. And the trustees simply didn't know enough about what things would look like so close to the date of their report to be able to take that into account.
Hey, Kathleen, Rick Newman here. I have read those reports, and I think we need to talk about Medicare, which is going to have problems, more urgent problems, I think, sooner than Social Security. So the Medicare Trust Fund is supposed to run short of money beginning in 2026, but that was the estimate before, as you're pointing out, before everything that's happening now. And they said under a stressful scenario could start running short of money as soon as 2023. That's only 3 years away. What are we going to do?
Correct. That's much sooner. And the Medicare is financed differently from Social Security. It's a combination of those payroll tax contributions, but also a lot of general revenues and other sources of income. So, and the other difference with Medicare is that, we're going to expect some significant increases in healthcare usage due to coronavirus. And also, as we're seeing in other parts of the healthcare sector, some big decreases in healthcare usage because people are afraid to go to the doctor or because they're not doing non-essential, they're not allowed to have non-essential healthcare. And so, it's just really difficult at this point to understand exactly how the crisis is going to play out for both of these programs, except to say that we know that their finances are going to be worse over the short term. We know, as you said, that it's worse for Medicare than it is for Social Security. And it just remains to be seen how quickly we can contain this virus, first of all. And then second of all, how quickly and effectively we contain the economic damage.
So Kathleen, it's Adam. Let's split this apart and just look at the Social Security part. It doesn't actually run out of money, but it falls short. So before COVID-19, how much do we need to come up with, and how do we do that as a society, as a country?
That's a great question. So yes, the trustees' report tells us that Social Security faces a real but manageable long-term shortfall. As of the date of that report, they were projecting that it's about 1% of gross domestic product. So we can definitely come up with that. That's the long-term shortfall. We either put more money into the system through those payroll tax contributions we were just talking about, or cut benefits, or some combination of those two things. It's doable. And the trustees were projecting that the Social Security Trust Fund, which is sort of like the system's rainy day fund, was going to be depleted in 2035. And so we have some time to figure that out. Of course, the sooner the better. Although naturally we're going to have to wait until this crisis passes to really grapple with that.
Kathleen, do you think this is something Congress can do? Is there enough political will? Because you'd have to raise taxes.
Right. I think exactly. I think that increasing those contributions to the system are inevitably going to be part of this. You just can't. You'd have to cut benefits for people who are nearing retirement in a pretty significant way to make up the difference in what the trustees are already projecting. Not to mention what we're going to be seeing down the road. So I agree, taxes are going to have to be on the table. That's really difficult for many members of Congress. And I think that's probably the number one reason that we haven't seen a political solution to date.
Rick, I think you're okay. Sorry about that. Kathleen Romig, thank you so much. She's a senior policy analyst at the Center on Budget and Policy Priorities. Thank you very much. Appreciate it. Well, coming up next this weekend, if you're looking for something to watch, you'll have a new season of Billions, this Showtime series on your list. We're going to be joined by the series co-creators next. Yep. You're watching Yahoo Finance Live. I'm Julie Hyman. We are watching stocks go up today. The NASDAQ around the highs of the session, and it's leading today. It's about 3.5% after earnings from Alphabet. Well, with all of us stuck home, we have been talking a lot about what we are watching. And this weekend, you will have something new to watch. That's because Showtime's Billions latest season is premiering on Sunday. We are joined now by the series co-creators, Brian Koppelman and David Levine, as well as our Julia LaRoche, who brought us this interview. Gentlemen, thank you so much for joining us. It's good to see you, and I'm looking forward to finding out what Chuck Rhodes and Bobby Axelrod are up to in the latest season. Brian, I'm going to start with you. When did you guys wrap shooting on this season? Was it before all of this was done? And sort of how are you feeling about the new season premiering during this pandemic?
Well, I'm really glad that this season is going to premiere now. You know, we finished 7 episodes and we got to shoot them and edit them and add the music and really finish them the way that the show is always finished. And these 7 episodes are super compelling. I'll say every day, David and I get tweeted at, letters written to us with people really wanting the show. And I know that for me, the fact that, there's been content for me to watch and read and listen to during this has been a really big deal. So the fact that our show can be there for people who are, our fans, like Julia, who's been a friend of the show from the beginning, our fans watch these episodes over and over again, and they obsess about them. This is a perfect time to do that and really engage with the show that way.
Yeah. Hey, guys, thank you so much for joining. And thank you for giving us something to look forward to during this crisis. David, I want to bring you into the conversation, kind of like a creative process here. And for the crisis that we're going through, I know you all have conversations with folks on Wall Street, and I know it's maybe a little early, but how do you think about your own characters during this time and how they might even navigate the crisis? I don't know if that's something y'all are thinking about, but it has crossed my mind. What would Bobby Axelrod do?
Well, it's a great question. We do talk to a lot of people, and we've been watching how certain of these guys have been handling it. We're going to deal with it in some way in the show. We're not going to track it and make it like a forensic look at the pandemic. I think other shows may do that. Our show operates like sort of within the world, in a parallel world, so we have to address it. But our story that we need to play out from the beginning half of the season isn't all about that. And we'll speak to it in certain ways, but we're not going to try to get predictive or anything like that. Axe and these other people will have gotten through it smartly, I imagine.
Real life. Oh, go ahead.
I was just going to say that during the course of this, David and I have gotten texts and emails from plenty of billionaires, and although they're tracking this and following this extra closely and speaking to experts and models, getting modeling work done. On the other hand, they're also still asking me which band they should get to play at their next birthday party. So it's not as though they're particularly positioned to withstand a lot of the things that most of us aren't. And so if you think about the way, billionaires as nation states, particularly these kinds of billionaires as nation states, they are able to mount defenses, not to health, obviously, but to the rest of their lives becoming incredibly affected by this.
Although in real life, when their underlings are smashing cell phones and throwing them out on Lexington Avenue to try and, run away from Preet and his, people, it's one thing. But are you getting any hint of what kind of scams may actually be out there now? Because when you have so much money thrown into a system like is happening now, the bad guys have a heyday, and that's got to be going on.
Well, let me just say, I have a GoFundMe to deal with this problem, and you should just send to me. If we do, Dave, I don't know how you feel about this, but I think any scams that we've identified, I think we're going to hold on to them for a minute so that we can use them on the show.
Yeah, and guys, you were just talking about it. One of the things I love about the show is how you do consult real hedge fund managers, real folks on Wall Street, some of the folks that, I would talk to or know as well. And So I just want to get a sense of, without any spoilers per se, what kind of themes we can expect in season 5, just based on these conversations that you guys have.
Well, without being too specific and tipping things off, we talk to these guys about greed, aggression, responsibility, inequality, all of these issues that people are dealing with. These billionaires just happen to be super influential with it. I'll tell you, as we've spoken to them in the beginning of this pandemic, you don't feel a lot of fear coming out of them. And maybe it's posturing. Maybe there's an awareness that they're talking to the people who make the show, so they don't want to show vulnerability. But, they have a certain swagger to them for the most part, and they're not showing a lot of fear at this. Even if they think the financial side is unfortunate for now, they're always looking for opportunity where other people are suffering.
I mean, it's also, I was speaking yesterday to a billionaire venture capitalist, and he was talking about, I'd say 10 days ago, he started talking to me about the food supply issues that surfaced in the papers yesterday. And I think probably the difference is those people are able to get pallets of, sides of beef sent to them on their own planes in a way that the rest of us can't. But as Dave said, talking thematically, it is true that many of them over the past couple of years have been thinking about how the inequality of the last 4 years, the sort of the way it's become so obvious, they don't necessarily think about it in altruistic terms, but they do think about it in terms of, well, how is the fact of this inequality going to affect me and my business? How is the fact that a lot of the country is realizing the way in which wealth is concentrated? It's not that they're thinking about it from a place of guilt, but they are thinking about it from a place of, well, how do I remediate this so that it doesn't redound back against me? And that's certainly something that we've thought a lot about and talked a lot about in the writer's room and with these billionaires and with the law side and with the people whose job it is to keep them in line and prosecute them and go after the ones who are skirting the law.
Guys, I want to turn to kind of what happens next with Hollywood, with TV, because whether it's Billions or whether it's other projects you guys are working on, when do you think shooting is going to and production is going to open back up? What does a set look like 6 months from now as a result of all of this? David, I'll start with you.
Yeah, this is something that we're dealing with every day. In the writing portion, the writer's room has gone to Zoom meetings and the writing can take place individually. So that's not much of a problem. But obviously shooting this stuff is a very communal effort. And tons of protocols are being developed and talked about right now within the industry about how all of these dozens and hundreds of crew members are going to come together in confined spaces. And even if they can protect themselves with masks and gloves and everything, how these actors can play these scenes in close quarters, effectively, spitting on each other some of the time from a distance of 2 feet. The rapid testing is going to be a huge part of it. And it's something where there are different scenarios at play. Some people being perhaps overly optimistic are talking about midsummer. Other people are talking about early fall. That's certainly what we hope for. And, the idea that we get back in there using as many smart protocols as we can with whatever the latest information in science is.
All right, guys, thank you so much for joining us. We really appreciate it. I'm looking forward to watching on Sunday. Brian Koppelman and David Levine, the co-creators of Billions. Julie LaRoche,
thanks so much.
Thank you, guys.
Well, take care, guys. And speaking of restarting Hollywood, we're going to talk next about what is happening in California in terms of a reopening plan. We'll be right back. Watching Yahoo Finance Live, I'm Julie Hyman. We were just talking about the possibility of Hollywood reopening. Well, yesterday, California Governor Gavin Newsom outlined what it would look like in that state, what his plan is. Melody Hahn is here with us for more on that. So what does the trajectory look like there?
Yeah, and Julie, I have to say, Gavin Newsom actually started and ended his daily press briefing with scolding of folks who have flooded the beaches over the weekend. Of course, this is when it is a curse to actually have good weather. He laid out 4 different phases where, of course, in phase 1, where there's limited availability, most stores are closed, only essential workers are in play. Phase 2, he says, is actually weeks away, when schools will start to reopen, retail stores, to a certain extent, manufacturing plants that are necessary, and public parks and beaches may end up opening over the next few weeks. Phase 3, he says, is a couple months away. That would include hair, nail salons, gyms, and the like, which are very much non-essential businesses to a certain extent. And then phase 4, of course, is the highest risk. That would only be able to happen if there is a vaccine or treatments involved. And that he anticipates could be next year. As we've discussed, it could be 18 months till we see that vaccine, although there is some promising news, of course, out of the likes of Gilead. One thing I want to point out is that Governor Newsom was actually first lauded, right, for his response and his seemingly proactive nature. Over the last couple of weeks, he's actually been facing a lot of criticism because he's saying that we should be prioritizing young, healthy people. There was actually a blurb on the website for the state of California, and that has since been removed. But he specifically was saying that we should be prioritizing our efforts in the hospital system there. Of course, disabled folk and advocates of senior citizens have taken issue with that. But I think overall, as we know, this is a framework and a blueprint, not a finite plan. And all of these phases can go backwards if cases continue to rise.
Right. We will need to stay nimble and flexible for sure. Melody, thank you so much. Stay safe out there in California. And thanks for joining us. And thank you all for joining us for this last hour. Just wanted to bring you up to speed on a couple of items. Gilead shares are up by 8% right now. Melody just mentioned some positive study results out related to that company's drug remdesivir in trials, or should say studies of it treating COVID-19. Stocks overall getting a lift today. Travel stocks are rebounding. We've got the Dow, the S&P, and the NASDAQ all trading higher. Keep it right here on Yahoo Finance.
Welcome into live market coverage here on Yahoo Finance. I'm Zack Guzman, and right now we have stocks surging to session highs. The S&P up by about 3% as the Dow is on pace to wrap up a month of trading in April. It'll be the best April since the 1930s. Still waiting to see whether it'll be 38 or perhaps the best April since earlier in the 30s. We're going to see where we end up. But right now, the market in full-on rally mode, triggered by optimistic news out of Gilead Sciences. That biotech company sharing early results from a U.S. government-backed study looking into its experimental Ebola drug remdesivir, and early results from that indicating that patients are recovering quicker than standard care, suggesting it could become the first effective treatment in the battle for patients facing COVID-19. Dr. Anthony Fauci, of course, the White House advisor on this task force, indicating that he believes it is good news, saying it's a clear-cut positive effect in diminishing the time to recover. The stock market has been rallying off that optimistic update while we're waiting to see the actual results from that National Institute of Allergy and Infectious Disease study. Gilead getting out ahead of those results, those official results, just by a bit, indicating that it does seem to be positive developments on that front. That's giving Gilead shares a boost, but the overall market overall trading higher on that. Also, we got the update on the GDP front this morning. That seems to be a much less important story, at least in the way that we're seeing it impact the market today. Of course, we did get the print, negative 4.8% in Q1 GDP at an annualized rate. That was worse than the 4% that economists had been bracing for. That was the largest contraction, the first contraction, I should say, since 2014, and the largest drop we've seen since the fourth quarter of 2008. But overall, the market clearly trading much more on the optimism out of the Gilead front, potentially a very effective treatment. Right now, we are seeing crude the strongest performer on a sector-by-sector basis. All 11 sectors are in the green, but energy up nearly 6% as we see crude prices rally to above $16 a barrel, nearly 30% in terms of the rally we're seeing in crude prices right now. But I want to start the show, since we do have the Fed announcement coming up at 2 p.m. Eastern time here, with the presser scheduled from Fed Chair Jay Powell coming up a little bit after that. I want to get to Brian Chung for more on the print that we got in terms of Q1 GDP. And Brian, it was not pretty, worse than expected, particularly alarming drops in consumption and the services sector, especially hard hit here. I guess, it wasn't enough to shake the market off the rally we've been seeing here, but clearly pain still to come in Q2 as well.
It's not pretty, Zach, but when we do hear from Chairman Jerome Powell in the press conference again in about an hour and a half, it is expected that he'll try to highlight the U.S. consumer as the main talking point for those GDP numbers. Keep in mind that the U.S. consumer is really the weak point of that report that we saw, and probably will be the weak point of that Q2 number that we'll see in July, which will really show the full impact of this, because Q1 didn't fully reflect the full force of the COVID-19 cases, at least here in the United States. And the reason why I say the U.S. consumer is because, keep in mind, it was the Federal Reserve before the COVID-19 that was saying the U.S. consumer is the bright spot of our economy because it makes up 70%. The consumer confidence, the ability to go out and spend, was really what was driving the longest economic recovery on record until the COVID-19 really took form here in the United States. So Chairman Powell might be using that as kind of the background for why the Federal Reserve could set up the U.S. economy for a recovery at some point down the line when the economy can reopen. But as far as what Chairman Powell will have to focus on for right now, because the future is all speculative, he was probably expected to provide some more color and commentary on the 9 liquidity facilities that the Federal Reserve has opened over the past 7 to 8 weeks or so. Keep in mind, the Fed has tried to use those liquidity facilities as a way to operate as a lender of last resort, with rates already at zero and with quantitative easing effectively uncapped. It seems like those usual things that we pay attention to, these pre-scheduled meetings, is not going to be the case or applicable for this April meeting. One other thing that's worth mentioning is that we won't be getting any economic projections for this meeting. We won't get that until June. So even though Chairman Powell might provide some sort of clarity on what he sees as a forecast going forward, not necessarily the case that we'll have actual numbers to say, here's what the Federal Reserve expects on GDP or for where interest rates go in the future.
Yeah, I mean, not only that, but every time we get an economic update in terms of data here, there is a lag between what we're seeing now, where we're at now, and where we were before. And obviously, when you look at Q1, there's a lot of January and February built into those numbers before we started to see things deteriorate here in March. But one of those is kind of the difficulty of trying to use what we had in Q1 and project forward. We did get the update from Morgan Stanley saying that as bad as Q1 was, brace for worse times in Q2 when we move forward here, projecting a 38% annualized decline for Q2 GDP once we get that. I mean, I guess that will be kind of the difficult part for Jay Powell, is kind of pairing what we got today for Q1 and what he thinks could happen in Q2, and how everything that they're doing at the Fed is trying to blunt the impact of where we could go in the depths of a Q2 slowdown.
Absolutely. And I think one thing that we have to not be surprised about is if Chairman Powell goes up to the virtual podium, because it'll be a teleconference, and says something along the lines of the worst is still yet to come. I mean, yes, negative 4.8%, the first contraction in 6 years, is quite eye-popping. And we've seen all those eye-popping numbers. It's almost desensitizing in the form of those jobless claims numbers every Thursday morning. But we have to remember that in 2008, Q4 came in at 3.8%, negative 3.8%. It was later revised down to 8.9%. The BEA, the Bureau of Economic Analysis, takes multiple looks at GDP. So it's entirely possible that the negative 4.8% figure that we got this morning as a first read is actually a rosier look on what the US economy actually looks like. In the future, they could revise that down quite more, as was the case in Q4 for 2008. So Jay Powell could come out here and say, look, I think the numbers actually are disguising what could be the true depth of the recession that the U.S. likely finds itself in. And keep in mind, the projections on an annualized basis for Q2 are just crazy numbers. Someone, it was actually Barclays chief economist, came on one of our shows earlier this morning and said he expects an annualized 45% decline in GDP for the second quarter. So it seems like that July number is really going to be quite an eye-popping number.
Yeah, they just had to one-up Morgan Stanley's 38% projection by just a bit there. But no, clearly the drop in Q2 is going to be worse than what we're seeing here in today's print in Q1. But for more on that, I want to bring on our next guest, Gennady Goldberg, TD Securities U.S. rate strategist, joins us now. And Gennady, when we look into, I mean, Brian was just highlighting some of the biggest numbers to jump out. And I mean, when you look at it, it is alarming to see consumption down 7.6%, particularly services there, contracting 10.2%. That was the largest decline ever on record. And I do not doubt that we're going to see things decline by an even larger percentage when we get to Q2. So just your thoughts real quick off of what we saw in Q1 and what you see happening potentially here when we get Fed Chair Powell speaking at 2 p.m. and in the press conference thereafter.
Sure. Thanks for having me. So I do think that Chair Powell is going to have to highlight that obviously the worst is yet to come. He's going to have to do that a little more gently. I think this market does need to be treated with kid gloves from now on. But, in a sense, we still have to figure out the extent of the damage, the extent of the rebound, so how quickly we can actually reopen once this is all basically behind us. And that's just what we don't know. And he's going to have to strike that very delicate tone between, hey, we've already done a lot. Let's figure out how much that can work. Let's figure out how to get all the rest of these facilities that we've already announced, as Brian was saying, back into place and make sure that they're actually impacting the economy. At the same time, there's a lot of expectations in the market that maybe the Fed could change the pace of buying of treasuries and mortgage-backed securities. There's a lot of uncertainty, given some of their emergency language, about how that will continue going forward, how long that will last, and really what the impact of that was going to be on the market, especially as we're staring down the barrel, at least in the rates market, of trillions more in supply from the U.S. Treasury.
Yeah, I mean, that's one of the things that we're expected to hear, right? His thoughts on the balance sheet and what they can do there. It's already at a record amount in terms of what that balance sheet looks like right now. But when we look at the interest rate side, not a lot expected there. We're already sitting on the lower bound here. So what is your expectation when we're going to listen to Jay Powell speak at around 2:30 today? What more can he do to kind of reassure markets? It seems like when they came out with all of these lending facilities, it was the bazooka that they had been touting for a while. We saw the rebound since late March. So, I mean, now what really can he do to say, all right, we've done what we can, but we're still here if need be?
Right. And for markets, it's always about what's next and not what's behind us. So absolutely, we're still looking for what else they can do. There's still a few tools in their toolkit. I mean, one of the big tools that they've got is yield curve control. That's something that they have discussed before. Fed Governor Brainerd has actually discussed that previously. They have been discussing average inflation targeting. That's been part of their review that's been scheduled to be finished by the end of June. I suspect, given everything that's happened, they'll be pushed back a little bit as well. he could provide us with a little bit of guidance on that. If he suggests that yield curve control is something that they're really seriously considering, if he suggests that rates are going to be low for years to come, and right now the market's pricing in just really the first rate hike sometime in 2023 or 2024. But if the Fed can really cement those expectations, they can actually bring yields even lower from here. And I think for them, it's a matter of financial stability. How do we get rates low and keep them low when you've got so much supply coming from the US Treasury because tax revenues have plummeted and our spending because of the CARES Act has shot higher?
I'm glad you used the word stability because that's been a concern of a few guests that we've had on the show. And I understand the reasoning that, we're in a shock right now and you need to do everything you can to address that shock and worry about what consequences in terms of your moves might be down the road. You can worry about those later. But an interesting story from Bloomberg today highlighted some of the risks that the Fed's putting on the market when we think about some of the moves that they've put into place. They highlighted one example from an outpatient clinic company, Surgery Partners, of course, backed by Bain Capital. It had a slew of debt problems. They were triple C rated, 8 levels below investment grade. By late March, though, and we saw a lot of the moves the Fed had put into place, the debt on those bonds at Surgery Partners traded down to about 55 cents on the dollar. But then the Fed announced that it's something they've never done before, that they would be buying corporate debt. And then you had the rally in that one example there at Surgery Partners basically came back to trade on par value. So it kind of speaks to this example of you had these companies that were sitting in a perilous position with a lot of debt on their balance sheets. And you look at what the Fed stepped in here. And there is a worry that maybe once this is all said and done, that there would be that moral hazard risk that you had a lot of companies that were not sitting pretty, taking risks that maybe they shouldn't have. Maybe the Fed could be incentivizing those risks as they came in here. So what's the standing risk on that front when you think about the Fed and the actions and again, that record balance sheet in coming in here and saying, it's fine, we'll be there to save you down the road?
Right. I think the risk is that the markets are a little bit too optimistic, that it's going to be a straight line kind of V-shaped recovery, as everyone's talking about. Basically by the end of this year, growth will continue. You won't have any more weakness. We'll all be kind of frolicking in the streets and, everything will be hunky-dory. I just don't think that's quite going to be the case. I think there will be companies that unfortunately, despite all the Fed and government support, don't make it through this crisis. They will either decide not to reopen their doors or will realize that because the rebound is likely to be a little bit more slow, I would say a little slower than expected, that they just don't see the levels of demand that are, really feasible for them. They could just shut their doors. So there will be certainly a fair amount of moral hazard that's come out of this crisis. And I think that's a longer term concern. But unfortunately, just because, if you're in kind of a burning building, you can't worry about potentially, the firefighter providing moral hazards to this market. They're trying to save the house. They're not worried about you relying on them in the future. I think the Fed is basically trying to make sure that everyone who entered this crisis makes it on their way through. And I just don't know if that's going to happen, unfortunately.
Yeah, and maybe it'll be something that Jay Powell will have more to address on the call. But I like the metaphor, and clearly they are doing everything they can right now for those companies impacted here. But Gennady Goldberg, thank you so much for taking the time to chat with us. Appreciate it.
Thanks for having me.
All right. Well, we are, of course, just 3 days away from one of the biggest shareholder meetings out there, Berkshire shareholders meeting, where we will hear from the Oracle of Omaha. But before we get there, our editor-in-chief, Andy Serwer, was able to sit down with Warren Buffett in an exclusive interview to get his thoughts on how humanity has not backed down from challenges in the past and how the progress, he says, has been incredible up until this point and should continue from here. Here's a snippet of their interview on what he had to say.
So how do you assess what's going to happen, and does that change your outlook?
Well, it's going to be terrible, but I've always felt a pandemic would happen at some time. I mean, I've actually used that term, in describing things that can interrupt the progress of not only this country, but the world. It won't stop the progress of the country or the world. I mean, this is a terrible event that's occurring. We don't know how terrible, and it may not turn out to be that big a deal when we get through, but it may turn out to be a very big deal, and we just don't know. And I certainly don't know, and nobody knows. But there will be other things that happen in the world in the next 5, 10, 20 years. That's the way the world works. It's not a totally even course. The progress of mankind has been incredible. and that won't stop. I mean, you flew out here, yesterday or today, and you flew over a country that 250 years ago, there wasn't anything here. That's only 3 of my lifetimes, and there wasn't anything here. And now you've got all these bountiful farms, and you got 260 million vehicles in the country, and you got 80 million owner-occupied homes, and you've got 155 million or whatever it is, million people working, and I mean, it's incredible. I went, when I had a medical check the other day, I went to incredible medical facilities that are just 2 or 3 minutes from here, and that wasn't here. Wasn't even here 100 years ago, and so we keep making progress. We haven't forgotten how to make progress in this country, and we haven't lost interest in making progress, and that will benefit to varying degrees all kinds of people, including around the world. But there will be interruptions, and I don't know when they will occur, and I don't know how deep they will occur. I do know they will occur from time to time, and I also know that we'll come out better on the other end.
Fitting reminder to be optimistic in uncertain times there from Warren Buffett on the day that we do get an optimistic update from Gilead and potentially a drug in the battle against coronavirus. Keep in mind, we are just a few days away from that Berkshire shareholders meeting. We will have exclusive coverage of that meeting and our exclusive coverage with Warren Buffett right here on Yahoo Finance this Saturday, with coverage beginning at 4 p.m. Eastern Time. Be sure to tune into that. All right, we're going to take a quick break. And on the other side, Boeing updating investors after reporting the results from its latest quarter, reporting a second consecutive quarterly loss, layoffs, and the fact that the company burned through $4 billion in cash. So why is that stock trading 12% higher today? We'll discuss that on the other side of the break. Stay with us. Welcome back to live coverage here on Yahoo Finance. We're watching Boeing shares up more than 11% in the afternoon trade after reporting earnings, reporting a second consecutive quarterly loss earlier, as well as the fact that they burned through more than $4 billion in cash, and yet shares are moving higher in the afternoon trade. For more on that, I want to get to Emily McCormick, who's been tracking the moves in Boeing. And Emily, investors at least thinking that maybe they could be in the clear through all of this now.
Well, Zach, this was really a case of Boeing exceeding low consensus expectations heading into this earnings report. So yes, this was a second straight quarterly loss for Boeing and another quarter of negative cash flow, but Wall Street really taking this in stride and saying that it could have been a lot worse. So if we look at those numbers, we had an adjusted loss per share of $1.70, so slightly better than a loss of $1.76 expected. And then revenue of $16.9 billion was just under the $17.01 billion expected. Also want to take a look at operating cash flow, since that is a closely watched measure for Boeing. That was negative $4.3 billion, so steep reversal from what we saw last year. We also saw total free cash flow at negative $4.7 billion, which is bad, but better than the more than $5 billion cash burn that Wall Street was bracing for heading into earnings. We also had the CFO saying on their earnings call earlier today that Boeing would return to generating cash in 2021 after burning record amounts this year. And we did see the stock pop after those comments on the earnings call. And then also we had Boeing CEO David Calhoun talking about the company being smaller, particularly on that commercial aircraft side of the business. And Wall Street also taking that positively as a sign that Boeing is aware of the misalignment between supply and demand, with global air travel being so heavily impacted by the coronavirus pandemic. So to give a little bit more detail on that, we have Boeing saying that they'll be cutting their 787 production to a rate of 7 per month by 2022. We're going to cut that to 10 per month this year. They're also cutting 777 production from the current rate of 5 per month to 3 per month. So again, really trying to pull back the business a bit because of the coronavirus pandemic. They're also planning to cut some of their overall staffing levels. And all of that is enough right now to see a pop in the stock. It's actually the Dow leader today.
Yeah, all that production being trimmed does amount to about a 10% reduction in their workforce by the end of the year. But when you talk about what David Calhoun discussed, it was interesting to hear his thoughts on how the travel industry will eventually recover here, not by any means an overnight recovery, when he says that it's about 2 or 3 years for travel to return to 2019 levels, an additional few years beyond that for the industry to return to the long-term growth trend that they saw before all of this hit. But a big question of how Boeing fits into those recovery plans will be what happens with their 737 MAX model. Of course, that model grounded after 2 deadly crashes. What was the update that Calhoun was able to give on that front, though, as investors continue to try and figure out when that plane might be able to fly again?
So the latest that we have, Zach, is that the 737 MAX regulatory approvals are going to potentially allow for deliveries to resume starting in the third quarter of 2020. Now, the FAA hasn't come out and given the green light to the company yet with its software update, but Boeing is at least providing some semblance of an update today. They also said production of the aircraft will resume at low rates this year in 2020, but they plan to boost this production to 31 per month in 2021. We did have overall production for Boeing halted in March for its Washington facilities. We also had the 737 MAX production actually halted even earlier than that in January. So this really is the linchpin of the growth story for getting this commercial aircraft business back off the ground. It is going to be a multi-year process, but Boeing, for now at least, remains optimistic about the 737 MAX program.
Yeah, and that optimism, as you said, moving shares higher by more than 11% today, perhaps also playing into the overall market rally that we've seen off the optimistic news that we've got on the Gilead front. So all of that playing together for quite the rally in Boeing shares right now. But Emily McCormick, thank you so much for bringing us that. We're going to take a quick break here. On the other side, discussing the reason for optimism out of that Gilead study and what it could mean for the overall recovery and reopening of states across the country. We'll dig into the results of that early trial and discuss how one restaurant chain is navigating all this through closures, keeping their drive-through window open, how that's boosted the progress in recovery at Raising Cane's Chicken Fingers. So the founder and CEO will join us on the other side of this break. Stay with us. Welcome back to live market coverage here on Yahoo Finance. I'm Zack Guzman, and right now we have the S&P 500 hitting session highs up nearly 3% today after Gilead Sciences gave the optimistic update that their Ebola drug remdesivir is proving effective in helping patients battle coronavirus. And we are also getting an update from that trial today from the National Institute of Allergy and Infectious Diseases. Dr. Anthony Fauci coming out and saying that the results were promising and that it could be an effective treatment against COVID-19. For more on that, I want to get to our own Anjali Kamlani with the details of that trial and why everyone's so optimistic about it. Anjali?
Hey, Zach. Yeah, thanks so much. So as we know, there are two reports today from Gilead's trials. One is that company-sponsored one that came out earlier today, which we saw showed some improvement in part of it. So it's basically like a first part of that trial showing some improvement in patients who took the doses, whether it was a 5-day treatment course or a 10-day treatment course. They saw similar results. And so that's going to help inform the next phase of that study. Meanwhile, the NIH study is the one that has a lot more hopes pinned on it because it's a very robust study in the sense that it had a placebo control group to compare with, which is different from the company-sponsored one. And so in this one, they saw that patients were recovering 31% faster than those who were not. So that time is 11 days for patients who were taking remdesivir versus 15 for those who weren't. And then also suggested that those who were on remdesivir were able to survive versus those that weren't. The mortality rate was about 8% versus the group of placebo, which was closer to 12. And so that is showing the promise and you know the hope that we have for some sort of treatment to be out to really instill that confidence for getting back to work and reopening the economy. So as of right now, that's just the basics of the result that we have right now. We're going to be hearing more from Dr. Fauci at that White House press briefing later this evening.
Yeah, and it is interesting since that does contrast with the update that we got out of a Chinese study on the same drug, Gilead's remdesivir, saying basically coming to the result that the drug was not associated with statistically significant clinical benefits. So this would seem to be at odds with that and provide, I guess, you know, it was a larger trial and more reasons to be optimistic that remdesivir is effective, Anjali.
Right, that's correct. So it's important to note that they never fully got through that trial in China, and it was a Chinese study controlled by China. It was just Gilead sending the drug there, but they did say that there were not enough, and that has to do with the fact that China was getting over, you know, the surge of cases, and so once you get over that surge of cases, you're not able to really continue that trial there, Zach.
All right, Anjali Kamlani bringing us the latest on the drug front in regards to patients battling COVID-19. Thank you so much for bringing us that. Meantime, we've been tracking the way that restaurants have been grappling with the shutdown as more states move to reopen their economies. There are a few out there that have been able to keep things going through their drive-through window. And no doubt that Raising Cane's chicken finger joint would fall under that as well. Raising Cane's, with its 500 locations in 28 states across the U.S., employs more than 25,000 employees and impressively has not laid off a single one through all of this. And for more on how that's possible, I want to bring on the CEO and founder of Raising Cane's. Todd Graves joins us right now, along with Yahoo Finance's Heidi Chung. And Todd, I guess, you know, right off the top, we've seen a lot of restaurants tap PPP funds to keep things going. You did not do that. How have you been able to make ends meet here through all this? I know my family has gone through the drive-through at Raising Cane's. Has that been enough to offset the slowdown that you've seen from other parts of the business? What have you been able to do differently?
Yeah, thank goodness it has maintained our business. Now, when we first started off and the stay-at-home mandates began, we lost the out business and the dine-in business. We were down 30. Pretty scary place to be because in our business, as you know, it's we make small margins off large volumes. So we went to work. We said, hey, look, let's create a mantra: no crew member left behind. You know, this is my baby, and I reconstructed the first Raising Cane's. We call it the mothership with my own hands, and it's like my crew's like my family. And so we said, hey, let's do this. Let's all go into this and come out with the same team on the other side. So we got to work really hard to get our sales up. And so through the drive-through, we got quicker and we got more proficient. And we went from 30% to 25 to 20, and now I'm pleased to say that we're actually even with our original forecasted sales. Other restaurants that don't have the drive-through, my heart goes out to them. But thank goodness we've had this, and we haven't had to lay off any crew.
Hey, Todd, it's Heidi Chung here. Thanks again for being with us. Zach mentioned this very briefly in his intro, but a lot of states in which Raising Cane stores are located are either opening up their economies or slowly thinking about opening up their economies. How is Raising Cane sort of navigating that? How do your franchisees and employees feel about opening up stores at this point?
Yeah, you know, it's with Raising Cane's, we're always going to go by our guiding philosophies. And so I think it's really important for our business and other restaurants to go off of what they know they can execute exceptionally well, because this has to do with your own crew and your own customer safety. And so you shouldn't go off of a date, you know, whether the authorities say, you know, on X day you can reopen, and you shouldn't go off of business pressure, because all restaurants have, and all business have that business pressure to get reopened. You should go off to where you can execute an extremely safe way to open your restaurants. And so for Cane's, since our customers can get our chicken fingers through our drive-throughs, we're not going to hurry back. We're gonna after the date it happens, I'm probably thinking a couple of weeks into it, we'll open up each place. Now, I do think by June 1st, you're going to see most restaurants, dine-ins being open and doing that. So I caution these restaurants that are going to open too quickly if they're not ready. So for example, you have to be able to do block scheduling, which means one crew works your day shift, one crew works night shift. If, heaven forbid, one of your crew members end up getting COVID, you need to be able to take that whole shift out and then be able to replace it with your day staff and do that. You got to be able to guide your customers, and we call it guiding. It's really policing, because when people come to restaurants, they want to enjoy themselves. They don't want to think about rules, regulations, so they come in and start stacking up with each other. You have to clearly guide them to say, hey, sir, ma'am, we need to stand 6 feet apart. Your turn to come up in order. Your turn to do this. You know, here's a separate cup for refills. You know, those sort of things. So, so I hope the industry's ready. Look, we do a job in our industry serving a quality product, great food safety, and I think restaurants are now taking it to another level. And then on top of that, customers are going to expect it at a greater level now.
And Todd, I have to ask, because this has been being discussed a lot lately, is just the supply chain concerns within the U.S. food industry right now. You guys obviously sell chicken fingers, so poultry is your main protein there. Can you tell us a little bit about your supply chain? Have you been noticing any disruptions in your supply chain, any distribution concerns there as well?
Yeah, absolutely. It's been a major concern of ours before this even started spreading. It was getting with our supply chain and going with them. And, you know, the restaurant supply chain is an exceptional group. And with us in particular, we do business with 17 different poultry processors, and that's 30 different plants across the United States. So we're able to get our chicken what we need. Our main concerns right now is just getting chicken. It's erratic sales in different markets. So a lot of times when we use a fresh product, so we'll have the hot shot chicken from one market, say from St. Louis, sometimes a week and sometimes on a daily basis. But with the challenge for small restaurant chains, any kind of protein they're getting, if they're going out to just one plant and one supply chain, then if that plant is getting sick, shutting down, their supply chain just stops. It's a real problem.
And Todd, just really quickly, it's my understanding that sales obviously were under a lot of pressure in March, dipping quite a bit. Has the recovery been intact in April? Have you seen a material difference in terms of sales? And how are your finances looking? A lot of other companies have had to draw down on their revolving credit facilities. Do you have enough money right now to weather this pandemic?
Yeah, I mean, we drew on a credit line immediately. We talked to our primary lenders. You know, once again, I'm a large company. I own 500 restaurants personally, and we do about $1.5 billion in sales, and we have 5 primary large banks. So we drew down about $200 million right off the bat, because you can burn cash really quickly when you're down 30%. But as we started growing our sales back, we actually held on to that money. Our banks are good with us holding on to. Right now, we're not hoarding. They're able to give other people their credit lines as well, because you just don't know what can happen right now. We're taking it day by day. But that's just when my heart goes out to these restaurants that don't have that credit line. And so for us, like I said, we went down 30%. Other restaurants without drive-thrus went down 90%. Others closed altogether. There is a light at the end of this tunnel. They're going to be able to reopen their dining rooms. But I saw these groups of restaurateurs across the country get really entrepreneurial And they did things like turn their parking lots into drive-throughs, doing takeout service, practicing safe social distancing, doing family meals. These same restaurants when I talked to originally were down 90%. They're down 50% now. And so throughout April, originally when it came out, everybody stopped. Everybody got really concerned, didn't go to restaurants. Grocery stores got slammed. And then when people started thinking about the safety of restaurants, getting more confidence in restaurants, sales are progressively going up on a weekly basis. And sometimes daily, you can see the trend going up. We can track ours and the sales are going up. Look, the restaurant industry is ready to get back to work and people are ready to go back into restaurants.
Yeah, I mean, it sounds like customers are already, as you said, we're already along for the ride there, going through the drive-through window to maintain picking up food through all this. We know that they've been spending on that as well. But thank you so much for giving us the update there. Happy to hear that you haven't run into as drastic issues as maybe some other restaurants have, and that the supply chain still figured out there. But Todd Graves, Raising Cane's Chicken Fingers founder and CEO, thank you so much for joining us.
Thank you, Zach. Thank you, Heidi.
And our thanks to Heidi. You beat me to it. Our thanks to Heidi Chung for joining us there as well. On the other side of the break, we're going to have an update there as Apple reports earnings tomorrow after the bill. What analysts are bracing for on that front and what you should know right after this. Welcome back to live market coverage here on Yahoo Finance. Right now, stocks are surging after optimism on the drug front out of Gilead, saying that their drug, Ebola drug remdesivir, is proving effective in treating patients with coronavirus. And we're seeing that boost stocks overall. Right now, though, energy, the largest outperformer in terms of a sector-by-sector basis. But of course, this week, all eyes are on the tech sector as large tech companies report earnings. We're going to get Apple tomorrow after the bell. And for more on what we should be expecting from that company, I want to bring on Dan Howley, who has the details of what we should be watching. Howley?
Yeah, a lot is going to go into what Apple saw as far as iPhone sales in the quarter. This is their second quarter report for 2020. Basically, it's going to be apocalyptic, you could say, mostly because Apple had its supply chain shut down effectively when China extended that Lunar New Year and then continued to close factories for a while. That meant that they weren't able to produce products. So that meant an inventory squeeze. And then alongside that, Apple was forced to close stores in mainland China. And then just as they opened their stores in mainland China, they closed all of them throughout the world with the exception of those. And we still don't know when those are going to open up in places like the US and Europe. So a big problem for Apple is going to be how they manage to get iPhones out the door, how many they manage to get out the door. And right now, analysts are predicting $53.2 billion in revenue, versus 58 billion in the same quarter last year. Earnings per share of 223 expected versus 247 in the same quarter last year. Obviously, the expectations could be wildly change throughout the different analysts that you speak to just because of the uncertainty of what's going on here. But what we're going to look at is a potential fall, according to BofA securities analyst Wamsi Mohan, of 32% year over year decline in revenue for iPhone. So that's really going to be an issue. We did, however, see a new iPhone launch in the past month, the 399 SE, and we're expecting the new iPhones to come later in the year, but there have been reports that those may even be delayed by a month. A lot of this says basically that we're going to see everything pushed back as far as the revenue that the company will get from this iPhone, the 5G version, when that eventually comes out. We're still looking at potentially a September launch, but I mean, really, it's going to be a tale of how badly the iPhone sales suffered and how much Apple could have been propped up by accessory sales and services.
Yeah, and exactly how long CEO Tim Cook does see that playing out overall, and we'll get his update and thinking on the earnings call as well. But Dan Howley, thank you so much for bringing us that. All right, we're going to take a quick break here on Wi-Fi PM. On the other side, we'll be chatting more about, we've already covered the way that for-profit companies have been navigating the coronavirus slowdown and how it's impacting nonprofits. The CEO and president of the Make-A-Wish Foundation will join us right after this for more on that. Stay with us. Welcome back to live market coverage here on Yahoo Finance. I'm Zack Guzman, and we've been talking a lot about how for-profit companies have been navigating the coronavirus crisis here as they've seen a turn down in revenues, but nonprofits are also grappling with new issues as well. Today, Make-A-Wish is kicking a year-long campaign to honor the 40th anniversary of the wish that inspired the founding of Make-A-Wish. The organization, of course, grants life-changing wishes for children with critical illnesses worldwide, and they are still doing so despite the coronavirus slowdown. And for more on that, I want to bring on Richard Davis. He is the Make-A-Wish Foundation CEO and president, and he joins us right now. And Richard, thank you so much for taking the time. I imagine that this is probably impacting your guys' operations quite a bit when we're thinking about dealing with children who might have compromised immune systems, but so important to make sure that the work continues here. So how have you been navigating this, and what are you guys launching with this new initiative?
Well, thanks, Zach. We're glad to be part of your story today because we are celebrating our 40th anniversary. It was 40 years ago this very day that we celebrated the first wish of a young man who was 7 years old, afflicted with leukemia, and his wish was to be a trooper, and he wanted to be a state trooper in the state of Arizona. And that wish 40 years ago became what we now know as Make-A-Wish America, which has granted 330,000 wishes in the last 40 years. Today, we celebrate the 40th anniversary. It's not what we thought it would be. We thought this would be the big launch of a remarkable day. We had everybody planned to be at the 2 Disney Worlds and Disneylands to celebrate what was actually the first wish at Disneyland, down Main Street in a fire truck. And so instead today we celebrate from afar and we talk about the importance and the essential nature of a wish. So here we have 5,000 kids right now whose wish just got delayed with an undetermined end date. Now you put yourself in that space and you're anywhere from 3 years old to 18 years old and you've been looking forward to this wish for what could be years, and all of a sudden it's put on hold. We do about 16,000 wishes a year, so about a third of those wishes now have been placed into a holding pattern until which time we know that it's safe for them to travel again. Instead, we're doing fine. We have a number of supporters that have been part of this Make-A-Wish story for 40 years. Our partners, our sponsors are very, very firm in making sure that we don't get harmed during this period of time. So we're doing quite well. I'm very proud of the support that we have. But some of our activation comes through some of our corporate partners, and they're closed. So we're looking at donors and people across the country to step into the void, build a bridge, and help us get to the next 40 years as we continue to grant these wishes to these kids, because each wish is true to them, and each wish inspires a hope for these kids who deserve that opportunity to believe in the future.
And it's very important that work continues here too. But I do like the new push here is that it's not always, you think about celebrities and some of these wishes that might want to do with celebrities, but a lot of them, as you described there, the first one isn't necessarily with people who are that type of person. It could just be, anyone out there doing their part to kind of help out in this as well. And that's kind of what you guys are focusing on here too. I mean, talk to me about how that might be a misconception of how you might think that it's all about that children might want to do it. It might not be.
Thank you for that. First of all, there's a misconception by about 40% of the American people that Make-A-Wish is for dying children. And it's not. It's a institution that creates hope for those kids with critical illnesses, some of which could be fatal. But in every case, the child has the chance to identify what's most important to them. And it could be a place to go, a thing to have, a place to see, a person to meet. And you bring up a great point. We're introducing an idea called messages of hope. And we're asking people all over the country to step in and take a look at how they can send a 60-second message to these children who are waiting, 5,000 now. And they want to know that there are people that surround them that don't have to know them, that believe in their wish, believe in their health, believe in their future, and are happy to share their views of hope and eternal optimism. And so we're getting tens of hundreds, even thousands of wishes now coming through. And the celebrities have been real clutch. We have celebrities who have wishes that in some cases was to go and meet a celebrity on the site of their film or go meet them after a concert. And these celebrities, many of whom don't seek any attribution, continue to come through with these nice messages of hope directly to those children, talking to them saying, not now, but eventually I'll see you soon and we'll celebrate that wish at one time or another. In other cases, some of the wishes need to be expedited because the kids are not healthy. In many cases, the celebrities and very important people step in and provide a different message of hope that is different than the original wish, but nonetheless important because it has to occur in a certain time period, and we can't delay all wishes indefinitely. So we're finding a way to pivot in this point in time. We're very grateful for all those who have supported us, and we're eager to tell our story in an essential way, given that the backdrop right now is focused on things like food insecurity and focus on job protections. We understand that. But as soon as those things are settled, we want people to come right back to the charities like ours, which are essential to the mission of creating hope and giving people something to look forward to at a time like this.
Well, congratulations on working on all this over the last 40 years and still doing it even in uncertain times. Richard Davis, the Make-A-Wish Foundation CEO and President, appreciate you taking the time, sir, to chat.
Thank you, Zack. We appreciate your support. Thanks, everybody.
Of course. Thank you very much. We're going to take a quick break here. On the other side, we are just 10 minutes away from that FOMC decision and the press conference that will follow from Fed Chair Jay Powell. What we'll do to break down what is expected at that press conference and what you should know as we are, again, just a few moments away. Stay with us. We'll dig into that right after this. Welcome back to live market coverage here on Yahoo Finance. I'm Zack Guzman, and right now we have the S&P retreating just a bit off session highs, up by about 2.8%, as we are now just 8 minutes away from the latest FOMC decision and the press conference from Fed Chair Jay Powell, which we will get shortly after that. For more on what we should be expecting, I want to get to our next guest, Greg McBride, Bankrate.com Chief Financial Analyst, joins us again on the show. And Greg, it's good to see you. I mean, right now we're sitting at the zero lower bound here. So on the rate side, not a lot is to be expected there, but still an important update and thinking to be provided here from Chair Powell. So what are you going to be watching for?
Well, you're right, Zach. I mean, the Fed has brought rates down to that near zero level that was so familiar to us after the financial crisis. But what they're doing to keep credit markets functioning properly, all that liquidity they've pumped in, that is the most important thing. So just because they brought rates down, it doesn't mean that the Fed doesn't matter. I would argue that the Fed is more important than ever, because without properly functioning credit markets, there will be no economic recovery. Credit is to a functioning economy what oxygen is to a fire.
And I mean, when we look at the Fed's balance sheet, we've already seen that grow to a record level. It was already pretty bloated, now even more so when you think about all the money that they're putting to work here to keep the market functioning here. Are there any concerns in your mind that we hit that now and when, you know, it could potentially get even bigger, and we think about how much needs to be done here to make sure? I mean, it seems like the way we've seen the market recover that their job might be done, but it's never over if you're Chair Powell.
Yeah, I mean, we are, right now markets are looking forward to the reopening, but the reality of it is we're going to have a lot of economic pain and financial hardship still to come. So it's not like we're going to be out of the woods once the economy gets reopened. And so having the Fed there to provide liquidity, there are going to be a lot of business failures, a lot of consumer bankruptcies. So still going to be a lot of pain left, and to make sure that credit is flowing, credit-worthy consumers, businesses, and even municipalities really going to be critical to the economic recovery. And having that backdrop of low interest rates, I think, is going to be a tailwind that we're going to need to spur consumer and business spending on the other side of this.
Yeah, you mentioned low interest rates. I mean, we were covering that yesterday when we were talking about the way that Americans are continuing to shift into high yield savings accounts. But I mean, low rates does hurt that idea that you would want to be saving here. So what have you seen on that front? Of course, maybe a good thing for people with credit card debt, but what's the thinking on that front?
Yeah, it depends on which side of the fence you're on. For borrowers, it's been good. Credit card rates are at a 3-year low. Home equity lines of credit, the lowest in about 2.5 years. Mortgage rates are near record lows, and refinancing activities off the charts. On the savings side, yes, rates are coming down. Top yielding savings accounts still around 1.5, 1.75. They'll continue to come down, but still a notable advantage relative to just parking it at the nearest bank that may not be paying much of anything.
And real quick, last question. I know, there's a lot of pushback on this front, considering, uncertain times and really throwing everything you can at the fire here. But the Fed has introduced a number of lending facilities here, and a lot of question marks have been raised about whether or not they're going too far. Any fears on your mind about whether or not they have gone too far, potentially incentivizing risk here, and a lot of companies that might have a lot of debt issues and still being kept afloat by low interest rates again, and all the help that's being provided?
Well, if the Fed learned one lesson from the financial crisis in 2008, it's that don't wade into the pool, jump in and make a big splash. And that's exactly what we've seen this time around. And this is unprecedented from an economic standpoint. We basically did a sudden economic stop. So, everything they've done, I think, is really what's needed. And we may still need more coming out of this.
Yeah, really hard to argue against it too, as we saw just from the complete collapse to what could be the strongest April recovery we've seen in the Dow since the 1930s, back in the Depression era, and hopefully avoiding a Great Depression 2.0 here. But Greg McBride, thank you so much for joining us on that front. Appreciate you sharing your thoughts, sir.
Thank you, Zach. Appreciate it.
All right. Well, as I said, we're just a couple minutes away from that FOMC decision and the update we will get from Fed Chair Powell. Keep it right here on Yahoo Finance. We will break that down as stocks have taken a brief pause in terms of where they were trading just a moment ago, almost at 3%, now off down to just 2.7%. No doubt as we await that FOMC decision. We'll take a quick break. Stay with us.
Welcome back into Yahoo Finance's live market coverage. I'm Seana Smith. We have breaking news. The Federal Reserve's decision is imminent. We have Fed Chair Jerome Powell scheduled to speak in roughly 30 minutes from now. We will bring you these headlines as soon as a decision breaks. Now, taking a look at the market ahead of this announcement, we are seeing massive gains across the board. The NASDAQ is the big winner so far today, up just around 3.5%. The S&P and the Dow are also posting solid gains, with the S&P up almost 3% and the Dow up 551 points, so well off of its highs of the day. Sector-wise, we are seeing all 11 of the S&P sectors in the green today, with gains being led by energy and the communication sectors, both of those up more than 5%. We have our Yahoo Finance reporter Brian Chung is standing by, and he has the details now with the Fed's decision. Brian?
Good afternoon, Shauna. The breaking news from the Federal Reserve, it is maintaining its current interest rate target at between 0 and 0.25%. That is the lower bound near zero. The Federal Reserve saying in this statement that it is committed to using its full range of tools to support the U.S. economy in this challenging time. It reworked its statement since the last time it had an FOMC statement that was in the middle of March. It said, quote, the ongoing public health crisis will weigh heavily on economic activity, employment, and inflation in the near term and poses considerable risk to the economic outlook over the medium term, end quote. A few technical things that's worth mentioning. It didn't change its stance on quantitative easing. That is the pace of asset purchases that it's been doing on U.S. Treasuries and then also agency mortgage-backed securities. It said that those purchases will continue, quote, in the amount needed, end quote. Something else that a lot of people were also watching was the minutia on the interest on excess reserves that it pays. There was concern that the actual effective federal funds rate was floating too closely to the bottom of the range. The Federal Reserve saying that it is maintaining the amount that it's paying on excess reserves at 10 basis points. A few other things worth mentioning, the statement was unanimously agreed upon. All the voting members of the FOMC did agree to this statement. But again, the Federal Reserve saying and echoing sentiment from Chairman Jerome Powell in weeks prior and in interviews prior that the Federal Reserve will commit to keeping its target range at near zero until it's, quote, confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. But again, Shauna, the headline for the announcement today that just crossed a minute ago, the Federal Reserve maintaining interest rates at the zero bound.
All right, Brian Chung, thanks so much for that. For more on this, I want to bring in Yahoo Finance's Adam Shapiro. He'll be joined with me for this hour. And we also have Michael Cox, former Federal Reserve Bank of Dallas chief economist. And Adam, let me just start with you. What are your thoughts on what we just heard from Brian? I mean, the big headline there, like he was just saying, that the Fed did not change its stance on QE and will continue to buy treasuries and mortgage-backed securities in the amounts that are needed.
I'll tell you, I spent 25 years at the Fed, but I have to say I haven't always been the biggest Fed advocate. But right now, I believe that the Fed is doing a good job. Quite frankly, I think it's the other things that they do other than lowering interest rates where they're doing a good job, such as the asset purchases and keeping liquidity going. So I've been pretty pleased with the Fed as of late. They learned a lot from the Great Recession, I think.
Yeah, it sounds like they might have done that. Adam, just let me bring you in here and just get your thoughts on what we heard from Brian.
And the technical issues of the era in which we live. You froze on my computer, so I'm going to assume that I'm actually going out to you, Shauna. But I'm curious to see what Jay Powell has to say at the presser later on in regards to what is going on with the other lending facilities. For instance, they've talked about buying municipal bonds. When is that actually going to pick up? Does it need to pick up? Or is the fact that they've just said they're going to do it sufficient? Are they going to actually give us the details of purchasing corporate bonds? Again, or just saying we're there if we're needed? Is that sufficient? Brian would probably have better insight on that. I mean, is just saying they're going to do it enough, Brian?
Well, in terms of whether or not the Federal Reserve's messaging is effective is going to really depend on who you're asking. But the Federal Reserve announcement that just crossed doesn't effectively change anything about the policy stance that they've announced over the previous weeks. When you consider that the Federal Reserve had made these emergency announcements effectively since the first week of March, that by the day seems to have changed, I guess, the toolkit that the Federal Reserve has used. And it's a playbook that many people didn't even anticipate maybe the Fed being as creative as it was in this response. Now, the Federal Reserve is still being watched for a number of other developments down the pike. It's possible the Federal Reserve just wasn't ready to announce those things today. things like details on the Main Street lending facility. This is the Federal Reserve's efforts to try to target businesses that are larger than those small businesses that were targeted under the Paycheck Protection Program, but still too small to actually access capital markets. Now, the Federal Reserve has said it will offer cheap 4-year loans to businesses with under 10,000 employees, but the Federal Reserve has yet to get that facility off the ground. This is despite the fact that the Fed announced that facility a number of weeks ago. So the Fed's still needing to finalize some of those things. So it seems like we should still be watching their day-to-day and any sort of emergency announcements in the future for changes on that front.
Hey, Michael, I want to go back to you just to get your thoughts on what we heard from the Fed and then couple that with the reading that we got out from first quarter GDP this morning. So shrinking at 4.8%. Obviously, this shows really the impact that the consumer is facing at this point. What do you think this means in terms of the potential for the Fed's response going forward here, what we could hear from Jerome Powell during his press conference in just around 25 minutes from now?
Okay, well, I really like what Brian said, especially in terms of the Fed being creative. The Federal Reserve was, as it was originally created, was honestly not created to buy government securities. That all started during the First World War when they were enlisted to buy government bonds that were first created in order to make loans to businesses, which they're finally getting around to doing, and that's called the Real Bills Doctrine. I'm sorry they don't have it in place yet, but I think the market is very encouraged by this, and I think that's what's holding up the market, and they need to make it actually happen. As to the decline in GDP, that turned out to be the 4.8% overall decline, turned out to be exactly where you know it would be, right? In food services, people eating out, entertainment and recreation services, air transportation, new vehicle sales, clothing and footwear, hospital and outpatient services. We were told we can't do those right now. But those declines were partially offset by increases in food consumed at grocery stores, prescription drug, intellectual property. People are watching a lot of movies at home. Things like that in single family structures. Now, keep in mind, we had one good month in the first quarter. So it was really in February when stuff sort of hit the fan. And so, unless we get unless we get back on track here, the next quarter is not going to look as good as this one. Spending is down by 7.6%, but income actually grew 1.9%. However, what you can expect here is the multiplier effect is already starting to kind of set in. We don't eat out at the grocery store. We don't eat out at restaurants, so they don't have the money to go, say, pay the rent. So the landlords don't have the money to buy what they might have been, to pay for their insurance for their car. And multiplier effects are going to be catching up with this pretty soon if we don't get
Michael,
restarted.
So let me interrupt, and I think it's appropriate that behind you I see the book, The Rise and Fall of Great Powers, because this multiplier effect that you talk about, let's give a real world example. People are not paying their rents, whether they're small businesses or residential renters. That means landlords or corporate landlords are going to have trouble making their interest payments. And then you've got this kind of magnification through the bond market. So are we going to see the Fed have to ramp up even more these lending facilities that it's created?
We probably will, but that's not going to be the way to get out of this. The way to get out of this is simply to get back to work. Frankly, I think it's going to take two things to get the economy going again. It's going to take some biological or medical fix, big time fix, such as a vaccine, or such as some way of treating people who are sick, or such as herd immunity, or even if we all had really good masks and just could go sit next to each other. Something like that's going to have to happen. Because things will continue to get worse as long as people told you can't go back to work. No, you can't consume in the ways you used to consume. But what I'm saying is that Fed policy is not the policy we needed in this case, as much as medical policy is.
All right, Michael Cox, a former Federal Reserve Bank of Dallas chief economist. Thanks so much for taking the time to join us this afternoon. I want to get zero in on the market's reaction to all this. As it stands right now, we were seeing solid gains across the board before we had this decision announced. Right now, the Dow up just around 483 points, so well off of its highs of the day. S&P and NASDAQ also holding on to gains. For more this, I want to bring in Hank's Haverford Trust Company. And Hank, just what is your reaction to what we heard from the Fed today?
Yeah, look, I don't think there was any surprise in the Fed statement. Keeping rates low for an extended period of time, all tools on the table, no surprise there. And I think the market is selling off a little bit, but I don't think it really has anything to do with the Fed statement.
Hey, it's Adam. I'm curious, what we just heard from the former economist from the Dallas Federal Reserve Bank, when you look at how markets are reacting and all of this liquidity is in place, there have been guests on Yahoo Finance who've said it's very possible, despite all of the headlines, we could still test the March 23rd lows because we're nowhere near out of the woods yet. And it's not the Fed's job to get us out of the woods, it's the Fed's job to keep the pipes open. So where do you see this headed?
Yeah, so that's an interesting point. We have never had a 4-week bear market associated with a recession, and so far that's what we've had: a 4-week bear market followed by a 4-week bull market, with the stock market in this epic titanic battle. On the one side, we're about to see the greatest quarterly contraction of GDP growth in the country's history, and on the other side, the greatest policy response, monetary and fiscal, amounting to 18 to 20% of GDP. And the stock market is caught in the middle of this. So consistent with all other bear markets, it is very likely that we're going to have a retest. It doesn't mean we're going to get right down to the March 23rd low, but we're going to have a downdraft from these levels at some point in the not too distant future, because as you said, we have weeks, if not months, of negative headlines to deal with.
Hank, how big of a pullback do you think we could see then?
Well, I don't think we're going to actually go down to the March 23rd lows, simply because of the enormity of the monetary response here. And as the previous guest pointed out, the correct monetary response. And they did it in lightning speed in 2 or 3 weeks, and in a magnitude 5, 6, 7 times greater than what they did in 2008. And so that is a solid backstop, but you could easily see a 20% move down from these levels.
Hank, it's Adam again, and I'm focusing on equities, but as we watch this earnings season, as we see some companies cutting dividends, they're suspending those payments right now, is it making the job of chief investment officers and other analysts that much more difficult, or are we going to get a purer market as a result of this, because we won't have the stock buybacks to kind of cloud what's actually happening?
Well, we're a quality manager that focuses only on dividend-paying companies. I never thought in my 30-year career with Haverford Trust that we would have to do a stress test on all of our companies in terms of the viability of them continuing to pay a dividend, but that's exactly what we did several weeks ago. And it's going to reveal the truly strong companies and high quality companies, but also companies whose earnings are can hold up in this type of environment. And this is an extraordinarily unique environment because we've never had a government mandated shutdown of 30% of the economy.
I'm just curious, those stress tests, can you share with us some of the results, some of the companies that might have hit it out of the ballpark by your tests?
Well, we've had 2 companies during this crisis increase their dividend, Johnson & Johnson and Dollar General, 2 clear beneficiaries of this challenging environment. And one company that we have owned and we like very much did suspend their dividend, and that was TJ Maxx, a best-in-class retailer that has decided to conserve cash. I think that was the correct move. And when the economy begins the normalization process, we think TJ Maxx will be a huge beneficiary of the destruction in the retail sector.
All right, Hank Smith of Haverford Trust, thanks so much for joining us this afternoon. We want to stick with the Fed's decision here and the economic impact that it could have down the road. And for that, I want to bring in Stephen Skanke's Kill Point Chief Economic Advisor there. And Stephen, just what did, when we take a look at what the Fed announced today, one of the things that we haven't really addressed yet is just the Fed's ballooning balance sheet at $6.6 trillion as of last Wednesday. What do you think that means? What are the broader implications of that for the U.S. economy?
It's hard to know the answer to that, Seana, because it's never been done before. I agree that all the things that they've done are the right things to do. They announced these 11 emergency facilities. They've only started down the path with a few of those. So where it goes ultimately is a little bit hard to know. Clearly, it has an impact on their effectiveness over time. Diminishing returns sets in the more they grow this and the more they venture off into different asset areas with their bond buying program. Ultimately, we know that there will be a price to pay on the inflation side of things, especially when the velocity of money comes back to a more normal time when consumer confidence returns and folks settle down and stop holding all the cash that has been built up offline.
Hey, Steve, it's Adam Shapiro. Good to see you. I can't believe I'm about to say it, but I would actually welcome some inflation. I think that the things that some of us have covered and that you've made you've done this from the White House and from Capitol Hill for decades. You see the picture much differently than the rest of us. And how do we get inflation back? It seems like the Fed is fighting a disinflation and a fear of something worse than inflation, the opposite.
And that's been a big fear that they've had because, as you know, you can't. Stopping a disinflation is very hard. There's the theoretical monetary economics issues of basically pushing a rope in the so-called liquidity trap. And the Fed is very fearful of that. And so they acted proactively, preemptively to get out in front to let everyone know that binding in credit markets wasn't going to be something that they were going to allow to have happen, and that there would be plenty of liquidity so that the expected economic consequences that have been reported today and right along were not going to be exacerbated by limitations in liquidity and credit. But sure, when consumer confidence comes back and spending does return, and I think too, when things settle down and we see business investment come back into play, and there's a lot of deferred business investment that needs to be made, that the demand for these goods and services will find some bottlenecks in the economy, and we will see some inflation as a result of those bottlenecks. And we'll also see some inflation, price inflation, as the production supply chain part of the global economy keep up fully and efficiently with what will be the demand for those in rebuilding companies' capital balance sheet and consumers coming back into the marketplace too.
That on top of the fact that I think we're all counting on Congress and the administration an additional, I'm going to say $1 trillion, maybe even more in fiscal stimulus as we go forward. But then you get statements from Treasury about this issue of not bailing out states, not bailing out municipalities, which might have mismanaged their funds. And you have the Fed, essentially, they haven't done it yet, but prepared to buy up muni bonds to do exactly that. It's kind of like pointing a gun at yourself and saying, I'm going to shoot myself if you don't do what I say.
Well, what's interesting about this, Adam, is that the Fed probably sees this more clearly than anyone, and not that people in the White House and Capitol Hill can't see it clearly, but what they see then gets clouded and colored by the political dimension of it. So all of a sudden, the need to do something for state governments in particular, who actually stand behind county and municipalities, just becomes a political issue. And you've seen that with some of the discussion that's just arisen in the last couple of days. But the Fed doesn't have to look at that. they can see the damage that state financial stress has on just managing the crisis and providing essential services. So they're ready to step into that. The other thing that's really difficult is the lag time that we get on Congress passing the CARES Act and something really happening. We've all seen it in just the delay in checks and the paycheck protection and how that's worked. Even as remarkably quickly as that has been implemented, still more than 50% of the money appropriated in the CARES Act is not in the hands of the intended recipients. So it's a little bit hard to gauge how all that works and where the friction is, especially as it trickles into the credit markets. But the Fed can move on that almost instantaneously with the way it operates through banks or the way it leverages different relationships in these 11 emergency facilities that it's set up, even though not all of them have been implemented yet.
All right, yep, that's something we will, of course, continue to watch here. Stephen Skanke, Keel Point Chief Economic Advisor. Thanks so much for taking the time to join the show this afternoon. I want to get over to Jared Blickery. And Jared, I know that you're closely watching the market's reaction to the Fed decision. As it stands now, we are off the highs of the day. S&P up just around 2.5%.
Yeah, that's right, Shauna. As the Dow is up about 548 points right now. NASDAQ up, leading now, up over 3.25%, and the S&P 500 up 2.6%. Here's the intraday price action, and we can see this is what happened around the Fed announcement right there, and it's hard to see because it's not a lot of action. We were off the highs already, but everybody's waiting for that Jerome Powell presser. I want to draw attention to the fact that the S&P 500 is in a critical area right now where a lot of traders are getting interested in shorting it. That would be between 2,900 and 3,000, roughly in there. When you consider this and the fireworks that we sometimes see from the Powell presser, could see some action over the next days that either validates this or pushes the market really strongly through that section. So here are the sectors. Energy is leading, up over 5%, and it's up over 31% for the month, best month ever. We have communication services, that's up over 5% on the back of Alphabet earnings yesterday, and then technology, which is once again outperforming today, up 3.5% after being an underperformer for several days. Shauna.
All right, Jared Blickery, thanks so much for breaking that down for us. For more on the Fed's decision, I want to bring in Kathy Zhang, Purdue University Associate Professor of Economics. And Kathy, I was reading through some of your notes. It was interesting because one of the things that you were focusing on is the importance of the communication from the Fed at this press conference and what they're exactly going to at a time like this. From what you know and from what you expect to hear from Jerome Powell, what do you think is the most important thing that should at least be communicated?
So one thing we learned from the last recession was just how important central bank communication is. So basically what I have in mind is some kind of forward guidance. So as you mentioned before, the Fed has cut rates to nearly zero, and there's only so much further they can go. There's been some debate on whether it's possible or a good idea to implement negative interest rates, but I never expected, and I don't expect Chairman Powell to commit to negative rates at all. What I do expect is some kind of communication and guidance on how long the Fed is going to hold interest rates at zero. So this is really important for setting market expectations and guiding the amount of uncertainty in the economy. So I think it's especially important amidst all this pandemic-related issues is to be very clear about on what the Fed's commitment is on maintaining low rates.
Kathy, Fed speak, doubt he will give us a direct answer to that kind of question, although I think you're right on target with what people are going to looking for. Mm-hmm. But with unemployment projected to be possibly at the end of this year still around 10%, how did the Fed doesn't have much room just yet because part of the mandate is full employment.
Right. Yeah. So it's a difficult situation to be in, right? Because the Fed only has limited tools to help reduce the unemployment rate, but also keep inflation in check, as you mentioned before. and how it decides to ultimately balance those two objectives will be very interesting.
All right, Kathy, thanks so much. Kathy Zack, Purdue University Associate Professor of Economics. Thanks so much for joining the show this afternoon. I want to bring in Joseph Minarek, the Conference Board Chief Policy Economist and also former OMB Chief Economist under President Clinton. And Joe, what was your reaction just to what we heard from the Fed today? There was no big...
Seana, I lost you there for a second. Let me speak up. I think that the most important message from the Fed really has been that they will do what it takes. The concern in the longer term about inflation, I mean, we're really looking way down the road, it seems to me. We've had important forces, important changes in the economy, intense competition, a very hard time. You ask any producer about the possibility of raising prices. Do they have pricing power? The answer is going to be no. The Fed has got to keep its foot to the floor, its right foot, to get the economy moving again. That is the ultimate priority here. There's a lot of structural dislocation going on beneath the surface. It's going to be difficult to get economic growth going again. And the Fed has got to maintain confidence and has got to maintain a sense that we are going to have liquidity on those key markets for securities of governments and businesses.
Well, Joe, it's Adam, and they've already said, they're all in for whatever it takes. So is there, because they haven't actually initiated some of the lending facilities yet. They've just said, we're there with $500 billion ready to go. Is that sufficient? Is just knowing that they've got my back, is that sufficient? They never have to actually spend a dime?
I don't think that's true, Adam. I think that's a really good question. But the fact that the Fed is extending its tools beyond the parts of the economy where it has previously acted in extreme situations. So large businesses, and we're now talking about getting down to smaller businesses that can offer their own securities, but in markets that might not be tremendously liquid, and even to buying loans of even smaller businesses. Getting into the government markets, including of relatively smaller governments, taking some risks in terms of potential defaults, because they are more concerned about stepping too lightly than stepping too strongly. I think that those increases in extent of their past behavior is probably going to say that they are going to need to act and not merely to speak.
Joe, do you think the current policies, do you think they're enough in what we're seeing to support the eventual recovery? Because one of the things in your notes that stuck out to me was the fact that you were saying conventional monetary policy is clearly at best just a partial remedy.
The Fed is doing a good job of backing up the Treasury and vice versa. I think that one of the gratifying things in this outlook is the fact that you have no apparent friction between the Treasury and the Federal Reserve. I think that's extremely important. Ultimately, how far this goes, I'm afraid to echo one of your earlier guests. We really are subject to developments in the healthcare technology and in the public health. The longer this goes, the harder it's going to be. The Federal Reserve is going to have to be stronger and stronger, keeping entities like smaller units of government and smaller businesses going. But that is going to be dependent upon the public health environment.
Joe, real quick, I noticed all those car toys behind you, and I asked this question because sometimes you got to let a company go out of business like Studebaker, yet the Treasury Department is now involved with the Fed. Could the Treasury inappropriately try to influence decisions at the Fed?
Could they do that? Yes. I think that what we've seen so far from the Federal Reserve is a rigid application of appropriate standards. They have not wanted to be pushed around. They've shown resistance. They've behaved well, I think, in an environment where they took some criticism and they took it on the chin and they were quiet. But they have made, I think, sound decisions, and that will serve us well, and that will serve the economy well if they can manage to maintain those standards going forward. That's my personal judgment.
Hey, Joe, what do you think? I mean, this is just uncharted territory, really, for everyone who's involved at this point. There's no plans in place. There are no maps. What would you say is the biggest single challenge for the Fed at this point, quickly?
The most important thing is maintaining liquidity and maintaining confidence, but that is going to require taking some steps, as you say, into uncharted territory, and then they're going to have to find their way back. Let's keep this economy going. I'll worry about the return trip later, but the return trip will be difficult.
All right, Joseph Minerick, thanks so much for joining us. I want to take another quick look at the markets as we wait for Fed Chair Jerome Powell's presser to get underway. We are still seeing gains across the board. The Dow is up 574 points. The S&P also holding on to gains, up just around 2.7%. And the NASDAQ can be by far the leader in the market today, up well over 3%, up just around 3.5%. Taking a look into the Dow, just where we're seeing leadership-wise, Boeing is by far the big leader, up over 9%, followed closely by American Express, Visa, and Walt Disney. Those four stocks are the top performers so far today. And I mean, Adam, it's going to be interesting when we take a look at and when we wait to hear the reporters ask Jerome Powell, because this territory, what Joe Minerick was just telling us, is we're in uncharted territory right now. This hasn't been something that we have seen in the past.
That's correct, but I think we have Jay Powell now, Seana.
Perfect. Let's head to Jerome Powell's press conference just got started here.
First and foremost, a public health crisis, and the most important response is coming from those in the front lines, in hospitals, emergency services, and care facilities. On behalf of the Federal Reserve, let me express our sincere gratitude to those dedicated individuals who put themselves at risk day after day in service to others and to our nation. The forceful measures that we as a country are taking to control the spread of the virus have brought much of the economy to an abrupt halt. Many businesses have closed, people have been asked to stay home, and basic social interactions are greatly curtailed. People are putting their lives and livelihoods on hold at significant economic and personal cost. All of us are affected, but the burdens are falling most heavily on those least able to carry them. It is worth remembering that the measures we are taking to contain the virus represent an investment in our individual and collective health. As a society, we should do everything we can to provide relief to those who are suffering for the public good. While many standard economic statistics have yet to catch up with the reality we're experiencing, it's clear that the effects of on the economy are severe. Millions of workers are losing their jobs. Next week's jobs report is expected to show that the unemployment rate, which was at 50-year lows just 2 months ago, has surged into double digits. Household spending has plummeted as people stay home, and measures of consumer sentiment have fallen precipitously. Hotels, airlines, restaurants, department stores, and other retailers have been particularly hard hit. Manufacturing output fell sharply in March and is likely to drop even more rapidly this month, as many factories have temporarily closed. Overall, economic activity will likely drop at an unprecedented rate in the second quarter. Inflation is also being held down, reflecting weaker demand as well as significantly lower energy prices. Both the depth and the duration of the economic downturn are extraordinarily uncertain and will depend in large part on how quickly the virus is brought under control. The severity of the downturn will also depend on the policy actions taken at all levels of government to cushion the blow and to support the recovery when the public health crisis passes. The Federal Reserve's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We're also committed to using our full range of tools to support the economy in this challenging time. Last month, we quickly lowered our policy interest rate to near zero. We stated then and again today that we expect to maintain interest rates at this level until we're confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. Of course, lowering interest rates cannot stop the sharp drop in economic activity caused by closures and other forms of social distancing. And low rates will not effectively spur the economy if those rates do not feed through to broader financial conditions or if households and businesses are unable to get credit. The economic disruptions caused by the virus created tremendous strains in some essential financial markets and have impaired the flow of credit in the economy. Without access to credit, families can be forced to cut back on necessities and could lose their homes. Businesses can be forced to downsize or close, resulting in further losses of jobs and incomes and worsening the downturn. Preserving the flow of credit is thus essential for mitigating the damage to the economy and setting the stage for the recovery. We have been taking broad and forceful actions to these ends. To support the flow of credit to households and businesses, foster smooth market functioning, and promote effective transmission of monetary policy to broader financial conditions, we have been purchasing large amounts of Treasury and agency mortgage-backed securities. The markets for these securities play a critical role in the economy, and they came under great stress last month as the scale of economic disruption became clearer and as investors clamored for liquidity. Our purchases have helped market conditions improve substantially in recent weeks. In light of this improvement, we have slowed our pace of purchases. We will continue our purchases of Treasury and agency mortgage-backed securities as needed. While the primary purpose of these securities purchases is to preserve smooth market functioning and effective policy transmission, the purchases will also foster more accommodative financial conditions. We are also undertaking programs to provide stability to the financial system and to more directly support the flow of credit in the economy, for households, for businesses of all sizes, and for state and local governments. These programs benefit the economy by providing financing where it is not otherwise available. In addition, by serving as a backstop to key credit markets, the programs can improve market functioning by increasing the willingness of private lenders to extend credit. Many of these programs rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing and support from Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. I would stress that these are lending powers and not spending powers. The Fed cannot grant money to particular beneficiaries. We can only make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers will benefit from our programs, as will the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend, and to make decisions about where we, as a society, should direct our collective resources. The CARES Act and other legislation provide direct help to people, businesses, and communities. This direct support can make a critical difference, not just in helping families and businesses in a time of need, but also in limiting long-lasting damage to our economy. At the Fed, we're doing all we can to help American families and businesses weather this difficult period. When the spread of the virus is under control, businesses will reopen and people will come back to work. We will continue to use our tools to assure that the recovery, when it comes, will be as robust as possible. Thank you, and I'll be glad to take your questions.
Tina Smialek.
Hi, Chair Powell. Thanks for taking our questions. You guys have cut rates to zero. You're buying up huge quantities of government debt. I guess the question is, what more can you realistically do to help the economy? And where do you see a need for Congress to step in?
So let me say that we're committed to using our full range of tools to support the economy in this challenging time. We're going to use them, as I mentioned, forcefully, proactively, and aggressively until we're confident that we're solidly on the road to recovery. And also to assure that that recovery, when it comes, will be as robust as possible. As long as needed, we'll use them. And I would just say we have a number of dimensions on which we can still provide support to the economy. As you know, our credit policies are not subject to a specific dollar limit. They can be expanded as appropriate, and we can do new ones. So we can continue to be part of the answer. Will there be a need to do more, though? I think the answer to that will be yes. I would say Congress has also reacted quite aggressively and strongly with the CARES Act and other laws, several other laws, and that's appropriate. With enhanced unemployment insurance and the Paycheck Protection Program, we've seen an extraordinary, historically large reaction. But I would say that it may well be the case that the economy will need more support from all of us if the recovery is to be a robust one.
Nick Timrose.
Thanks, Chair Powell. Nick Timrose of the Wall Street Journal. I want to follow up on Gina's question and ask what specifically do you think elected officials should consider in order to help return or hasten a stronger return to full employment? And what policy tools did you discuss at your meeting today that might be used to stop a deflationary spiral?
So let me start. I'll take the questions in the order you gave them. So in terms of if I can say legislative priorities, we're not responsible for fiscal policy. Those will be decisions for Congress to make. But I would say that policies that protect workers, businesses, and households from avoidable insolvency, that keep businesses going so that they're able to produce goods and to either hold on to their employees or quickly rehire them, those are going to be key policies. They'll come with a hefty price tag, but we would come out of this event eventually with a stronger economy and with less long-run damage to the economy. So that's a key thing that really Congress could do over time. In terms of what we can do, I mentioned we have our credit facilities are wide open. We can do more on that front. In addition, we've had extensive discussions, as I've mentioned, done a lot of thinking about what monetary policy might look like in coming months over a range of potential scenarios for the economy. We do think that our policy stance today is right where it should be for now. As you know, we cut rates to the effective lower bound. We've said that we'll keep them there until we're confident that the economy has weathered the effects of the outbreak and is on track to achieve our goals. With asset purchases, we're continuing to purchase Treasury securities and agency MBS in the amounts needed to support smooth market functioning. So we're doing those things, and I would say that we'll continue to use our tools as needs be.
Steve Leisman.
Mr. Chairman, question, Steve Leisman with CNBC. I've got two questions here. First of all, why aren't you announcing or conducting a specific quantitative easing program? And maybe you could explain what the context is now of the purchases that will be made and the amounts that are to come. The second question I have is the Federal Reserve really taking enough risk to help households and businesses here, in that you just said that the programs that are out there may be best for those who are able to repay loans. But so don't you have a series of programs essentially lending only those able to repay, which is essentially helping those who may need it the least? Thank you.
So let me say again, in terms of asset purchases and other measures, we do think our policy stance is appropriate now. We've had discussions, as I've mentioned, over time and done quite a bit of thinking about what we might do in the future. We think for now our policy stance is appropriate. We're not going to change it now. And we're really waiting to see more from the economy. There are a range of potential paths the economy could be on. And I think as the time approaches then we'll address your first question, which is about asset purchases. But that's not something we're doing today. It's something that we have talked about, and for now we like our current policy stance. In terms of risk, so We operate under the laws that Congress passes, and there are a number of aspects under Section 13.3, and you can see that they've permitted us to, I think, move very quickly and move into areas where we've never been before and do so quite aggressively. So I think we're going places and providing help in places where we never have, and I'm glad that we are. I think it's appropriate that we are. Nonetheless, these are lending powers, and if you read Section 13.3 of the Dodd-Frank Act, or the Federal Reserve Act, and I know you have, it does require that we be secured to our satisfaction, and we can't lend to insolvent companies. It's clear these are lending powers, and we are ultimately bound to implement the laws that Congress gives us. We do not make grants. We can't make grants. And the reason I raised that in my remarks is that I just want to be clear on that. We can do what we can do, and we will do it to the absolute limit of those powers. We'll keep at it, and I just want people to know that we will be at it with the legal authorities that we have until we get through this thing. We will keep using our authorities. But there are authorities that we don't have, and there may be a need for those authorities to be used as well as ours.
Heather Long.
Hi, Chair Powell. It's Heather Long from the Washington Post. I have two questions for you, both on timing. The first, do you plan to launch the corporate credit facility and the Main Street lending facilities in May or early May? Anything you can give us a sense on timing? And the second, in the statement you refer today, the FOMC refers today to a lot of medium-term risks from the pandemic. That sounds like you all think this is going to be a long recovery, a long road to recovery. Can you give any more guidance on how you all see this recovery taking shape? Thanks.
Sure. So in terms of those facilities, the corporate credit facilities are near being finalized and will be operating, I would say, soon, fairly soon. Main Street facility is, we're close to announcing, to issuing a new term sheet. As you know, we put out a term sheet for comment a while back, and we got a couple thousand comments. We've carefully studied them. We've tried to reflect those in what we're doing now. I think with Main Street, there'll be at least a couple of different kinds of lending going on there. This is a broad area of the economy with many different kinds of credit needs, so we're going to keep at that for some time, I think, adding in sectors and lending products. So I think we'll probably be continuing to work and expand Main Street for some time, but it won't be done quite as quickly. But the first part of it, I think, will be done fairly quickly. In terms of our statement, so what we said was that I'll just read the sentence. It says, ongoing public health crisis will weigh heavily on economic activity, employment, and inflation in the near term and poses considerable risks to the economic outlook over the medium term. So what we meant by that, over the medium term. So obviously what we're talking about is not right now in the very near term. It's between now and the long term, so the next year or so. And I would point to a couple of risks to the outlook that what we were thinking of. First is just the virus. How long will it take to get it under control? Will there be additional outbreaks? Will there be drugs that can either treat it or a vaccine of some kind? So all of that is very much shrouded in uncertainty. The second issue, and this is a very substantial one, is just the possibility of damage to the productive capacity of the economy through a couple of channels. The first is just workers who, if one is unemployed for an extended period, that person can lose the skills that are needed, can lose touch with the labor force, and have difficulty restarting his or her career. So that's a feature of deep and long recessions, and that's something we've got to watch out for. Another is just businesses. These thousands of great medium and small-sized businesses that we have all over the country, they're worth so much more to the economy than the sum of their net assets. They contain, they're job creators. They're really important. And if we see an unnecessary insolvencies, a wave of those, that could be damaging to the performance of the economy over time. So the good news is that we have policies, as I mentioned in my remarks, we have policies that can address those things, but not perfectly. So that's another risk. The third thing I would point to is just the global dimension. This is a very global phenomenon, and we're seeing economic data from around the globe, which is very, very negative, and that too can weigh on U.S. economic performance over time. I would say just on the U.S. economy, there are things you can say. One can say. The first is that in the near term, we're going to see, significant declines in economic activity, significant declines in employment, and increases in unemployment. We're going to see that as a consequence of the virus and the measures we're taking to protect ourselves from it. The next phases are more uncertain, highly uncertain, but we will go through a phase starting fairly soon where we begin to reopen the economy, and probably the economic activity will pick up as consumer spending picks up. Consumer spending, as I mentioned, has gone down quite a lot. It'll begin to pick up as people start to return to their normal patterns of spending. But the chances are that it won't go right back to where we were, because people will, until they're confident that the virus is well and truly under control, then they will be somewhat probably reluctant to undertake certain kinds of activity. So it may take some time for us to get back. It probably will take some time for us to get back to a more normal level of unemployment and ultimately to maximum employment.
Okay, James Politi.
Thanks, Chair Powell. You didn't firm up your guidance on, this is James Politi from the Financial Times. You didn't firm up your guidance on interest rates at this meeting. And given the risks that you just outlined, under what circumstances would you strengthen the Fed's commitment to keep rates at the lower bound? And is there any danger to delaying that pledge? And on the credit facilities, what kind of demand are you expecting for the programs that were set up under the CARES Act? And are you expecting them to rapidly reach capacity like the PPP plan did?
Okay, so on the first, as I mentioned, we moved very quickly, very aggressively. We were the first to return to the effective lower bound where we are now. We got there essentially right away, and we think that's the right place to be. We think if you look at surveys, you look at market pricing, the market expects us to be there for a good while, and that's appropriate. So, it's not as though the market is pricing in a near-term liftoff or anything like that. And let me just say, we're not be in any hurry to withdraw these measures or to lift off. We're going to wait until we're quite confident that the economy is well on the road to recovery. So we see our current stance and our current guidance, and I would say the same thing about asset purchases. We see them as appropriate. I've also mentioned now a couple times that we have done a lot of thinking about what monetary policy might look like over coming months. And that would, depend on where we are in a range of potential economic scenarios. So we were thinking about that all the time. But right now, for now, we think our current stance is appropriate. So we made no change in it today. Second question was so the thing about our facilities is Treasury still has plenty of equity. So we've said that if demand for our facilities is greater than we've estimated, then we'll expand them. And we have the ability to do that. So it won't be the way the Paycheck Protection Program is, where there's a specific amount appropriated for it, and then there's no more money. That will be unlikely to happen here unless we exhaust Treasury's equity, and we're a long way from doing that. The second thing I would say is, and you've all seen this, is when we announce these facilities, and I mentioned this in my remarks, it's not just the actual lending we do, we build confidence in the market, and private market participants come in, and many companies that would have had to come to the Fed have now been able to finance themselves privately since we announced the initial term sheet on these facilities. So that's a good thing. Companies are out there financing, they're out there raising liquidity. We haven't made any corporate loans in those facilities. We've made the short-term money market loans, but we haven't made any of them. And yet there's a tremendous amount of financing going on, and that's a good thing. So for that reason, the ultimate demand for the facilities is quite difficult to predict, because there is this announcement effect that really gets the market functioning again. Of course, we have to follow through, though, and we will follow through to validate that announcement effect.
Okay, Howard Schneider.
Oh, hi, Chair Powell, and thanks for doing this. I wanted to get you a little more expansion on the timing of recovery and the connection between the health response. You said earlier, I think, that you thought the second half of the year could see a pretty robust rebound. Is that now out of the question? And do you think a steady recovery is really possible until a vaccine's developed, given the patchwork of measures we see taken around the states? Is that going to really lead us to a steady path out, absent a vaccine?
As you know, economic forecasts are always uncertain. Today, they're unusually uncertain, and that's really because so much of the performance of the economy depends on the path of the virus and the success of the measures we take to control it, our success in reopening the economy, and also the time it takes to develop new drugs. And our tools, the things that we do, don't affect any of those things. We're not experts on those things either, but what the experts tell us is that the outcomes are highly uncertain. So this is an unusually new kind of uncertainty added on top of our regular uncertainty. But I will say I think there are a few things you can say about the path ahead. First, this time now is going to be a time of sharp contraction in economic activity, high unemployment. Personal consumption expenditures have declined sharply, business investment as well, unemployment moved up. We're going to see economic data for the second quarter that's worse than any data we've seen for the economy. And they're a direct consequence of the disease and the measures that we're taking to protect ourselves from it. So then we'll enter this new phase, and we're just beginning to maybe do that, where we will formal measures that require social distancing will be rolled back gradually and at different paces in different parts of the country. And in time, during this period, the economy will begin to recover. People will come out of their homes, start to spend again. We'll see unemployment go down. We'll see economic activity pick up. And when will that be? It's very hard to say. But let's just say, for this purpose, that it's in the third quarter. So, as I mentioned earlier, that could be a fairly a large increase. Given the size of the fall, the increase could also be substantially large, although it's unlikely that it would bring us quickly all the way back to pre-crisis levels. Of course, this is the period as well that carries the risk of new outbreaks of the virus, something we really want to avoid. I think then, after that period, at some point you will have, the kind of formal social distancing measures will be gone, but you'll still be left with probably a level of caution on the part of people who will worry. And probably keep worrying for some time. You would think that behavior will change as people gain confidence. So the sooner we get the virus under control, the sooner people can regain that confidence and regain their economic activity. I think trying to be really precise about when that might happen and what the numbers might look like is, I think it's very tough to do that.
Okay, Steve Matthews.
Steve Matthews with Bloomberg. Chairman Powell, you've noted a number of times over the last year that there's been a broadening out of job gains with marginalized workers. People have been left out of the recovery over the 10-year period, finally making job gains, and particularly minorities, but also many other workers. Do you worry that this recession is going to fall hardest on those workers who struggled and just got job gains in the last year or two, and that it may take years from now before there are opportunities for them again?
Yes. That's exactly what I worry about. So unemployment has tended to go up much faster for minorities and for others who tend to be at the low end of the income spectrum, and it tends to come down faster as well, but it tends to go up faster and be much, much higher. And we were in a place only 2 months ago. We were well into, beginning the second half of the 11th year is where we were. And every reason to think that it was ongoing. We were hearing from minority, low and moderate income and minority communities that this was the best labor market they'd seen in their lifetime. All the data supported that as well. And it is heartbreaking, frankly, to see that all threatened now. All the more need for our urgent response, and also that of Congress, which has been urgent and large, and to do what we can to avoid longer run damage to the economy, which is what I mentioned earlier. This is an exogenous event that it happened to us. It wasn't because there was something wrong with the economy, and I think it is important that we do everything we can to avoid that longer run damage and try to get back to where we were, because I do very much have that concern. I think everyone is suffering here, but I think those who are least able to bear it are the ones who are losing their jobs and losing their incomes and have little cushion to protect them in times like that. So yes, that's a very big concern.
Victoria.
Hi, I'm Victoria Guido with Politico. The Paycheck Protection Program has experienced some logistical problems because of the speed at which all of this is happening. For the Main Street lending facility, which will also work through banks, what lessons are you taking away from that? And then more broadly, you mentioned earlier this year that the federal debt was on an unsustainable path. And I was just wondering, for Republicans that are starting to get worried about how much fiscal spending they're having to do in this crisis, whether that should be a concern for
them. So a couple of things. This is different from the PPP, the Paycheck Protection Program, in two ways. One is these are not grants; these are loans. So I don't know that the demand will be quite as strong as it has been for the PPP. I don't know that, but and the second thing is we won't run out of money. It's not a limited pot, so there won't be this incentive to try to get there first and that sort of thing. So I'm hopeful we will very much try to learn as much as possible from that facility and from all the other ones too. We have a lot to learn here, so. We'll certainly be trying to do that. In terms of fiscal concerns, so for many years I've been before the Fed. I have long time been an advocate for the need for the United States to return to a sustainable path from a fiscal perspective at the federal level. We have not been on such a path for some time, which just means that the debt is growing faster than the economy. This is not the time to act on those concerns. This is the time to use the great fiscal power of the United States to do what we can to support the economy and try to get through this with as little damage to the longer run productive capacity of the economy as possible. The time will come again, and reasonably soon, I think, where we can think about a long-term way to get our fiscal house in order, and we absolutely need to do that. But this is not the time to be, in my personal view, this is not the time to let that concern, which is a very serious concern, but to let that get in the way of us winning this battle, really.
Okay, Edward Lawrence.
Oh, yeah. Thank you, Mr. Chairman. Edward Lawrence from Fox Business Network. Now, given the amount of stimulus on the fiscal side and monetary policy side, how much weight do you give to finding a vaccine, from clearing that uncertainty you talked about around treatment and whatnot, for the Federal Reserve pulling back on some of the Fed's actions and raising the rates from the zero lower bound? Also, when does that Main Street lending facility get deployed? Because you talked about soon, some businesses are in need now. Thank you.
So we don't. We're not in a position to make, a reliable assessment of when a vaccine or a therapeutic drug would be ready, and so we're not going to set our policies based on our estimate of that. We're going to just provide the support that we can with the tools that we have, and we're going to keep doing that until the recovery is well underway. In terms of Main Street, so you know the story. We put out a term sheet. We got a lot of comments. We took those very much to heart. We spent a great deal of time here. It's a challenging space because it's many different kinds of borrowers. They have different needs, different sizes of companies, and so we're as I mentioned, we're very close to announcing a new term sheet, which will then become operative fairly quickly. My guess is, though, that we'll keep looking to add products and add different kinds of borrowers to that as we go, and we're well aware of the importance of doing it as quickly as possible. We're very much in touch with the urgency of that need.
Okay, Don Lee.
Chair Powell, it's Don Lee from the LA Times. Just wanted to follow up on the question on the labor market. I know you said that it's highly uncertain, but there are analysts who think that we'll have very high unemployment until even the end of next year, as high as 9%. And at this point, can you just talk a little bit more about what you see as the path of employment in the coming months and into next year?
Sure. So unemployment's going to go up to a high number in the second quarter. Uncertain what the number will be. And that's because so much economic activity has been shuttered, really, as we take social distancing measures. So sometime fairly soon here, and probably gradually and at different paces at different parts of the country, we'll see the social distancing measures rolled back. People will begin to spend more money. It's really consumer spending has fallen precipitously. And once that starts to happen, people will get hired back and unemployment will go back down. I don't think it'll get anywhere near the historically low levels that we had in as recently as February, 3.5%. I think it will take some time for that to happen, for us to get back to anything that resembles maximum employment. But I mean, the main thing we want to get back on that road. We want to get that recovery going and get people back to work as fast as we can. Not faster than we can, but as fast as we can. And the main thing is to get into that stage where the economy's healing, where we have the disease under control, where we don't take too much risk of second and third waves and that sort of thing, and get people back to work. And it's again the path of it is highly uncertain, but we will be there with our tools, supporting the economy and supporting that recovery.
Scott Horsley.
Thanks, Mr. Chairman. After the financial crisis, banks were instructed to up their capital so they could weather an economic shock. What kind of steps do you think we need to take for the economy writ large to make it more resilient to this kind of shock?
Can you just say that part? You're a little bit low volume.
Yes. What kind of steps could we take to help the economy as a whole be more resilient to this kind of exogenous shock?
It's an extraordinary shock, unlike anything certainly that's happened in my lifetime. And a couple things come to mind. I think the time will come for a careful assessment of the answers to those questions. It's early to be asking them. We're still putting out the fire. We're still trying to win, and I think we'll be at that for a while. But I'd point to a couple of directions. We worked hard to strengthen the banks, much higher levels of capital, liquidity, a far greater sense of what the risks are they're running and how to manage them. So the breakdowns that we've seen in market function have really been in the capital markets, and I wouldn't rush in with prudential regulation into the capital markets, but I think, and we did plenty of things, tri-party, we did a lot of reform in the capital markets, money market reform, tri-party repo reform, central clearing, all these important things. But there will no doubt be with this, the size and force of this shock will no doubt reveal weaknesses in the financial architecture, and we'll have to go to work on those. I also think it, it tells you the importance of getting your fiscal house in order. The U.S. really hadn't gotten back to where we needed to get on fiscal policy, and so we have an already high level of debt to GDP and rising quickly when this shock arrived. Now we have the fiscal capacity to deal with it, I believe, but we will need to. Ideally, you would go into an unexpected shock like this with a much stronger fiscal posture.
Mike McKee.
Mr. Chairman, given the demand shock and the drop in oil prices, do you anticipate that we might see any kind of deflation, even for a very short period, that would require a Fed response? If we get a negative print on CPI or PCE, how should people think about that? And second question, there is a disconnect, it appears, between the markets and the economic outlook right now. And I know you've said that this isn't the time to worry about moral hazard, but do you worry with the size of stimulus that you and the Congress are putting into the economy, there could be financial stability problems as this goes along?
In terms of inflation, we think that inflation is very closely and strongly related to inflation expectations. And during the global financial crisis, there was a concern that we might see deflation, but it didn't happen. Inflation tended to move down a little bit, as it will when demand is weak. And but inflation expectations did not move strongly down here in the United States. They have in other places in the world, though, over the past 25 years. There's been downward pressure on inflation really for several decades now. So I would say as long as inflation expectations remain anchored, then we shouldn't see deflation. And the Federal Reserve is strongly committed to maintaining 2% inflation over time. So we'll be there to work on that. I think you asked really about headline inflation. If low energy prices, very low energy prices, were to drop headline inflation negative, I would hope that people would see through that, and we'll be monitoring it very carefully. Would see through it though, and look to core, which is a better predictor of future inflation. So, needless to say, we'll be keeping very close track of that. In terms of the markets, our concern is that they be working. We're not focused on the level of asset prices in particular. It's just markets are trying to price in something that is so uncertain as to be unknowable, which is the path of this virus globally and its effect on the economy. And that's very, very hard to do. That's why you see volatility the way it's been, market reacting to things with a lot of volatility. But, what we're trying to assure really is that the market is working. The market is assessing risks. Lenders are lending, borrowers are borrowing. Asset prices are moving in response to events. That is really important for everybody, including the most vulnerable among us. Because if markets stop working and credit stops flowing, then that's when you see very sharp negative, even more negative economic outcomes. So, and I think our measures have supported market function pretty well. We're going to stay very carefully monitoring that. But I think it's been good to see markets working again. Particularly the flow of credit in the economy has been a positive thing as businesses have been able to build up their liquidity buffers and households have been able to be home. People have been home, concerned about their jobs, but they're not concerned about the financial system collapsing as they were in 2008 and 2009.
Okay, Chris from the AP.
Hi, Chair Powell. Chris Regaver at AP. Thank you. I guess I had two questions. I wanted to start on the unemployment picture and nail down a little bit how you see things going from here. you did talk about potential loss of skills over time. So are you worried about structural changes in job markets that would keep unemployment high and therefore potentially beyond the ability of the Fed to do anything about, which is something that was debated, as you know, after the last recession. And then eventually, of course, the unemployment rate did go lower than people thought. Second question is just on the money from Treasury, the $454 billion. It sounds like you want to keep that in reserve for programs that have high demand, such as the Main Street program. Are you willing to use that to backstop, say, a program that is having more losses? I mean, what's your tolerance for loss among that $454 billion? Thank you.
So in terms of the labor market, the risk of damage to people's skills and their careers and their lives is a function of time to some extent. So the longer one is unemployed, the harder it gets, I think, and we've probably all seen this in our lives, harder it is to get back into the workforce and get back to where you were, if you ever do get back to where you were. So, and longer and deeper downturns have left more of a mark generally in that dimension with the labor force. And so that's why, as I mentioned, that's why the urgency in doing what we can to prevent that longer run damage. It doesn't have to be that way. We won't be able to limit all of it, but we do have the tools to do what we can to keep people in touch with the labor force and working, and also out of insolvency too. It doesn't seem fair that people should lose everything they have, including their homes, over this. So nonetheless, there will be some of that, but we do have some tools to ameliorate that. In terms of the the money, the $454 billion, it's a couple things. First, the Treasury Secretary really has authority over that, right? And it stands in front of our losses. But I do think we're clearly moving into areas where there is more risk than there has been in the past, and that's okay. I think that's what we're supposed to do. This is a very unusual time, and so. But in terms of the way to think about that money, I think that's really a question for the Treasury Department. We set up the facilities and we work very, very closely and successfully and collaboratively with the Treasury on this, but that particular aspect of it falls more to the Secretary.
Okay, we'll go to Nancy Marshall-Genzer for the last question.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I'm wondering what you would say to savers who are hurt by very low interest rates and maybe going into investments, maybe in the stock market, that aren't so great for them. And also, I'm wondering if you can give us any more of a clue as to how long you think we're going to have interest rates near zero.
So we think that low interest rates affect the economy through a number of channels in a positive way. Lower interest rates support economic activity through channels that we, through channels that we understand reasonably well. They make it cheaper to borrow. They make they drive your costs of borrowing down. They do raise asset prices, including the value of your home. If your saver owns a home or has a 401k, your saver will benefit from that. But for people who are really just relying on their bank savings account earnings, this is that's you're not going to benefit from low interest rates. But we have to look out for the overall economy. Low interest rates support employment. They support economic activity. And those are our mandates. And I think for the overall good of the economy, low interest rates are a good thing. And it's not to say they're good for every single person, but that shouldn't stop us from doing what we think is good for the whole. In terms of how low, I really don't want to speculate. We will turn to questions like that soon enough. But in terms of how long we'll stay and under what conditions we'll stay at the effective lower bound, those are just exactly the things we're thinking about. Right now, we like the place we are. We've said that we'll keep our rates where they are until we're confident that the economy has weathered the effects of the outbreak and is on track to achieve our goals. So that's where we are. We're not changing that guidance today, but it'll be. That means we're going to be very patient. That means we're not going to be in any hurry to move rates up.
Thank you very much.
Thanks.
Reserve Chair Jay Powell on this significant Fed day. They're all significant now, but I think the Fed coming in with a number of important statements here. Powell really affirming where the Fed is at in their process of trying to help the economy through this coronavirus period. Of course, we'll just start with the Fed's statement, which quite a bit different than what we've seen from the Fed over the last decade, just the way that they start the statement, the language they use in there, making no assessment of the U.S. economy right now, not characterizing the health of the business or the consumer sector, talking about the tremendous human and economic hardship that we're seeing here in the U.S., using this phrase as needed to talk about their asset purchases longer term. We've gotten obsessed with these small Fed phrases over time. So the latest one really going to be an amounts necessary. They're talking about their QE program there. Going through some of what Powell said during the press conference, he expects there'll be a double-digit unemployment rate when we get the latest jobs report that's expected out a week from Friday. Also talking about the need for all levels of government to do what they can to support the economy in this time. I want to bring in Yahoo Finance's Brian Chung now for a little bit more on, Brian, what stood out to you during the press conference out of this statement? I think we're all trying to parse through and take away what our biggest thoughts are. I just want to start with where you feel like Powell took this conversation.
Yeah, I mean, at the baseline, we have to understand that the Fed's announcement today wasn't actually all that changed. There was no real change in the policy stance. The Fed had already cut interest rates to near zero and had launched what was effectively capless quantitative easing or asset purchases in treasuries and agency mortgage-backed securities. So we were really listening into the Powell press conference for two things. First, what were his kind of expectations for where the U.S. economy is going to go from here? And then secondly, any sort of new detail on those 9 liquidity facilities that the Federal Reserve had announced. So on the first bit on the U.S. economy, it sounded like he did expect that this is going to be a long slog back. So he did say that he does expect consumer spending to rebound. Keep in mind, consumer spending being 70% of the U.S. economy, but he said it won't rebound to the levels that we saw before COVID-19, that because of things like social distancing, it'll take time. And I think that's a translation for we shouldn't expect to see a V-shaped recovery. And then on the second bit on the liquidity facilities, nothing necessarily new, hoping that maybe he was going to provide some more color on if the Fed saw a need for covering kind of new holes in the wall, if you will, whether that's mortgage servicers or maybe nonprofits like universities. But he did say that the Main Street lending program, which is really the cornerstone, if you will, of the Federal Reserve's efforts to try to plug the holes on Main Street, because there's all these companies that are larger than those that qualified for PPP loans, but too small to access capital markets. He said that should be up and running soon, although he didn't appear to really have any more details beyond what the Federal Reserve had already unveiled up to date. So it seems like the Federal Reserve still has a lot of work to do on those liquidity facilities. But again, regardless, the actual policy changes today, not much in there.
All right, let's go to the markets now. They were higher earlier today. They remain higher. Jared Blickery, what stands out to you just looking at the charts that we're seeing here? And this rally continues. We're now on pace for really one of the best months we've seen in the market in quite some time. I think a stunning reversal for folks, given not only what happened in March, but where the virus still stands. The outbreak is still not, I don't really think, in the neighborhood of under control here in the U.S.
You said it. This has been an incredibly fast and furious rally that we've seen. Dow's up over 600 points, pressing up against session highs. Powell managed to get through the entire press conference without very much of a sell-off at all. Very muted action here. Here's the NASDAQ. It's up nearly 4%. We're seeing tech surge again and finally lead again after being kind of dormant for a few days. S&P 500 is up over 3% as well. And here's the intraday. Well, this is actually a year to date. We'll take a look at that in a second. But here's the intraday price action. And everything here is from the announcement into the presser. And you can see we're making new highs right now. Now, if we go to a year to date, and I do want to spend a few seconds on this because it's pretty important. A lot of traders are interested in shorting at the current levels, all the way up to the 200-day moving average, which is just above the 3,000 level. Also coincident with this price action resistance line that we've been tracking since basically the beginning of the rally all the way down here. Is it going to work out? We have no way of knowing. We do have month-end pension fund rebalancing. And because of the incredible surge in equities that we've seen this month, it's estimated that pension funds may have to sell $50 to $100 billion into Thursday, which is the end of the month. We'll have to see if that has any effect on markets. It seemed to at the end of the last month, which was also the end of the quarter. Let's also take a look at the VIX because that has been flirting with the 30 line. Generally perceived that below 30 is kind of a return to normal. Of course, we were trading near 10 to 12, 15 in the lead up to the coronavirus when we were making all-time highs. And then we have the chip index here. The Philly chip index has just been surging today. Very impressive, especially given the fact that AMD issued such weak guidance yesterday. Market just shrugging off. So we have a lot of canaries in the coal mine that are signaling it's still risk on. So here's the 10-year T-note yield, kind of flat today, up about 2 basis points, still around that 0.6 level. Really want to see that lift off, but in the meantime, not really having too much of an effect on the markets. And I guess we'll take a look at the Dow heat map here because we do. It's going to be, here's the Dow. We can see Microsoft up over 4% ahead of its earnings, Apple up over 3.5%, Visa up 6%, JP Morgan up over 3%. Financials have been leading over the last few days. And the sector that's been doing the best is energy. Energy has been up, I think, 31% this month. And there you can see it's leading again today. Very impressive, especially given the delve into negative prices last week that we saw in crude oil. So this will be my last chart. We'll check on crude oil today, and we can see it is up 23%. It was up nearly 30% earlier. Miles?
All right, Jared Blicker with the latest on where we stand in the market right now. For a little bit more on the Fed, I want to bring in Tom Graff. He's the head of fixed income at Brown Advisory. And Tom, I guess I'll just start with your thoughts on what we heard from Powell today and really what you've made of the Fed's actions in the last 2 months.
Thanks, Miles, for having me. Look, I think the Fed kind of stuck to their message that they're trying to build a bridge between where we are now and when the economy can start opening again. I think Powell was pretty realistic about their ability to provide further stimulus right this moment, but also wanted to emphasize that when the time comes, they'll do whatever they can do to make sure it's a robust recovery.
And then I guess, Tom, I think there's been a lot of misunderstanding around what the Fed has done, what the Fed might do. Do you think that Powell can really do anything to allay those fears? I mean, we're having people say, oh, the Fed's going to start buying equities. And I don't think there's anything that he's done that suggests that, but it certainly is now like a market talking point that the Fed's kind of gone off the reservation. I mean, how do you think Powell can navigate that kind of environment?
Well, so it is a tricky balance he's got to go. So he wants to make sure that he doesn't close the door on further stimulus, that he doesn't let the market think that they're out of ammo or that they can't do anything more. Because I think that's a mistake that Bernanke made in 2009. But on the other hand, there are some, I think, much less likely things that are floating around. One of them is negative interest rates, and the other is buying equities. I earlier said that I think the Fed wants to build a bridge between here and the recovery period. I don't know what buying stocks achieves in that regard. Whereas keeping the financial markets functioning, right, keeping debt markets open, making sure companies can access capital if they need it, that's a bridge action. So I think there's this sense that the Fed just wants to prop up markets, and actually Powell sort of swatted that down a little bit earlier today, even though he didn't mention the equity thing specifically.
Hey, Tom, it's Brian Chung here. So listening into Powell's press conference, I was looking for forward guidance. That's what the Fed said ahead of exogenous shock that it was going to use to try to battle the crisis. And I think that it seemed like it was a little vague what he was trying to say here. He didn't really have a number on where he could see unemployment going. He said that quantitative easing is still capless for right now. Didn't necessarily commit to a certain amount of purchases as maybe many on Wall Street had expected ahead of this meeting. What did you gather from the forward guidance aspect of Powell's communication just now?
Look, I personally think that this sort of forward guidance is a bit more effective than what the Fed was trying back during the 2008 and subsequent recovery. At that point, they wanted to, at first they were giving literal time horizon guidance, but then later it gave sort of vague for a long time, for an extended period type guidance. What Powell is now saying is, look, we're going to be at zero until the economy appears on its way to a robust recovery. I think within the Fed, the fact that they lifted off in 2015 is seen as a mistake now. So I think they want to avoid repeating that, avoid this sense that some number higher is the center of gravity toward which interest rates are going to flow when things are normal. So I think rather what they'd say is, we're going to keep interest rates at zero until unemployment is dramatically lower than where it is now.
And then I guess, Tom, along those lines, thinking about this Fed regime, the Powell Fed regime versus Bernanke Yellen, which, was pretty much one continuous leadership structure there. Powell talks a lot about, he said it right in his first sentence, that the folks least able to bear the economic burden of this are stuck with it. He has this, I think, populist kind of view of how distribution works in the U.S. economy right now. Do you think that is also informing his lack of using economist type guidance, I guess? He's not an academic, but he also seems to be looking at the economy in a very different way than some of his immediate predecessors.
Yeah, I was definitely struck by when he responded to one question with, "That's exactly what I worry about." I thought that I didn't think that Bernanke or Yellen would have put it that way. I'm not sure that he has a completely different viewpoint so much as I think we saw in the last, say, 2 years prior to the coronavirus crisis, how much benefit was garnered to the bottom end of the income structure, which does include a lot of minorities and other disadvantaged communities, right? We saw how much benefit was garnered to them, and I think he's forlorn a bit that might get lost, sort of through no fault of anybody. So I do think, I'm not sure that if Bernanke or Yellen were in this seat at this moment, that they would have a different point of view. But I do think Powell's bringing something else to the table than what was coming at that time.
And I was really struck by what he said at the beginning. It seemed a little bit like a different Chair Powell in a way. And I've been going through the exercise of just sort of sliding doors of it all. What would we have been discussing right now if coronavirus hadn't come along? And I just went back to the past Fed meetings and was looking at questions we were asking. And some of those were around inflation and the idea that the Fed was willing to let this economy run a little hotter than usual, over 2%. And then to hear Chair Powell say multiple times today, we are in no hurry. So in terms of their patience here and what we were thinking before about inflation, do you have any thoughts on what this kind of move by the Fed, all these facilities coming in, is going to do to inflation in the long run?
Well, I think it's really tricky. So I think there's a scenario where there's a burst of demand during a recovery phase that sort of front runs an improvement in supply chains, such that could cause some inflation. But honestly, I think if inflation ran at 2.3, 2.4, 2.5 for a short period of time, the Fed would be elated. They've been trying to get inflation expectations somewhat higher for multiple years now and hasn't been successful. So I think the one they'd be like. The other thing that would make them elated in that scenario is the fact that there's a burst in demand in the first place to cause this scenario to happen. So I think any of the inflation scenarios are ones where something's gone right about the Fed's policy, and I think they'll actually be pretty happy with the outcome.
All right, Tom Graff with Brown Advisory. Thanks so much for joining us today. Brian Chung, thanks for joining us as well. We'll talk to you guys hopefully soon about everything going on in the fixed income and Fed worlds. Coming up after this break, we're going to take a look at this market rally here on this Fed day. Also going to talk a little bit about what could be happening this summer. Specifically, will you be able to send your children to camp? What that could look like. Dan Roberts will join us with that story coming up in just 2 minutes. Finance Live, Miles Upton here in New York. Let's take a look at this market. Again, we've got a huge rally on our hands here on this Fed day. The Dow is up 2.5%. The S&P is up 3%. The Nasdaq's up 4%. And the Russell 2000, the small caps, they're up 5% today. So far this month, we have seen the small caps gain just about 20% since the start of April. The NASDAQ is up about 9% year over year. So, I mean, we're kind of, I think more than that, about 15% year over year. But it's a very interesting period here where we're starting to, I think, Jen, leave in the rearview mirror some of those scariest days. And I don't think anyone's going to soon forget what March 2020 was like. But this split between what we're seeing in the news flow, you've got Uber layoffs, Lyft layoffs, Boeing layoffs. There's the Airbnb renter host-pocalypse, I guess, out yesterday. GE coming out with bad news from its aviation unit. The news is all bad. Jay Powell, double-digit unemployment, unprecedented decline, and yet here we are, the stock market doing its thing.
I was feeling pretty good after the press conference, Miles, and then you had to remind me of all that labor news out of there. I thought Chair Powell did a pretty good job today at saying, look, we are all in, we're going to do whatever it takes. And the market, which had big gains earlier this morning on the Gilead news, continued to hold those. So obviously not spooked by anything that Powell said in there. And there is this bifurcation. We're seeing it in what's happening with headlines and then certainly what's happening in some stocks, but just bifurcation even in technology. Look what we saw from Google. And then we've got some chip names down today. We've had AMD and AMAT. So not everything is getting thrown out at once. And we are continuing to see a little bit of that rotation. Only names down today, really, Walmart, which of course we've seen huge gains in that. Zoom also lower here. So some of those names that have done really well in the stay-at-home phase, we're continuing to see the rotation out of those.
Yeah, and I think, again, it is kind of like, how many times can we say it? The market's doing one thing, the real world seems to be doing another. Eventually, it would seem that they would converge, but as we learned for the last decade, that's actually not true. So I think we're kind of just two different stories for the time being. All right, let's move out into the future. I know no one can really make any plans outside of maybe 3 days from now, but certainly families need to figure out what they're going to be doing this coming summer. Dan Roberts, you talked about what the summer camp space could look like, because we are rapidly approaching. I mean, forget about the time. You already needed to know if you were going to go to camp, but the time where you have to decide, are you going to actually send your child? And these camps don't know really what they can do.
Yeah, Miles, I think it's something a lot of people are beginning to think about. And obviously the difficulty for the camps is that it's not going to be one uniform process across the country. I mean, now that you see certain states reopening, camps in those states, like in the South and maybe in the Midwest, will be just fine. Whereas on the East Coast, which is where I chose to focus for this story today, camps can't yet. They're waiting official guidance. Focused on Maine, where some of the country's oldest camps are, and they're waiting on official guidance from the governor. And what's hard is they're all anticipating that guidance is going to be basically some form of, it's up to you. We leave it to you, and we suggest these precautions. And the reason that's hard is camps will go different ways. Some camps will be over precautious and won't open at all. Some camps will open, but with major changes. And I get into some of those changes. I think there are enough changes that it really is a different kind of camp experience. I mean, some of these summer camps, they're going to, if they open at all, completely isolate the camp. So staff and campers arrive, and for 5 weeks or 7 weeks, whatever it is, can't leave at all. So no outdoor trips, no excursions, no socials with other camps, no sports against other camps. And that really changes things, but it might be doable. And the irony is that a lot of these camps will end up with shorter sessions than they usually have, but with more costs than usual, because they're going to have to hire extra medical staff. But the bottom line is camps basically are hoping that if it's a very different kind of camp experience, they can open in some form or another, because the worst case scenario for them would be to have camp be canceled. I mean, this is an $18 billion industry. There's thousands of camps across the country, hundreds in Maine, and a lot of people have a lot of questions. So it's tough. Most of them are expecting to have to decide by May 15, because they have to start ordering the equipment and food they need in order to open in June or July.
And Dan, of course, another way that parents get their kids off their backs and get them occupied for the summer are those pre-college programs, whether it's at an Ivy League school or the Andover, Exeter programs of the world. Do you have any insight there, especially as many of those are clustered, of course, in New England?
Yeah, I heard a lot about those programs because the issue for day camps and summer camps is different, obviously. And ironically, a day camp might be more in jeopardy, or some kind of summer program where it's not sleepaway, because the kids come and then they go home, or the teens, or whatever age people were talking about. Whereas the summer camp, as I mentioned, they can try to just completely quarantine for the whole summer, keep everyone isolated within the camp. Now, interestingly, the two areas we're talking about here intersect, because some of the camps I spoke with, they are concerned, or at least betting, that they won't be able to get any international staff. You know, a lot of these summer camps usually have a lot of staff that come from outside the US. Due to flight restrictions, they probably won't get that staff. But on the bright side, they're able to replace them, they think, with locals, you know, US counselors who unfortunately had their internship, some jobs canceled already because of coronavirus. So I think some of the programs you're asking about have already been put on hold, but as a result, those young people can maybe find a job at a camp if the camp's open. So a lot is in flux right now. And obviously what we're talking about also involves, you know, sport, because people are wondering, will there be college football? Those programs usually start in August. Well, if people aren't going back for college on time, you know, the actual students, how could there be college sports?
Hey, Dan, one question on this camp front is it's kind of like the economy. They can open, but people have to choose to send their kids there. And in my community with people sending kids to camp, there's just a lot of discussion right now about, because the camps keep saying, oh yeah, we're gonna open. And parents are like, great, but I'm not sending my kid. So I don't even know if we know these camps are gonna go off, even if they say that they're open.
Yeah, that's a very good point, Jen. Now, of course, what the camps say, and maybe it's smoke, is that for now, they have had very few, if any, cancellations ahead of time. And I think that's because a lot of parents really hope there will be camp. I mean, you know, I wouldn't know yet. Maybe you would know better than I, but I think a lot of parents whose kids normally go during this coronavirus time where they've had the kids cooped up at home, they're desperate for there to be camps so that, you know, both for the kids' benefit and for the parents' benefit. But yes, if you're concerned about the health issues, that makes sense. The only examples I've heard of so far of parents already deciding, well, I'm not sending my kid, even if there is camp, is parents of kids who have pre-existing health conditions. You know, I spoke to one parent who their son has asthma, so they already know I'm not going to send my son to sleepaway camp even this camp. But it's going to vary across the camp landscape. Some camps are going to have really strict health measures. Some might not open at all. Some might open, but you know, usually these camps, the parents have been sending their kids there for many summers already, and they trust that the camp will take all the necessary safety precautions.
Yeah, Dan, we're out of time here, but just one quick thing before I guess Miles is wrapping. Miles, are you looking to wrap? One sec. Is the cost issues, like if you put a deposit down and you decide not to go, do you get the money back, sort of like a trip? Or if it's going to be social distancing, is it going to cost less because it's not the same experience? I know you want to say something about it, but no, go ahead.
Yeah. You know, I asked camp directors that exact question of, look, with all these restrictions, it's a very different experience. And parents ask for a discount on tuition. And they said, no, we're not hearing that, because they understand that to open at all, we're going to have more costs than usual. But you're right that it's varying. I mean, some camps are already telling parents, don't worry, you don't have to get a full refund. If we have camp not comfortable, we'll get a full refund. Other camps may not have that financial luxury. And some sound like they're saying to parents, well, if you don't want to send your kid this summer, could you hold your tuition and we'll use it and apply it to next summer? But it's going to vary.
All right, Dan Roberts with the latest on the camp trade. Again, rapidly approaching about 7-8 weeks away from when kids would start going to sleepaway camps, at least here on the East Coast. All right, coming up after this, we are going to talk a little bit about what Google is doing with their Hangout, their Meet feature. Of course, we're on it here every day, expanding usage across the board, and some things that Google is doing to get this product in the hands of more people. We're back with that in just 2 minutes. All right, welcome back to Yahoo Finance Live. Miles Ludland here in New York. Well, certainly our viewers know that things have been a bit different here at Yahoo Finance. We've been using Google to broadcast to you out there from our own homes, and we're joined now by Javier Soltero. He's the Vice President and General Manager of G Suite over at Google. So Javier, let's just start with what you guys have seen in terms of increased usage and how many different organizations like ours, I guess, went from, we use this for meetings and we had folks in California and New York, but now we're broadcasting out 8 hours a day from across the country, across the world. And I'd imagine we're not the only organization that has gone from, maybe 10 or 20 miles an hour to 100 miles an hour with our Meets and Hangout product.
Great. So great to be here. Thank you, Miles. I'll start by saying that, the growth that we've experienced over the last 2.5, 3 months has been something extraordinary. I'm fairly new to Google, so for me to have just come into the organization right as this was about to happen, and then see this product, grow to become such an integral part of how companies function, how broadcasters like yourself are able to produce news, schools, et cetera. It's just been incredible. And I think the interesting part about how people like Yahoo Finance and your team are adopting this is just the creativity that you can employ once you have the ability to capture live streams and then sort of rebroadcast them, et cetera. It still leaves us with the ability to not just communicate with each other, but also to inform the public, produce interesting content, et cetera. So we're very excited about that.
Javier, it's a competitive space, though. And, you've got WebEx and Skype, and of course, we all know the Zoom phenomena. How do you guys benchmark yourselves against those competing products, and what do you guys look to do to differentiate yourself in the marketplace?
Well, first of all, I think we start not just for Meet, but really for all of G Suite with this idea that we build products that people choose to use, right? There's a lot of options in technology nowadays, and we're guided by the idea that if you build the best product, the only way to confirm that is by having people adopt it and stick with it. So that's what guides our decision-making around what features, et cetera, we put into not just Meet, but every other aspect of G Suite. Additionally, I would say that because this product Meet has a unique history in that it started and was built primarily for the enterprise audience, and up until literally today was only available to users who were paying customers of G Suite, we have a unique opportunity to actually prove this idea that you can have products that have consumer sensibility, ease of use, et cetera, while preserving the security, manageability, and privacy that's necessary for an enterprise experience to take hold.
Javier, Dan Roberts here. Thanks for joining us. Let me ask you, in terms of the future, once the worst of coronavirus has passed, there are a lot of theories and takes about how this will change the future of work forever, and that a lot of companies will now allow more workers to be remote, which is interesting because I remember briefly a few years back, the backlash to working from home. And, a lot of notable tech companies came out and said, we'd really prefer you to be in the office. So are you guys thinking in terms of that being at least a possibility, or maybe even a likelihood, that even once certain workforces no longer have to be from home, they'll choose to be? And how will that change kind of the needs and burdens of Google Meets?
So glad you asked. And while I don't know that we can do much about summer camps, which was your previous topic there, I'd say that, look, video conferencing technology has been around for a while, right? Like, this isn't new stuff. What is new is that we've gone from having it be we could have some people be remote and sort of an optional thing that allowed people to be, for a group of people in a meeting room to have, some other smaller subset of people not present and still have a meeting and be effective, to now a place where we've had to embrace this so broadly across our entire lives. And through that process have established some interesting things that'll last beyond the sort of shelter in place and the response to coronavirus. So for example, whether it's education, where we've always known that we can use technology as a way to bring education to more people, now we're having to live that at a scale that's previously unprecedented. And the things that we are learning, both as Google, for us as the people building these products, as well as a society in terms of what works and doesn't, is super instructive. Similarly, I would say for the workplace, where if we wind up, after all this is said and done, and we return to some sense of normalcy, with a more opportunity as a result of people being comfortable with what can be done without people being physically in the same space as each other, I think we'll be better off.
Can you give us a little bit of a sneak peek of what that could look like? I mean, I have been amazed at how well this has worked for us and for kids that I have in school, but I imagine you're already trying to innovate for the next level. Is that AR? When is it going to not look like the Brady Bunch, or are we here for the foreseeable future?
It's a good question. The way I approach that or think about it is there's first of all the sense of how do we feel like we're all in the same place, and there's a range of innovations, some of which I've already seen and we're looking at, others that I'm sure are left to the imagination about how do you get as close as possible to recreating the sense of actual human contact. Right now, it takes a lot of effort for me to look at a camera that is not directly where your eyes are at. So I feel like I have to do sort of an unnatural act here to stay focused. Beyond that, it's what are we getting together in these virtual spaces to do? Is it to share content, which is probably the original use case of video conferencing? It's not just we see and hear each other, but hey, you look at my screen. And there's a lot of innovation, including some things that we've delivered relatively recently in Meet and things that you'll see in the coming months that are aimed at making the task of, okay, we're all here together for whatever purpose. It could be like a doctor-patient, telemedicine scenario or a virtual yoga class. How can we, share content and sort of make the experience richer? And then the third leg I'd say is, well, what are the types of things that we are actually going to enjoy doing together in virtual spaces like this, right? So it's not just about the content that we're sharing, but is there an activity? Is there entertainment models? I mean, you all candidly are pushing the envelope here by evolving your broadcast operation so quickly and so effectively into this. So I think we'll keep seeing that, and it's I think less a technology problem, to be very honest with you, and much more of a creative application of this that we have yet to see.
All right, Javier Soltero with Google. Thank you so much for joining us. Great to talk to someone, I guess, on the other side of this exchange, as it were. Hopefully we can talk soon, and maybe we'll take this offline, talk about how Jen can get out of her Brady Bunch mentality here and maybe make it feel a little more natural. Thanks so much for joining us.
Thank you. Thanks, everybody.
All right, coming up in just 2 minutes, we're going to take a closer look at this market rally as we head towards the closing bell and a busy after-hour session for earnings. Facebook and Tesla among the highlights. We'll have that coming up right after this. Go back to Yahoo Finance Live, Miles on here in New York. A little over 3 minutes to go in today's trading session. Again, highs across the board. The Dow up about 530 points, so a little bit off session highs that we saw, but the Nasdaq still up 3.5%. The Russell 2000, the outperformer, up some 5%. As we mentioned, going to be a very busy after-hours earnings session. Facebook, Tesla, Qualcomm among the standouts. Microsoft also expected to report their results. We're going to have all of that for you coming up with the closing bell in just 2 minutes, and we are back right after this.
Welcome back to Yahoo Finance. We've got less than 60 seconds to the closing bell here and a rally on our hands. The NASDAQ is up over 3.5%. The Dow and the S&P both up more than 2%. And the Russell, which has really been the standout of late right now, the Russell is up about 5.5%. It's been a busy day. We've got stocks rising on hopes of Gilead's treatment for coronavirus. Also, we had a Fed meeting and that's the closing bell on Wall Street. So yeah, we had a Fed meeting this afternoon as well. Chair Jay Powell, no real action, so to speak, but it was historic nonetheless. A historic announcement, very different than what we usually see from the Fed in the written word, and then also from the Fed chair himself. I want to bring in my co-host, Miles Udland. Miles, you don't get to talk right now because you're going to be preparing for earnings, but I just wanted to say hi. We've got Facebook, we've got Microsoft, we've got Tesla. We have a slew of after-hours earnings coming up. Andy Server,
Jay Powell. Don't sell them short. That's all.
Don't sell them short. Okay, I just wanted to make sure people knew you were there, but that I wasn't not letting you speak about Chair Jay Powell. I'm going to let Andy Server chime in here. So, Andy, Chair Powell coming out, he was very, I thought, moving and empathetic at the beginning with what's been happening about the virus. And then just through the whole time with answering questions, it was without a doubt the Fed is going to do, it seems, whatever it takes at this point. Is that crystal clear to the markets now?
Yeah, it is. And Jen, I think that you didn't even mention the GDP report this morning.
I did not.
I mean,
you know what, between a drug coming out that might help, and the Fed chair, and after hours. You're right. I mean, we lose these other unprecedented falls because there's so much happening.
Yeah, these are the three big events of the day, really, where the Fed, the GDP report, preliminary report for Q1, which is the biggest drop in 12 years, down over 4.5%. So you got that, but it was really mitigated, and in fact, greatly so, by the Gilead announcement. And Gilead is just a fascinating story. Remember, it took the market down a couple days ago when there was sort of a conflicting report about the efficacy of that drug. And now, of course, it's going to be put to use. But, the techs, are just fascinating, leading the way here. We're going to get a slew of these reports, as you said. But just to give you some really interesting context, I think, Spotify and Google just turned positive YTD, okay? They're up for the year. And by the way, Amazon and NVIDIA are way positive for the year to date, which is, really surprising to me. But it just shows, like, March 23rd, who cares, right?
Yeah. And on Spotify, I'm pretty sure I saw it on the 52-week high list. I mean, Rick Newman, is this market telling us a different story than what we are seeing in the economy? Are we out of sync?
I think we are out of sync. It feels to me like all the world's best doctors are gathering in the emergency room, which is making everybody hopeful, but the patient remains gravely ill. And we just don't know if the doctors are going to be able to do what it takes to heal the patient. So, I mean, it's great news about the Gilead drug, but my understanding of this is, first of all, this is only for treating severely ill people in the hospital. It's not preventive. It's not a vaccine. We have to make sure we don't confuse the two. And I feel like we're going to have ups and downs on this. I mean, the one study out of China, apparently inconclusive. Now Dr. Fauci today even said it looks like this can speed the treatment for people severely ill with COVID-19. But again, it's not a cure-all, and these are still very small trials, and it could still be a long time before this is making a difference in the economy.
Today certainly helped the markets out. We were starting to get news crossing the wires here on earnings. Miles has Qualcomm.
All right, let's go through the numbers quickly here on Qualcomm. The company coming in with better earnings per share and revenue for its fiscal second quarter. The quarter ended March 29th, 88 cents a share on an adjusted basis. Street was looking for 78. Qualcomm reporting revenues of $5.21 billion. That is better than the $5 billion Street was looking for. Another company bucking the trend here of guidance. The company did guide for its current quarter on both the bottom and top lines, looking for revenues in this quarter, $4.4 to $5.2 billion. Current estimates for 4.9, so slightly light there. On an adjusted basis for earnings per share, 60 to 80 cents in this quarter. The Street was looking for 77. The stock was up about 4% in the after hours, up about 3.8% as we check right now. So again, Qualcomm coming out beating and providing guidance, even though the guidance was slightly light. I think, as we noted yesterday with AMD, any company that says anything about the future is giving investors more than they've become accustomed to in this environment.
Yep, certainly not expecting it these days. Let's head to Seana Smith. She's got the breaking news on Microsoft's earnings. Seana.
Hey there, Jen. So it looks like Microsoft beat on both the top and bottom lines here for their fiscal third quarter, coming in revenue at $35.02 billion. The estimate on the street was for $33.69 billion. Earnings per share also topping expectations at $1.40 a share. The estimate from the street was $1.28. Some commentary here just in terms of the impact that coronavirus has had on Microsoft, or lack thereof, I should say, so far. The company saying that they have had a minimal net impact on total company revenue here for the quarter from a coronavirus. I also went on to say that cloud usage increased in some segments. They also mentioned that they did see a slowdown in transactional licensing in the final weeks of the quarter. Drilling down into some of Microsoft's closely watched segments, their intelligent cloud division reporting revenue of $12.28 billion. Their more personal computing division revenue there at $11 billion. And Microsoft also saying that this division did benefit from an increase in demand during the quarter. Microsoft also reporting that their product revenue coming in at $15.87 billion. But again, headline numbers for Microsoft beating on both the top and bottom lines for revenue and earnings per share.
All right, Shauna Smith with Microsoft there. Looking through this release here, Satya Nadella saying, we've seen 2 years worth of digital transformation in 2 months. It echoes a little bit of what we were hearing from Ian Bremmer earlier this week in terms of the changes, the rapid changes that we're seeing here. Andy Serwer, Microsoft, the cloud, bringing it to Amazon, is the COVID work at home response that we're seeing from companies going to be driving this growth? Is this a secular trend that will last longer for the likes of Microsoft?
Oh, 100%. And, it's interesting because, I've heard both ways. First of all, intelligent cloud is Azure. Azure is inside of that intelligent cloud business. So just kind of two names of it. But, I've heard people say that the coronavirus will accelerate the secular trend. And of course it is a secular trend, big time, or it will actually, make it go a little bit slower. I mean, it is a B2B kind of operation. So to the extent that businesses are hurting, it's not necessarily a great time for them. So I was actually really curious and still curious to sort of sort through that. I'm also curious to look at, and maybe Seana, if she's going to be checking back in, I'm not sure, is looking at Teams and seeing how that business is doing. I think they added a bunch of subscribers there. That's kind of an interesting. Now that is a coronavirus play. We were just talking to Javier Doltera, I believe his last name is, from Google, who was in charge of Meet, which we are using right now, and all that Zoom kind of play and all those things are obviously red hot.
We're seeing Microsoft stock up here, but making a big move after hours is Facebook, and Miles Udland has those numbers. Miles.
Yeah, Jen, the stock up significantly. The company here beating across the board, reporting $1.71 in earnings. That's in line with expectations. But then on the revenue line, a blowout here. Advertising revenue, $17.4 billion during the quarter. The street was looking for 17.1. Total revenues, $17.74 billion. The street was looking for $17.3 billion. Facebook also reporting more daily and monthly active users than expected. 1.73 billion daily active users. 1.68 is where the street was at with its expectations. Monthly active users, 2.6 billion against 2.34 for estimates. Now, family daily active people. So this is all Facebook products, which includes WhatsApp, Instagram, and Facebook, of course. 2.36 billion, which is an average of 12% increase over the prior year. 2.99 billion people are inside of Facebook's ecosystem on a monthly basis, according to the company. So I guess 1 of every 2 people in the world, give or take, is on a Facebook property at least once a month. We'll get through some of the details here in a second. Just want to call out quickly, because Facebook does in their release, headcount up 28% year over year in the first quarter. We looked at that with Google in their announcement, Alphabet in their announcement yesterday, still ramping up significantly. I think there is some expectation that these tech giants, even with their strong position, are not going to be quite as aggressive with staffing up as they've been over the last couple of years. But again, as you mentioned, the stock up 6% right now, following better than expected first quarter report.
Go
ahead, Andy.
Oh, a mystery solved for me personally, Jen, because I was out in Menlo Park talking to Sheryl Sandberg not long ago, and we talked about, and then I followed up and talked to her about people using Facebook, and then when I talked to her remotely during the coronavirus time, I said, listen, we know everyone's on Facebook, but are the advertisers still spending money on Facebook? So we knew the numbers were going to be boffo in terms of people using the platform, but were the advertisers going to stay there? Would the revenue stand up? And the answer is yes, they did stick with them, which is unlike traditional media companies who've seen, the numbers of people going to the website staying the same, but the advertising dollars not staying the same.
Sounds like flat is the new up. So
well, they did say they experienced a significant reduction in the demand for advertising, as well as a related decline in the pricing of our ads over the last 3 weeks in the quarter, due to increasing of the business outlook. Also, looks like we're not providing specific revenue guidance for the second quarter or full year 2020. Rather, going to put a snapshot on revenue performance in the quarter thus far. So, Miles, in terms of the guidance here, is that unusual? Is that enough? Would we expect more color on the call?
Yeah, I mean, I think they're going to be pressed for it. I mean, Google was last night, and Google CFO Ruth Porat said, don't extrapolate a couple weeks of a trend there. But Facebook saying essentially what we heard from Google last night, April trends reflect weakness across all of our user geographies, as most major countries had some sort of shelter-in-place guidelines in effect. And so Facebook is not going to be immune from a broad economic slowdown here. I think it's also interesting when you look at their expenses, and we had expected that they would have to moderate some of these expectations. Facebook now expecting total expenses this year to be 52 to 56 billion. Last year, or that's down from a range of 54 to 59 billion. So they're cutting CapEx by 4 billion, at the high end of that. So I think that's going to be an interesting, trend through the year. Obviously, Facebook now is retrenching to some extent, 14 to 16 on the CapEx instead of the expense line. 17 to 19 was the prior expectation there. So certainly ramping down how much money they think they're going to spend this year. And this is only the beginning of that reevaluation. So I will be interested to see, maybe not just on tonight's call, but when we hear from them in July, and then when we hear from them again in October, what do trends look like to the company at that point? Because as we heard from Jay Powell today, this is all kind of just beginning. And I think our biggest companies are feeling the same way.
I'm finding it really striking, the information on advertising, especially following up on what we heard from Alphabet yesterday. So is digital advertising going to be really different than advertising overall? Because in here, they say after that initial steep decrease in advertising revenue in March, we have seen signs of stability reflected in the first 3 weeks of April. So if you do have something and you need to reach out to advertise your product, you're not going to a billboard anymore. People don't want to touch a magazine. Is digital advertising actually going to survive in here? Akiko, Fujita, I want to bring you in for what you've been sussing out as you look through this report.
Yeah, it is interesting that the commentary you just pointed to out of Facebook, pretty much as Miles pointed out, what we heard from Ruth Porat yesterday. I'm not sure I'm convinced that the stability that they have seen, when you consider the last few weeks of March, the significant declines they saw in ad revenue on that front, whether things have in fact stabilized. Because if you look at companies who usually advertise on these platforms, we're talking about those sectors that have been hardest hit, whether it's the hotel sector or the leisure sector or the travel sector. But to your point, Jen, I think that is maybe a broader question to raise, which is the area where these advertisers go to, is that going to shift? In that case, you look at a company like Facebook or Google, and they're certainly best positioned to take advantage of that. I wonder if we can go back to the numbers from Microsoft, though, because, we've talked so much about these companies that are benefiting on the back of these stay-at-home restrictions. And you could certainly argue that Microsoft has, across the board, the portfolio essentially for these companies to help them adapt to increase digitization. I did think it was interesting when you look at, when you look back to several weeks ago when Microsoft essentially came out and said that they were having supply chain issues. Those constraints potentially could offset some of the gains they saw because of the shutdowns they were seeing in China. And in this report, we're seeing Microsoft essentially saying that in at least the personal computing segment, they did see a big benefit from increased demand to support remote work and learn scenarios, but that was offset by supply chain constraints in China that did improve later in the quarter. So that may be a number to look for moving forward, because all indications is that manufacturing is bouncing back in China. And so you wonder going into this quarter whether Microsoft is going to see the gains on the back of that as well.
Yeah, and on the ad front, go ahead, Jen.
Go ahead. No, Andy, I wanted to jump to you on Facebook.
Yeah, just jumping back to Facebook, 2 quick points. First of all, digital advertising can very much be impacted during downturns like this. In fact, it can be pulled much more easily and much more quickly than traditional advertising, because you can just ping a program out as opposed to a longer term commitment in different types of media. So that's number one. Number two, the street likes what it sees with Facebook, you guys, because that stock was trading at 183 when we started the day, the start of the session, and after hours is now at 210. So, and then because, Jen, if all advertising is going to get affected and digital advertising is going to get affected, the company that's going to get least affected is the Facebook.
We also saw a big move in the regular session for Tesla ahead of their results, which are now out, and Miles has had a chance to dissect those. Miles.
Yeah, a little bit more of a muted move from Tesla here after hours, though the company is out again with more good news. $1.24 in adjusted earnings per share. The street was expecting a loss of 37 cents. Revenues in the quarter, $5.99 billion. The street was looking for $5.81 billion. So a beat there. The company did report negative free cash flow, $895 million. That's a little bit more than the $605 million that the street was looking for. But Tesla has $8.1 billion in cash on hand. Feels like a lifetime ago, but they did come to market in February when the stock went to $900 a share. Stock's at $817 here, $816 in the after hours. So, the Tesla story was really what dominated the beginning of 2020, but has fallen obviously by the wayside here to some extent. But again, another better than expected quarter out of Elon Musk. He's pulled a few of these off in a row now. I think it'll be a very interesting story to track, obviously, going forward. We're going to talk to Tasha Keeney of ARK Invest in about a half hour for more on Tesla. But again, Tesla beating top and bottom line, stock up in the after hours.
All right, a busy after-hour session. We're going to keep our eye on all of these names here, see how they just continue trading. Coming up, though, on the other side of this break, again, more earnings reaction. Plus, we're going to talk to New Jersey's Governor Phil Murphy about the state's COVID-19 response and plans to reopen the local economy. We're back in 2 minutes. Welcome back to Yahoo Finance. New Jersey trails only New York in terms of the number of cases and deaths from COVID-19. Residents there have been under lockdown since a March 21st stay-at-home order from Governor Phil Murphy. He joins us now. Governor, so we're seeing other states start to dip their toe into opening up. What is your very latest thinking on getting New Jersey back in business?
Good to be on with you. You're absolutely right. We're the second most impacted state. We've lost over 6,700 lives. It's almost unfathomable. We put in place earlier this week a 6-step road to recovery plan. The first 4 steps of those are healthcare related. And the most important one is we need to see curves continue to go down, whether it's flattening of the positive test curve or hospitalizations continuing to go down, and they have begun to do that. Intensive care beds, ventilators, et cetera, and we're still losing too many lives. So that's got to be the first step. We're not there yet. I think we're several weeks away, but we are going to start to take some baby steps. I announced, for instance, today that effective this weekend, Saturday morning at sunrise, we're going to reopen both state and county parks and allow golf to take place in New Jersey under very explicit parameters, assuming folks do the right thing. They don't congregate in those parks. They keep social distancing. They wear face masks. We'll keep those parks open. That's a maybe a symbolic but important one for mental health and for folks who have been locked up for weeks upon weeks. And by the way, New Jersey's compliance has been great, but this is a step, I hope, in the right direction. The first of many we're going to have to take, but it's going to take some time.
Governor, good talking to you again, and thanks for that update. One of the things I wanted to ask you about is I know that you have an all-star cast really ready to go on this commission that you've started, including former Fed Chair Bern Bernanke and CEOs of Campbell's and Prudential and Merck ready to help you open the economy. What are you looking to them for in terms of guidance, and what will their role be to help New Jersey restart?
Good to be back with you, Anjali. Yeah, this is a group that we announced yesterday. It's about 20 persons, including most notably the lieutenant governor, who are ex officio members of the committee. The theory is a simple one. None of us have ever done this before. None of us have ever lived through or governed through a pandemic, and then the recovery that we're going to need to see that follows. And so the hope is that this group, which represents a whole range of perspectives. You mentioned 3 outstanding current and former CEOs, Rich Trumka, the president of the AFL-CIO, Neera Tanden, who runs the Center for American Progress. We've got a small business representative on that committee, faith-based arts community. We need wisdom from them. We need them to react to suggest steps that they think are prudent, that we should be taking. You know, this has been both a crushing healthcare crisis in our state as well as a crushing economic crisis in our state, frankly, in our country. And we need all the help and wisdom and advice we can get.
And what about testing? I mean, we know that you have the site of the first drive-up saliva testing in the country, as well as you announced that you're going to be ramping up as well, mirroring what New York's efforts have been. So, how are you maintaining the supplies and looking at that? The supply chain has been such a big issue. Tell us what's going on in terms of that. Is it really the federal government versus the state right now?
Yeah, no, I'd say it's actually right now we've got a high degree of cooperation with the federal government. You know, we started as a country completely unprepared for this, and I'll use testing as the best example of that. New Jersey's cobbled together, frankly, with bubble gum and paper clips. We're now the 3rd or 4th highest tested state in America, but the feds, to their credit, particularly early on with FEMA, have been there for us. So one of those 6 benchmarks that I announced, in addition to on the road to recovery, in addition to seeing those curves go down, Anjali, to your very good question, is we've got to get scaled up testing, and it's got to be rapid return testing. Rutgers University, our flagship state university, has done extraordinary work on this. I see some cheers there.
Yeah, Charlotte Knights there.
Amen. RU is in the house. But I would say we've got a very good rhythm going right now with the federal government. I hope even before the end of this week that we'll be able to announce some specifics in terms of not just having the ability to test, but to have our arms around the supply chain with thanks to the federal government. But more to come on that.
Governor Murphy, hey, Rick Newman here. So are you getting everything you need from the federal government at this point, or do you need more? And if you do, what is it?
Yeah, I'd say 3 things. Number 1 is the testing supply chain. As I say, I think we're in a good place, but not. You know, I'll ask you to look for some more definitiveness around that over the next number of days. Secondly, we constantly make the point that we desperately need direct federal cash assistance, and New Jersey's not alone. This is states of blue and red colors all over the country, but particularly the ones that have been hardest hit. And we are at or near the top of that list. This has been a historic blow, not just to individuals who lost their jobs or to small businesses or sectors like airlines and casinos and others, but state governments. I know ours, our expenses go up by the day as we're taking care of the folks who've been impacted. Our revenues are off a cliff. So we definitely need that. And that's something that's still outstanding. That's a congressional matter, obviously, but we also need the president to sign anything that gets his way. And thirdly, and finally, this is not going to be over in the next couple of weeks. We need to make sure that we have a sustaining partnership with the federal government, because we're part of, at a minimum, we're part of the New York City metro reality. Even if we bat 1,000 and reopen our economy exactly the right way without any mistakes, this virus, according to anybody who's an expert, will suggest is going to come back and bite us again. We got to make sure that we're in this relationship with the administration for the long haul. Those are the three, I'd say, realities right now.
Governor Murphy, Andy Serwer here. You know, one thing the virus does not respect is state lines, right? The coronavirus doesn't understand what a state is. And I know you've been working with Governor Lamont and Governor Cuomo, but how are you coordinating things? I mean, you've got like mass transit coming in from New Jersey into the city. How is that all going to unfold?
Yeah, Andy, very good question. And you just peeled yourself off the ceiling after the Rutgers comments. I just want to make sure the viewing audience knows. Listen, it's got to be really three rings of focus, I believe. In my case, we got to make sure that whatever we do to get back on our feet meets the litmus test of what's right for the 9 million folks who call New Jersey home. The second ring is, to your very good question, we got to do this, if not exactly coordinated, at least harmonized with the relevant neighbors. And for us, we formed a regional council. We had basically been informally checking with each other the entire way. When we shut down, we said, you know what, let's put something, a little bit more formality around this as we reopen. And so things like mass transit are exactly the sorts of things that we're trying to come to grips with right now. What's the new normal look like? What's the work at home reality going to be? What's the capacity that we should impose, everything from a restaurant to a transit train, et cetera. And then the third ring is we need a deep and abiding and sustainable relationship with the federal government. And I think it's got to be all three. It's when we announced that regional council, folks said, oh gosh, they're doing that because they can't get what they want from the feds. That's just not true. We need to do both. We got to get it right for ourselves, our neighborhood, and with the federal government. And those are exactly the sort of questions that you're asking, that our regional council is pondering as we speak.
Governor Murphy, I want to get back to that earlier point you made about the massive revenue shortfall you face right now. You've made the point, like many other governors, that you need the help from the federal government. What happens if you don't get that in a timely manner? What's the alternative? Are you considering tax hikes in certain areas, massive cuts? What's the plan B?
Yeah, I don't think there's any amount of tax hikes that you can put in place that comes close to what we're talking about. In New Jersey, this is a $20 billion or more hole. So there's no amount of taxing that we can do. It would be massive cuts in service and headcount. Which is exactly the last thing we should be doing for a number of reasons. Number one, the people's livelihoods. It would be crushing to yet another universe of first responders, educators, EMS, et cetera. Secondly, would be pulling services from the very folks who need them the most at the time of the most significant healthcare crisis in the history of our nation. So it couldn't be worse timing. And if that weren't enough, we're already at all-time highs in terms of unemployment. Would be probably coming close, back of the envelope, doubling unemployment in America right now. So for all of those reasons, please God, let's take door number one: federal direct cash assistance into the states, not just New Jersey, but for states across the country, particularly those that have been hit hard. And that's the smartest, in my opinion, overwhelmingly the smartest thing we could do right now.
And Governor, one of the things that I know you pointed out, what the new normal looks like. What does that look like for businesses, and what can the private sector expect you to come out with in terms of rules and what your expectations are?
Yeah, I mean, Angela, I think it's too early to give you a full chapter and verse on what that looks like. If you look at the state parks, for instance, we are mandating, none of the playgrounds will be open, no picnics, no rest areas, no visitor centers will be open. We're expecting folks not to congregate, keep at least 6 foot distance. Mask is strongly recommended. I think you're going to see similar, by the way, we're limiting our parking lots to 50% capacity. I think you can assume that steps like that will apply plus or minus in a lot of different ways. What's a warehouse look like? I think it's going to be hyper social distancing, hyper cleaning of surfaces, face masks, work from home wherever practicable and possible. I think it's going to be. You said it. It's a normal, but it's going to be a new normal, and it's going to be, I think, a quantum step for our country, not just our state, in terms of when we all look back on this decades from now. This is going to be a major inflection point for how we go about our lives.
And final question, Governor. You're a former Goldman Sachs guy. Not that we hold that against you in any way.
Recovering banker.
Yeah, there you go. But what's your take on the economy? You know, we just got that GDP report out that was pretty grim. Q2 is probably going to be worse. Unemployment, recession, very likely. How's this going to unfold for the balance of the year?
Gosh, I don't know that I've got a big enough crystal ball. I know it's a hell of a rough patch for us in New Jersey. I do think if you look at the textbooks, I'm strongly of the opinion, spend, and don't worry about your indebtedness right now. And that's something that is counter to the first couple of, I got elected to fix the economy and get the state back in order. And so we've been making record pension payments. We've been having record fiscal surpluses and rainy day funds. We've been managing our indebtedness. I think you got to use a different playbook right now. I think the federal government, we can't print money, but the feds can. So I think stimulus in a big way to states. I like the Federal Reserve's borrowing or lending facility they announced a couple of weeks ago that they'd buy municipal bonds. I'd like to see New Jersey take advantage of that. I think we shouldn't be worried right now. Again, there'll be a time to worry about this, but I'm less worried about the balance sheet right now. I'm much more worried about getting cash in the barrel to the point of attack, including to folks who are unemployed, small businesses, big impacted sectors, and especially to states.
Governor Phil Murphy, New Jersey's governor, thank you so much for joining us. We know you have a very full plate, and we appreciate your thoughts and all that you're doing.
Thank you so much for having me, everybody.
Coming up, we've got much more. We have a very busy after hour session. We're going to go back to talking about earnings. We have eBay still to come, and much bigger discussion on Tesla ahead with ARK Invest, Tasha Keeney. Welcome back to Yahoo Finance. Stocks up more than 2% in the regular session. A rally continuing after hours for the likes of Facebook, reporting stability in ad revenue. The stock is up nearly 10%. Let's see how eBay is doing. They have also reported results here after the bell, and Shauna Smith has crunched those numbers for us. Shauna.
Hey there, Jen. Well, the stock's not reacting nearly as well as Facebook is to their earnings. The stock is down just around 0.7%. So let's go through some of these numbers here. Taking a look at the headline numbers, it actually was a pretty positive here from eBay when you compare it to Wall Street's expectations. So revenue coming in at $2.4 billion, and adjusted EPS coming in at 77 cents. Drilling down into some of the additional numbers that eBay has put out for this quarter, they said that active buyers grew by 2% for the quarter for a total of 174 million global active buyers. The company also reaffirming their full year guidance. They did not make any changes to their full year guidance. So that, of course, is something to note here during this time, because we're seeing many companies pull their guidance for not only the current quarter, but also going ahead for the rest of the year. The company also offered some comments about how its business has been impacted by coronavirus. eBay saying that its marketplace has seen a surge in demand, and they said that they saw strength since mid-March and has continued through April. So that, of course, is a good sign, a strong sign for the company. But on the other hand, their classified business, eBay saying that their classified platforms have been adversely impacted by recent auto dealer closures in many international markets. They also said that lower traffic to horizontal classified sites around the world due to social distancing requirements and lower advertising revenues has put some pressure on eBay's classified business, and they expect that pressure to continue. They say that has continued into April, so something to keep in mind for eBay's current quarter. Now, what's also interesting, eBay said that it continues to explore potential value-creating alternatives for its classifieds business, and saying that it is holding active discussions with multiple parties and anticipates having an update by the middle of the year. So that's something to keep an eye on as we move forward here from eBay. But again, looks like pretty solid headline numbers from eBay, coming in at revenue of $2.4 billion and adjusted EPS of 77 cents.
All right, Shauna Smith on the eBay front. We're continuing to see big gains out of Microsoft and Tesla and Facebook here. Much more to come in just 2 minutes. Welcome back to Yahoo Finance. Facebook shares were up more than 6% in the regular session. Now we've gotten the earnings. They're up another 9%. Miles, you crunched those numbers early for us going through the report. We're still waiting for more commentary here. What has investors so excited to bid this up 9%?
Yeah, I mean, I don't know, Jen. I kind of wonder how much the market is just looking at what Facebook is telling it and saying, well, I guess it could have been worse and it's not. And the company coming out here, pulling their guidance for the full year, which we expected, and they go through in great detail what they've seen in their business so far. They've got an initial steep decrease in advertising revenue in March, but then signs of stability reflected in the first 3 weeks of April, where ad revenue has been flat compared to the same period last year. Now, of course, most investors want Facebook to be growing 20 or 30%. But ultimately, if you can say flat compared to last year, that's going to be a win. April trends reflect weakness across all our geographies, as most major countries have had some sort of shelter-in-place guidelines there. So I think the street is simply reacting to what we've seen in the virus data. We're reacting to what we've seen, from other major companies where, sure, things aren't good, but they could have been worse. And that is the market's operating. That's the MO right now. So Facebook, again, not coming out with tremendous news, but in this world of, as long as it's not something I was afraid to hear, I'm going to be okay. That seems to be the reaction here. Again, the stock is now up 9% after hours, $211 a share. We're within striking distance of record highs for Facebook, which, they hit back in the summer, $223 per share. So for the company to be back, discussing a record high, I think for a name in the FANG group that has lagged for a long time, I think is really something it tells you a lot about right now the strength of this market.
And Andy, just to look at a note that Credit Suisse, which has an outperform on the stock, put out, they're just saying, look, we're just too conservative on Facebook and underestimating the long-term monetization potential for the stock. It goes to, during this crisis, the big are going to get bigger here and more powerful.
Yeah, 100%. And first of all, when we talk, well, it wasn't so great, it's not so amazing, but, compared to other things out there, it's an extremely strong company, an extremely strong position. And it really does speak to what you just suggested, Jen, which is the fact that the FANGs are going to be coming out of this thing stronger than ever, each and every single one of them, and each and every one of them in their own way. And I'm just so fascinated, aren't you, by what Washington, D.C. is going to do when, they were all belly aching about these companies having too much market power, too much power over our society, our economy. And then we went through this crisis and, gee, look at them. They're even bigger. Can you imagine?
Yeah, maybe we'll get back to the old conversation before too long. So also making big moves after the bell here. Tesla stock is up some 7.5%, tacking on to gains of 4% in the regular session. Coming up next, Tasha Keeney from ARK Invest. We're back in just 2 minutes. Welcome back to Yahoo Finance. Tesla shares higher here after hours after reporting top line growth in the first quarter over last year. Also, an unexpected profit coming even amid the coronavirus pandemic. I want to bring in Tasha Keeney from ARK. We've talked to her many times about Tesla. You are a Tesla bull. How do you think people should be evaluating Tesla right now in the time of this global pandemic? Has it changed any of your thinking, any of your analysis around what you like about Tesla?
That's a great question. I think a lot of the focus right now is going to be on sort of short term, when are things going to reopen because of the health crisis. But for us, we think of this time as, so one, we think it'll actually accelerate some trends that we already saw happening. We had always thought that the auto industry would consolidate as autonomous electric cars took hold. Not every company is going to have a credible platform, and not every company is going to survive this transformation. A crisis like this, we think, is just going to accelerate that consolidation. So we're already seeing companies like Ford. Ford just discontinued their partnership with Rivian for a new electric vehicle project. I think other traditional auto companies are going to have to push pause on their side projects or innovation projects, where companies like Tesla that are built sort of from the ground up as an electric vehicle maker, we think they're a leader in autonomy as well, will really come out of this as one of the leaders. And compared to the rest of the auto industry, everyone is going to be hurting, and there's some structural things in place with Tesla that the other players just don't have.
So that's the bull case for Tesla, which is the competition just basically falls farther behind. But at the same time, you've got oil prices at record lows, which means gas prices are going to be that cheap. And there's going to be less incentive for people to buy electric cars. And Tesla did seem to say they noticed a shift downward to their lower priced models in the first quarter. So how much is that going to hurt the company?
We've done some analysis on how much we think gas prices will affect EVs, and the answer is really not that much. So one, actually, the savings that you get from an EV, if you look at the operating cost, gas prices are really just sort of a small part of that equation. You get a lot of savings on maintenance and other pieces of owning the car, and also we just think consumers aren't doing that math. They're really looking at sticker price. So for us, the big point here is when electric vehicles on a sticker price basis become cheaper than gas-powered cars. And that's driven by the battery cost decline curve. So that's really an economies of scale question. So we see that happening in the next couple of years. So that's really what we're looking out for.
So following up on Rick's point, though, I mean, how do you see the demand picture shifting as a result of sort of the economic fallout that we've seen as a result of this? The gas prices, it sounds like you don't think that's going to be a significant factor. But I mean, Tesla cars aren't cheap either. So do you see a significant shift, or are Tesla buyers, those who are looking to buy before, still going to continue to look to this car?
Yeah, well, I think we've seen some initial positive news. For instance, we think premium vehicles could actually hold up better than the rest of the segments in a time like this. But in general, when you think of Tesla in particular, I mean, they've always been supply constrained. We have not thought this was any sort of a demand issue with the company. And in fact, in China, we're seeing, electric vehicles are really still strong. And most importantly, Tesla has that Chinese factory up and running. And it started production again since the shutdown. So we think, the demand picture, it has sort of always been there for Tesla. So it's really just a question of the supply.
With all this stimulus coming out of Washington now, does Tesla need another electric car subsidy? I think the benefits to Tesla for that were about to run out. Is that part of your bull case?
When we model battery cost declines, we don't take into account government subsidies. They're very hard to predict, and we really look at ARK Invest for innovative technologies that survive without government support. So we think even without subsidies, on a like-for-like basis, an EV could be cheaper than a gas-powered car within the next couple of years. So we think there, again, back to that demand question, there's demand for electric vehicles because they're actually better cars. They offer better performance on a total cost of ownership basis. They're already cheaper than gas-powered cars, and that's without that subsidy. So we're not too concerned on that front.
Tasha Keeney with ARK Invest. Also want to note here that Tesla is the top holding in the firm's three big funds. Tasha, it's great to see you at this time, and stay safe. Thanks for talking with us about Tesla.
Thanks for having me.
We're continuing to see gains here after hours in Microsoft, Facebook, and of course, Tesla. We'll be back with much more after this break. Welcome back to Yahoo Finance. Every now and then, with our attention focused so closely on the public health crisis, you forget that we are in a presidential election campaign year. And Andy Serwer, you had a wide-ranging interview with former Commerce Secretary Penny Pritzker, and you talked about the campaign. What did she have to say?
Jen, the election's less than 190 days away, I can tell you that. So we're going to be paying much more attention to that in the coming weeks and days. I talked to Penny Pritzker. She is a strong supporter of Vice President Biden in his bid to become the next president. I talked to her about that. Here's what she had to say.
Well, the campaign stands in a really good place. The vice president continues to make the campaign and his team stronger and stronger. And that's the opportunity that exists for him, given that he's just, really become the clear nominee. Second thing he's done is unifying the party. You see him reaching out to folks, not abandoning what he believes in, but really making sure that the tent is open and welcoming to all parts, all comers, anybody who wants to be a supporter of his. I think Vice President Biden is experienced and tested in crisis. And we know this. He's seen public health crises like the Ebola crises or the H1N1 crises. He's lived through those. He's been part of the leadership of, he was charged by President Obama with seeing us through the economic crisis in 2009 and thereafter. And so, Vice President Biden also is a man who relies on facts, on data, on truth, on experts, all of which are necessary for us to fight the current situation. And I think he would be decisive both in addressing the public health crisis by giving clear direction, by relying on experts, by having wide availability of free testing and making sure that everyone knew that they could afford that and they shouldn't hold back because fear of not being able to pay. So he would eliminate the cost barriers. And he'd have full deployment of all the operational resources necessary. He would garner the federal government to do its job. This is why you have a federal government.
Yeah, obviously, Penny Pritzker is a big fan. There's no question about that. And, possibly looking at a cabinet position if Joe Biden gets the nomination and then if he's elected president. So that only time will tell you guys.
Yeah, and as you said, how much time is left?
Well, it was 190 days on Sunday or Monday, something like that. So
it's coming.
Yeah, it is coming.
One way or another. Interesting interview. So just to wrap up the day, we have had possibly a breakthrough in treatment with Gilead. We have had GDP falling, as Andy Serwer noted at the beginning, a historic drop there. We had a Fed meeting where nothing happened, but history was made time and time again. And then we had a busy after-hours session. Miles, what stood out to you the most during this day?
I think the way that the market's reaction to the GDP data, and we're going to get a terrible claims number tomorrow, continues to confound many. But ultimately, it's just telling you that, look, the market looks forward, and it's just looking forward further than I think a lot of investors believe prudent. But that's the world we live in. Jay Powell said the Fed's not going anywhere. The market's looking 3-6 quarters down the road, and that's kind of the world we live in.
Andy Serwer, the market is doing what it's doing, and Jay Powell says he's not running out of money anytime soon. You heard Governor Murphy as well. We had an interview with him. Andy, I want to get your last thoughts, but I got to go. I'm going to have to get them in the break. You're going to have to stick around and talk with me on the phone. We got to leave it there for today. I'm Jen Rogers. You've been watching Yahoo Finance, and we'll be back here tomorrow.